Good morning. It is 9 a.m. on Friday, January 14th. This is Yahoo Finance Live. I'm Julie Hyman. Brian Sazi and I have a big show for you today. There is a lot going on this Friday. Let's start with looking at the futures here this morning, where we are seeing fairly significant declines being indicated of about 0.8% to 0.9% across the board here. That's after we got a retail sales number that was much worse than anticipated, falling by 1.9% month over month in December versus the 0.1% drop that was estimated. We are going to get details on these numbers and try and figure out what happened in just a moment. Also, the Fed getting more diverse as President Biden releases long-awaited nominations for 2 governors, plus the top banking regulator at the central bank. We're going to have details as well as reaction from former Fed Governor Betsy Duke. Pour one out for Truly. Weak sales of the hard seltzer led to another profit warning from its maker, Boston Beer. We'll have details on that and the stock action. And our top story this morning has got to be the big banks who are starting to report. JPMorgan, Wells Fargo, Citigroup, BlackRock. That means no rest for the weary. Brian Chung with us right now to talk us through some of the numbers. And Brian, what really stands out to me and what was sort of hinted at in the Jefferies numbers that came out a couple of days ago, weakness in fixed income revenue, which seems to be now a theme across the banks.
Yeah, and you rewind to the depths of the pandemic, and the big trend at the time was that those money center, big markets-focused banks were the ones that were doing well. The bread and butter consumer banks were not doing so well. Maybe starting to see a little bit of a reversal, at least based on the initial earnings that we've gotten. Let's start off in Midtown Manhattan with JPMorgan Chase, the nation's largest bank, revenue coming in at $30.4 billion on bottom line adjusted earnings per share of $3.33, beating estimates on both the top and bottom line. And Julie, you highlight the really interesting number that kind of isn't seen in those headline numbers, $3.3 billion in fixed income commodities sales and trading. That fell short of the street's estimates of about $3.4 billion. And also take a look at equity sales and trading, also missing the mark quite a bit, $1.9 billion versus the street's estimates of about $3 billion. You can see the numbers on the screen ahead of you in terms of those breakdowns of the different types of revenue lines for the bank there. Jamie Dimon, the CEO, saying that the economy continues to do quite well despite headwinds related to the Omicron variant, inflation, and supply chain bottlenecks. But again, maybe reduced volatility, at least in the markets, leading to fewer revenues, at least in the investment banking side of things. But let's take the E-train downtown to Citigroup, if you will, also here in downtown Manhattan. The revenue coming in at $17 billion, just squeaking out above the street's estimates of $16.8 billion. Adjusted earnings per share, interestingly, coming in at $1.46, short of the street's estimates. You don't see that too often in the banking industry. Now, they had a similar story with regards to a market slowdown in fixed income, $2.5 billion in total fixed income markets revenue compared to the street's estimates of $2.7 billion. So again, Wall Street not expecting this type of slowdown as we saw in fixed income. That's a 20% year-over-year decline, by the way, pretty comparable to the 16% year-over-year decline that we saw at JPMorgan Chase. But a lot of moving parts here with Citi. They're changing shape. Actually, they exited their retail bank business in Mexico to focus on institutional and private bank businesses. Jane Fraser, the CEO there, is calling it a refresh of our strategy. But again, Citigroup changing a lot, especially when you consider they exited 4 businesses in Asia. But let's hop on a plane now, go out to San Francisco, California, where another major bank reported. I'm talking about Wells Fargo, of course. Fixed income, not as much of a big story for Wells Fargo because they're more of a consumer bank. In fact, their fixed income trading business is less than $1 billion, so it's really not even worth mentioning. What we want to see is the underlying loan pipeline for this bank because they're so consumer facing. Things actually look pretty good on that front. The revenue coming in at $20.86 billion. They beat the street's estimates on the bottom lines, but average loans actually decreased 2.7% on a year-over-year basis, but they still increased their revenues by about 13% year over year. How did that happen? Non-interest income going up 27% year over year. Keep in mind, though, this might be changing. Wells Fargo is among the other major banks that said they would be reducing their overdraft and their non-sufficient funds fees. That's good for consumers, but obviously, how will that impact their non-interest income numbers? We'll have to see in the quarters to come. And if you thought we were done, a little bit of a head fake, I've got one bonus bank for you. We're talking about BlackRock here. They're not your bank's bank. They're really more of an asset manager, but worth mentioning here, they had revenue of $5.1 billion adjusted earnings per share of $10.42. Total assets under management up 15% on the year. That's the trend for BlackRock through this post-pandemic period. But interesting to see that expenses actually got bigger for employee compensation and benefits, up 16% year over year, showing the bid up in wages, at least on Wall Street in the labor market there. And guys, this is a trend that you're seeing at the other banks as well. And as a reminder, I'm not done with the bank earnings. We got Bank of America, Morgan Stanley, Goldman Sachs. That won't be coming, though, until next week. So at least I'll get a little bit of a breather over the weekend, guys.
Brian, were there any other positives in these reports? Because bank stocks were set up, really, they have been priced for perfection. And, the market is expecting these names to show some good profits later this year when the Fed starts hiking rates.
Well, I mean, you can make the argument that maybe they were priced for perfection headed into the fourth quarter earnings. Obviously, the financial stocks, when you just look at the XLF over the year 2021, was pretty good, especially when you consider how hard these bank stocks got hit during the depths of the pandemic. And as you mentioned, a lot of that 2021 updraft was because of the optimism over a steepening yield curve. And for banks that borrow short and lend long, that's often better operating of an environment for these banks to kind of serve in. Now, of course, with the Fed hiking interest rates, in theory, that should be good. But you have to remember that, at least in the short term, the effect of hiking interest rates actually leads to a flattening yield curve. So the dynamics are very much different. I think, again, the story is really not necessarily about what is the shape of the yield curve, at least in the short term. It's really all about volatility. And I think when you talk about 2021 and the Omicron variant, and yes, that did introduce some volatility towards the end of the year, the volatility that we saw, at least for capital markets, if you're at a trading desk, just simply aren't as profitable as they were perhaps in 2020. So in many senses, of course, the pandemic, you don't want to compare anything to 2020, but at least for those trading desks, some of that volatility was very good for fixed income. When you take a look specifically at even Goldman Sachs and Morgan Stanley, will be very interesting to see what their numbers look like next year. But that story is starting to shift again. Like I mentioned, fixed income, especially with those comps as large as they were in 2020 and parts of 2021, it's going to be very difficult for those money center banks to beat those estimates again.
And maybe difficult for them to extend those gains to Sazi's point with that XLF and near record levels. That's that ETF that tracks the financials. Thanks so much, Brian. We will talk to you again in just a few minutes. And in the meantime, we got to talk about those shocking retail sales numbers. I mean, I was shocked, at least this morning, to see that 1.9% drop month over month in retail sales versus the 0.1% drop that was estimated. And really, Brad Smith is covering this for us. Sorry, I'm tongue-tied because I'm so surprised by these numbers. I mean, you go down the list here, any way you break it down, you can back out cars and gas, you can look at the control group, any way you slice it, this was a miss.
Yeah, that's spot on, Julie. It was a huge miss this morning against the expectation in a decline of 0.1%. The U.S. Census Bureau announced a decline of 1.9% in retail sales in the U.S. for the month of December 2021, and that versus the expected decline that I mentioned a moment ago of 0.1%. Ex autos, as you mentioned, that decline was 2.3%. Ex autos and gas, the decline was 2.5%. And then additionally, we saw a little bit of a revision lower in November of 2021 as well, which came in at 0.2%. And so where did the largest decreases come in by segment? I want to break that down for a hot second. Non-store retailers, that declined by about 8.7%. You saw furniture and home furniture stores, that declined by about 5.5%. And then additionally on the sporting goods and the hobbies, not a ton of people buying new musical instruments and books and bookstores. That saw a decline of 4.3%. Here you're taking a look at the side of your screen at the S&P 500 retail sector ETF. We're going to continue to track that throughout the day, but we've seen some declines early going into the start of today's trading session as we're just about 20 minutes out from that. The retail sector has been a focal point during the week. We got CPI data that revealed a 7% increase in December year over year, or at least over the year prior here, the highest 12-month increase since 1982. We also saw some supplemental digital sales data that was published by a host of companies, either transactions companies and spending pulses. Salesforce, we spoke to them this week, revealing that prices were 25% higher compared to the 2020 holiday months of November and December. And as we've seen these analyses come forward from some of those card processors and online sales platforms about records, they also come with the fact that we saw a lower volume in the pace of transactions year over year. And so that's significantly lower, as well as some of the headwinds that we know were navigated by many of the names in the retail retail sector that we track on a day in, day out basis, and many small businesses as well. That's shaped up for what we got here in this massive decline between the 2 months, both November and December in this holiday season particularly.
Brad, I'm still confused by these numbers. I have to say, I mean, especially since those numbers that you're talking about, which yes, showed maybe a decline in volumes, but most of them were strong numbers. MasterCard spending pulse, those Salesforce numbers that you mentioned. And Salesforce in particular was looking at digital sales, which, as you mentioned, fell by 8% in December. So you have to wonder, I mean, there are a number of things that you can point the finger at here. You have to wonder, is part of it that people were heeding the calls, the alarmed calls to buy early? Is it that people couldn't find what they wanted maybe by the time December rolled around and so didn't buy it? Is it that they were deterred by some of those higher prices? Is it some combination of all of these? I mean, it's just difficult to sort of suss out what was going on.
Right. And if we can break it down in a few categories about where they were purchasing, when they were purchasing, and increasingly what they were purchasing as well. And we'll start with the what and the inventory concerns and the constraints there that we had seen many of those retailers signal going into the holiday season. That pulls us into the when they were purchasing. And perhaps many, to your point, of the consumers were heeding the call of companies to say, if you can get the purchasing done early, do so, because that will guarantee that you have products by the holiday season. Now, what that does is it certainly puts that dampener on December, if you will. And so that kind of dovetails us into the last portion of this in where they were purchasing, whether that was online or in store. And increasingly, as we've talked about the omni-channel approach, and I know you had a great conversation with the JPMorgan analyst in retail yesterday, just about how important that omni-channel approach is, both the combination of brick and mortar and digital. That was something that is noteworthy, particularly in this report, is what stands out to me in those categories that we were breaking down a moment ago, and where people may have pulled forward some of that purchasing activity to ensure that they actually had the product ready, either on the shelf, under the tree, whatever the case was, ready to be given to somebody else, perhaps over the holiday season, the season of giving.
And of course, then there was Omicron as well, which we didn't even really get into, which certainly probably kept people out of the stores and kept staff from working as much in the stores. We got to leave it there, though, right now. Brad, thank you so much. Appreciate it. Well, coming up next, as we mentioned, we did indeed hear from President Biden, who has picked some new Fed governors, as well as the top banking regulator. We're going to discuss this with former Fed Governor Betsy Duke. That's after the break.
Well, last night, the Biden administration making the news that it was going to be rounding out its Fed nominees with names to fill the last 3 remaining vacancies at the central bank's board: Lisa Cook and Philip Jefferson for governor roles, and Sarah Bloom Raskin for vice chair of supervision. We want to zoom in a little bit more on that news now with someone who was inside the Eccles building itself. Former Fed Governor Betsy Duke, also former chair of Wells Fargo, joins us now over the phone. Betsy, it's great to have you on the program this morning. You were at the Fed from 2008 to 2013, and you worked with Sarah Bloom Raskin for some of that time. Just wondering if you could have any sort of quick reaction to the news. What do you think she brings to the Fed, especially in that very important vice chair of supervision role?
Thanks, Brian. Yeah, I'm actually really glad to see that they're going to round out a full complement of Fed governors, because the work of the Fed works best when you have full complement of 7 governors, and I think they are 3 outstanding nominees. Sarah, in particular, I did work with most closely on taking all of the capital rules, the Basel capital rules, as well as implementing Dodd-Frank, and not only implementing them, but paying attention to the impact that they would have on smaller institutions, and trying to simplify those rules so that they didn't present an undue burden on the small banks. She's a solid regulator, and I think a really good choice.
Now, what is the significance of the vice chair of supervision role specifically? Because this is a role that there's only ever been one person sitting in. It was created in 2010. So Sarah Bloom Raskin, having been there as a Fed governor, might be taking on some slightly different responsibilities in this specific role, especially with some Republicans perhaps saying they're concerned about whether or not she's going to be too hard on banks. What do you see as her approach to regulation if confirmed by the Senate?
Well, the vice chair for supervision was created in Dodd-Frank, and the purpose was to really elevate the supervision role that the Fed has. And so it's a difficult role, because you have responsibility for not only supervising individual banks, but also keeping an eye on the overall financial system and making sure that it is solid and safe and available to support the economy. So, it is a tough role, and it requires understanding banking and the interaction of the financial system, the importance of the financial system, the regulatory regime or framework that the Fed has now started in the crisis when I was there, particularly with the stress test. I was there for the first stress test. And the stress tests are actually, I think, an excellent tool, because they're a forward-looking view of, given individual portfolios of banks, how they might perform in different risk scenarios. And the impetus for that risk can be different. The most recent stress test focused on pandemic risk, and I think future ones will probably focus on others, such as cyber or climate or anything of that nature. But the impact of the financial statement is generally the same. It's either going to be an impact on asset values or an impact on operations of the company. And so those are then incorporated into the financials of the company, and you can actually test the resilience of the banking system, which I think worked really well. If you look at how the financial system came through the pandemic, I think that's a testament to the resilience of this framework.
Betsy, it's Julie here. I want to ask about the composition of these picks in terms of gender, in terms of ethnicity and color, because this is obviously notable that Lisa Cook could be the first Black woman to serve as Fed governor. We're talking about women potentially in that vice chair of supervision role and in the vice chair role. How important is it, as the Fed has emphasized now, to have a diverse board of governors in order to be setting policy?
It's always been really important to have diverse voices around the table, and I think these picks are notable for that reason. Not just in that they bring a different perspective, but also that future economists, future Fed governors, people who are maybe in high school now or just getting ready to go to college, will look at this and say, that's a possible career for me. And the economics profession in particular has been not very diverse for quite some time. As to the women, I think I was only the 7th woman to serve on the Fed board. But while I was there, we did at one point, the women outnumbered the men because there were 2 vacancies, and Janet Yellen and Sarah and I were there and outnumbering the 2 men. So I think it'll be really good for Fed deliberations, and it's a positive development.
And Betsy, I want to ask about kind of the environment on the monetary policy side of things that these new nominees, if confirmed, would be facing. Obviously, there's a lot of concern about inflation. And now that it's official from the White House, President Biden just releasing a statement saying that, quote, we're at a moment of historic economic progress. But again, probably also arguably a lot of peril because of the monetary situation we find ourselves in. What do you think is going to be the biggest issue? How could you see this kind of slate of nominees approaching the economic kind of recovery, the uniqueness of it that we're facing now?
Well, the good thing is all of them are trained economists, and all of them have worked in the Fed system before. I think the 2 governor nominees have both worked in Federal Reserve banks. Sarah, of course, has been at the Fed before, and she has an undergraduate degree in economics. So it's really about watching the development of the economy, looking at how it might develop in the future. The staff at the Fed is an incredible strength. You have some really brilliant minds there who are helping the governors to shape policy and to think about it. But in addition to that, it really requires some real world experience. So in terms of bringing diversity to the Fed, I was not an economist, I was a banker. And some of the best insights I got were from people who were just really on Main Street telling me what they saw.
Right. And even Jay Powell himself, not a PhD economist, but a lot of color to kind of digest there. But Betsy Duke, former chair of Wells Fargo and former Fed governor, helping us break down that news. Thanks again for stopping by Yahoo Finance this morning. Coming up on the other side of this break, Elon Musk says Tesla merch can be bought using Dogecoin. That's apparently sent the price of the cryptocurrency sharply higher this morning. We'll have more on that and other top movers on the other side of this quick break.
Welcome back to Yahoo Finance Live. I want to bring you some other movers that we are watching this morning, besides, of course, the big banks. Got to talk about Tesla here for a moment on two fronts. Let's start with the Cybertruck, shall we? Because the company apparently has pushed back production of the Cybertruck to the first quarter of 2023. This is according to a report by Reuters. The Cybertruck is already something of a punchline, Brian Sozzi, because when it was introduced, let's say there were some problems with even the demo version of the thing. And we're seeing a lot of other truck makers come out and actually produce electric trucks. So this is maybe another speed bump for Tesla.
No, I saw what you did there, Julie. No, I'm actually starting to think that maybe the Cybertruck just doesn't even come to market. And we just saw a couple prototypes created by Tesla and Elon Musk to drive excitement around the company's car portfolio, which clearly they do a heck of a lot better getting cars out the gate than these large trucks that are really shaped like giant squares or cubes going down the road. And if it does come to market, and when it does, should it come to market, what does it even look like? I think the team is over at Tesla still trying to get the design right to the point where they can make these trucks and actually make money off it. And now, as they're trying to figure this stuff out, you'll have Ford coming out here pumping out electric F-150s, all electric, at some point this year, and really starting to establish a marketplace.
Yeah, and you have Rivian making trucks. Yeah, they're making fewer than they had initially hoped to, but they're actually making and selling them. So that's 2 in the column versus Tesla with 9. Of course, something that Tesla's Elon Musk is very good at producing is tweets. And he produced another winner last night where he said that the company would be accepting Dogecoin for its merchandise, not the cars itself, I don't believe, but just like gear, swag around Tesla, right? Now, this is something the company had teased before, but I guess it's actually doing it now. And so we're seeing a bump in prices of Doge on that headline.
Well, I think you saw Elon Musk trying to flex to start off the year. We've seen a lot of weakness in cryptocurrencies the past month and a half. So it could be Elon trying to, I think, remind a lot of folks out there that he is a market mover in all things crypto, coming out here and tweeting what he did on Dogecoin reacting positively. But we were joking a little bit about this in our Slack channels, Julie, this morning. I'm over these tweets from Elon Musk. I just want him to focus on the Tesla business, trying to top really what was a strong 2021 for him. You have to give a tip of the hat to Elon Musk and what they achieved last year.
Yes, for sure. So we'll see if he gets the head down and gets that Cybertruck rolling. Let's talk about another one that we're watching, and this is one that has been perennially on our movers list as of late, not for the right reasons. I'm talking about Boston Beer. The company is now coming out again and revising its forecast, and it looks like it has to do with excess inventory of its truly hard seltzer. So we've already talked about how the various alcohol makers sort of failed to anticipate that maybe hard seltzer would be a fad, or at least the demand wouldn't be as large as anticipated. But Boston Beer just seems to still be struggling with this.
This is brutal. And you're seeing the price targets come out here on the street. Deutsche Bank with a very sharp take on Boston Beer after this release, essentially saying that the stock is still going to be in the penalty box. A lot of investor disappointment on Boston Beer, and as they should have. Boston Beer coming out here saying our earnings projected for last year will be between a loss of $1 to income of $1. Previously, they were looking for income of $2 to $6 a share. So that is a massive whiff, and I think really underscores how much Boston Beer overestimated demand of Truly hard seltzer. And then secondarily, how many cases of Truly are just sitting in bar back rooms and convenience stores collecting dust and essentially going flat. Keep in mind, Boston Beer had to take a write down on hard seltzer last quarter here. Looks like those problems are continuing.
Yes, they are. All right, we're going to take the opening bell on this Friday morning. Another SPAC ETF there coming to market. SPACs, appropriately enough, is the ticker on that one. Who knows? Maybe we'll have another big year for SPACs. We'll see. And another mover that we wanted to check on, which is another one that we've talked about before that is still struggling, is Sherwin-Williams and the paint business. The company reporting preliminary numbers for its fourth quarter that missed estimates. It comes out with the full quarter, by the way, just in a couple weeks on January 27th, but felt the need to come out ahead of that and announce these numbers. Preliminary net sales, $4.76 billion, just shy of estimates, but earnings per share really below estimates here, $1.35 is that preliminary number. 169 is what analysts had been estimating. And it seems like that this has to do with raw materials problems and labor problems for Sherwin-Williams.
Yeah, we don't recommend stocks here, Julie. We're not in that game here at Yahoo Finance, but I will make a recommendation. If you need paint for your house, buy it before February 1st, because Sherwin-Williams is pushing through a 12% price increase because of the inflation it is seeing. Now, I was on a analyst call this morning, or analyst/media call, because clearly I am now a member of the media, where they were talking about CEO John Marikis, labor shortages in the stores and in the plants continuing to impact this business. Shortages in key ingredients to make paint. So for those looking for the supply chain problems that have hammered corporate America the past year, if you're looking for that to end sometime this year, look at what Sherwin-Williams had to say, because clearly you are probably wrong on that assumption. Marikis also noting this too, which is a red flag to me as we kick off earnings season. The January started slowly for the business, which is very interesting, but I guess dovetails with them seeing labor shortages. You can't necessarily sell paint if you have no people in your stores to sell it.
At the same time, I thought it was interesting, and maybe you can tell us if he expanded on this in the call. He said demand was still strong. So again, this is yet another company that's putting all of the onus and all of the blame on what's happening in supply chain and not what's happening in the stores, that there are still people who want to buy that paint.
My sense coming off the call, Julie, is demand is a little bit less than strong. You want to say solid, good. Now, demand was strong. He was talking about back in October. When you hear a CEO come out and say, hey, our January started off slowly, you're not just worried about what Sherwin-Williams, what their first quarter might look like. You're worried about what a rival PPG Industries, they also make paint. How has their year started? How has Home Depot's year started? How has Lowe's year started? You have to start thinking about the whole supply chain if you're trading the sector.
Yeah, most definitely. We'll be watching those other paint makers too to see if they are feeling that pressure. Let's take it on over to Jared Blickery here, because speaking of pressure, we got the banks this morning, we got disappointing retail sales, we got the numbers we were just talking about. None of it equals green on your screen for the markets.
No, except for energy, and what a story that's been. But we'll get to the banks in a second here. Let me just pull up the Wi-Fi interactive so we can see what's going on inside the market. Energy, there's that green square, only up 1/3%. Not much of a move, but financials taking it on the chin to the downside, down 2%, led by JPMorgan off of that FIC and equities trading miss, followed by materials here and industrials and consumer discretionary. So the cyclicals and the value trade, except for energy, really flagging right now. So let's take a look at these. JPMorgan down 6%. And guess what? This is going to be its worst earnings reaction since 2011. Let's just put a 10-year chart on JPMorgan. Well, that's kind of impressive there. But you take a look at what's happened over the last year. Really a lot of choppy sideways action for what is now the biggest credit card issuer in the world. And let's take a look at Citigroup, also down after its earnings announcements. It's relatively flat, down 5% over the trailing year. Finally, Wells Fargo has been the outperformer recently. It broke out of its trading range and has been hitting multi-year highs. Let's get a max chart and see where that compares. Yeah, they're reaching their 2015, 2016 highs. So we'll have to see if anything comes of that today, getting pretty close. The travel sector was in the green yesterday, but not today. I'm not sure if it's Omicron fears or just general market weakness, but I think yesterday it was clear that it was really all about the inflation numbers. And today, a lot of focus on the retail sales numbers. This is at home builders. I was looking for China stocks, another patch of green, but those retail sales numbers didn't really move the market as soon as they came out, but there is going to be a lot of focus on them today. The Citi Economic Surprise Index has been turning down. So the economic data has not been coming in quite as strong. Those inflation numbers, yes, but those are not good when they're high. And then we had Bank of America's Michael Hartnett come out this morning. He is rather bearish on earnings, especially this year. He says they were up 40% last summer, going to be maybe 5% this summer. And going into the second half of the year, they could turn negative. So he sees, and I'm going to go to a chart of the S&P 500 now. He sees 44,000 in the S&P 500 before 5,000. You can see where the current price is. The high in the S&P 500 was on the first day of the year, this is a one-year chart here, is 4,800 and change. If we go back down to 4,000, that's going to be somewhere down here, I think. That's a 17% decline. So just watch out watch out below there. It could be kind of a rocky year, at least according to the way analysts are interpreting things right now, guys.
Yeah, I mean, he's certainly not the only strategist to have said we could see a correction at some point. But to sort of put it in those stark terms and to talk about the depth of that correction we could see, that sort of hits different, doesn't it? All right, Jared Blickery, thank you so much. Appreciate it. We're going to take a quick break. When we come back, we're going to be checking with iCapital Network Chief Investment Strategist Anastasia Amoroso about where she's seeing in these markets and where she is finding opportunity for 2022.
Lots to digest in the markets today, from mixed bank earnings to a whiff on retail sales. So what's the next best trade you should be making in this environment? Anastasia Amoroso, iCapital Network Chief Investment Strategist, is here with us now. Good to see you as always. So look, bank earnings mixed at best, retail sales not so hot. Even Sherwin-Williams, you were just talking about, Anastasia, and earnings warnings from them this morning. Now you're looking for a 10% return on the S&P 500 this year, but do you have to dial back what you're thinking in light of reports like this?
Yeah, you really do have to. And I think, Brian, that's really the story as we head into this year, is we're in this adjustment process, which might be a little bit patchy. We're adjusting from the economy that was very, very strong, a very strong reopening momentum, and you had the Fed that was doing nothing. The Fed was just sitting back, and this is clearly changing. We now have an economy that's normalizing, and you really see that across the board, whether it's the bank earnings we saw this morning, whether it's the retail sector, whether it's the industrials and some of the PMI and ISM numbers. We're seeing this step down lower in activity and normalization of activity, still solid, but it's just slower. And now the Fed is actually starting to do something about it. So that's what's causing some of this volatility here. And this might be a process. This might be a period of adjustment that goes on for some time. And Brian, if you look at the numbers, what typically happens for the markets during this transition process, it's exactly that. The volatility, the choppiness persists. For example, we looked at the 3 months before the rate hike, and the 3 months after the first rate hike over the last 3 or 4 rate hiking cycles. And we find that within that bracket of 6 months, the markets kind of do nothing. There's just a lot of choppiness back and forth. But if you look at the 12 months after the rate hike, you do tend to have positive average returns. But to your point, and to the point that we wrote in our outlook about, is those returns are not double digits. They're somewhere in the 6 to 10% range. And that's really our expectation for this year as well.
But just staying on that too, I think so many concerns in the market are over the Federal Reserve. Oh, they're going to lift rates 3 times this year. Maybe it's 4, maybe it's 5, who knows? But should more concern actually be placed on the pandemic? Because when I see Sherwin-Williams come out here talking about ongoing supply chain shortages, lifting prices by 12%, really the pandemic continues to hammer corporate America.
It really does. I mean, we're certainly not out of the woods yet. And I'm very hopeful, as I think are a lot of us, that we're going to move out of this pandemic stage to the endemic stage at some point this year. We have to, as we talk about normalization, I think we have to normalize COVID here as well. But until we do, we're going to continue to have these disruptions. I mean, you go to certain places and you go to certain hotels and restaurants are closed because there's not enough workers to actually keep the restaurants open. So we're seeing the supply chain challenges all over the place. And until we normalize the treatment of COVID, given all the medical tools that we have, unfortunately, that too is going to continue to weigh on activity.
Anastasia, given all of these hurdles that we're talking about and all this tension, all this volatility, you have some interesting ideas in your latest note for what you say is hypergrowth, which I think gets people excited. Everyone would like to see some hypergrowth in their portfolios. And the first idea that you have is venture capital, which I think is quite interesting here because obviously we're coming off of a pretty big year for exits from venture capital and early stage stuff that was then maturing and coming to market. What's the best way for everyday people to get into and invest in venture capital?
Well, this is definitely a space that's been reserved for institutional investors. Endowments, foundations have invested, and also family offices have invested pretty heavily. But the access to some of these vehicles, VCs, is broadening into a more and more, wealth management community and clients. So to your point, Julie, about this has been a banner year last year for venture capital because so many of these VC companies were able to tap the public markets. So the concern now maybe is like, well, does that slow down? And we're not going to see the same exit opportunities. And I don't have that concern because if you look at VC exits, the IPO market is one of those exit paths, but the other one is all the M&A that's occurring. And actually, typically, the M&A market, the strategic acquisitions of some of these smaller VC-backed companies, that's a bigger avenue for exits. And so when I come back to the corporate America, and when I look at the earnings growth rate, despite some of the disappointments this morning, that's still at record levels, and it's still 25% above the pandemic, and you still have $7 trillion of cash on the balance sheets, I think these companies are going to be redeploying that cash, and they want to invest in those hyper growth opportunities as well. So I think the exit environment for venture capital backed companies is going to remain still quite strong. And not to mention, Julie, that you have $1.4 trillion in dry powder for private equity firms. And private equity firms might be looking to take a company and bolt on another company to it. And that's how you come up with a better enterprise. So I think you still have a lot of tailwinds. And again, the access to VCs, VC funds, and VC access is definitely expanding.
And of course, you got some publicly traded private equity companies now. You got a new one yesterday in TPG. I also want to ask about one of your other ideas, which is crypto, DeFi, et cetera. And I think this year showed that people are definitely interested in this area. But I think there are also, there too, I would ask a similar question. There are sort of more opportunities to invest in this space than ever before. Not so much it's not as difficult to get into, but how do people decide in which thing to invest when they're looking at crypto?
Yeah, Julie, I think a lot of people are asking that question. And frankly, it's a struggle because if you've kind of missed the run at Bitcoin and now maybe you're unsure what's next for Bitcoin, where else do you go to? And I would just point to 3 opportunities that I would say they're longer opportunities. They may not necessarily pan out this year, but I think we should start looking at them this year. And the first one is just the use of things like automated market makers and automated lending, and where can you potentially take out the intermediary and let this peer-to-peer network of computers based on blockchain do the work. So those are the types of applications and cryptocurrencies that we're looking at. That's one category. The second category is smart contracts. If you talk to a lot of CTOs and tech officers within corporations, they're very much focused on automating some of these transactions that typically were labor intensive and paper intensive, and blockchain and smart contracts that are pre-programmed software, they have a big role to play in that. And the last big trend, and by the way, the venture capital community is very much interested in this, is this concept of Web 3.0. So this is decentralized applications, for example, decentralized social media, decentralized metaverse, and this notion that rather than letting somebody else own your data, we own our data and we're able to sell it in parcels or allocate it in parcels as we see fit. So those are the three very exciting ideas in crypto right now that obviously extend well beyond Bitcoin, and some of them are available as cryptocurrencies, but more and more of these are available as VC-backed companies that are being built as we speak.
I think most of us still trying to figure out how to use Web 2.0. It's just a true story there. Anastasia Amoroso, iCapital Network Chief Investment Strategist. Always good to see you. Have a great weekend. All right, speaking of earnings and figuring things out, here's your Yahoo Finance stat of the day, people. Fourth quarter earnings were seen rising a solid 20%, but oddly, analyst estimates for the fourth quarter stayed relatively unchanged for 6 months, according to Bloomberg data. This is a departure from the past 4 quarters, says Bloomberg, when analysts lifted their profit forecasts heading into each reporting period by an average of $4 a share. All right, up next, we'll talk to the head of high-yield credit strategy at BofA Global Research about what to expect in 2022 from credit markets. Stick around.
Well, with interest rates so low, corporations issued an awful lot of debt in 2021, particularly in the high yield sector. While that issuance may slow in 2022, still could be a popular area for investors. Let's talk more about the outlook for high yield with Oleg Milentyev. He is Bank of America Global Research Head of High Yield Credit Strategy. Oleg, thank you for being here. I want to start, I think, with what the big issue is in the minds of investors across asset classes, and that is rates going up. What are the particular implications for high yield of the outlook that the Fed is going to be changing the balance sheet and raising rates?
Yeah, so high yield, I guess there are two things to know about this asset class. First and foremost, the number one risk for investors is credit risk. And the good news is usually these two things are going in the opposite direction, meaning you have either credit risk going higher or interest rate risk. And so right now, of course, is the time to be more concerned about interest rate risk, which happens to be a secondary consideration for high yield investors, again, just because the exposure to that risk is lower. Having said that, it is a risk. We have seen Fed pivoting essentially 180 degrees in the last couple of months, and this is certainly something on investors' minds today.
Well, like we have a lot of traders on our platform that aren't too familiar with credit markets or don't follow it as closely as you. Are you seeing anything in credit markets that may blow back onto the portfolios of equity investors soon?
So yes, so there is a connection between these two markets. They're not perfectly correlated, and in fact, much of the time they could be going their own ways based on their own technicals and fundamentals. But if you see extreme pressure in a corner of a credit market, equity investors would generally know about it. Such extreme pressures don't happen often by definition, and this is not something we necessarily expect to happen in 2022. So with the risk of rising rates in mind and potential spillover into credit and to some extent into high yield, this is not something that we expect to derail the high yield market, but still have some effect on it.
And in your most recent note, Oleg, you looked at the particular sectors where maybe we have seen some capital misallocation because of the loose financial conditions, because of the ample liquidity out there. Talk to us about some of the areas that may be most at risk in this environment.
Sure. Yeah, so this is something we do frequently. We just like this approach of essentially following the money, right? We don't always know sort of the ultimate resolution to some of the macroeconomic trends, but following the money is a simple approach that helps us understand where potential excesses might be building. And so we've done this, as you mentioned, just in this latest note, and we've identified three sectors where the increase in debt, increase in leverage has been most significant. Those include transportation, automotive, and utilities. And if you think, just kind of take a step forward from here and just think what is a common denominator across these sectors. One is they all COVID exposed. So to some extent, you may say, look, this is not necessarily the normal capital raisings that took place here. It's in reaction to COVID. These companies have been rebuilding their balance sheets. Maybe the other common denominator across them is they happen to be more of a focus for ESG investors, just because infrastructure is a big part of those flows and portfolios. And so maybe to some extent, we're beginning to see over allocation of capital as a function of popularity of ESG mandates.
And so what then are the implications for those particular areas? Are there higher default risks then? Is that what, yes?
Well, I think first and foremost, you want to be aware of what those flows are, and you want to be sort of cognizant of potential for, let's say, overcapacity building in these sectors. Once you have overcapacity, it's more difficult to maintain profitability. Once you have that, margins come under pressure, And essentially, it all goes down to the quality of balance sheet and the quality of the income statement. So I would not necessarily jump immediately from, seeing significant inflow of capital to higher default risk, but it certainly puts you in a corner of the market where you just spend a little more time analyzing the sector and watching some of the other metrics.
Right, and also suggests, what we already know, that a lot of the companies, particularly when you talk about transportation, there's a lot of stress in that area right now. Oleg, thank you for being here. Oleg Milentiev is the Bank of America Global Research Head of High Yield Credit Strategy. Thank you. We're going to take a break. When we come back, the Supreme Court has blocked President Biden's vaccine mandate for large employers. We'll have more on the implications for big business next. Yesterday, the Biden administration mandate that big businesses get their employees vaccinated was dealt a blow by the Supreme Court, although the healthcare industry has a mandate that stays in place under this ruling. Our Alexis Keenan has been tracking all of this for us. So, Alexis, interesting ruling here, and this sort of split ruling, if you will, given the different industries.
Yeah, this is really a apples and oranges result here. And some companies sticking to their own employee vaccination requirements already, others relieved that they don't have to follow this guidance and worrying that they would lose too much staff here if they did have to implement something like this. So just to recap, the Supreme Court blocking the Biden administration's large employer mandate that was supposed to apply to 84 million US workers, that would have imposed fines on private companies that have 100 or more employees unless their employees were either fully vaccinated or tested weekly for the virus and remained masked at work. On the other hand, the Supreme Court went ahead and allowed the Biden administration's healthcare mandate that applies to 10.4 million U.S. workers. And that one imposes fines on healthcare facilities that receive federal funds unless all of their employees are vaccinated. That one does have a exemption available for religious and medical reasons if employees do not choose to get vaccinated under those circumstances. So what should these private employers now do is the question. In a majority of jurisdictions, this ruling doesn't prevent employers from adopting their own vaccination requirements. Though in some states and localities, laws say otherwise. The National Academy for State Health Policy is tracking some of this, and you can see it there on your screen. You have Montana and Tennessee as these states that have banned private employers from requiring vaccination. And then there you have some other states, many more others, requiring those exemptions, allowing for religious and also medical exemptions. So I've been talking to employment and labor law experts in the heels of this decision here. And they tell me that, look, OSHA's general rules still obligate employers to provide a safe workplace. So companies should be watching for not just existing federal, state, and local laws now all combined, but also for any new legal guidance that is coming out of this decision and changes that are afoot. So the White House here could revise this large employer mandate, and they could try to bring it in line with what the Supreme Court is saying it might accept, which is a much more narrowly tailored version of this rule. So we're waiting to see how companies are going to react to this change. You have the Wall Street Journal saying that, look at airlines, Tyson, Disney, Starbucks, Raytheon, just to name a few, all already having their own vaccination mandates. You also had JPMorgan saying that in-office employees would be fired by the end of today if they don't receive the vaccination, also reporting 99% compliance there. So a handful of others were watching, looking to see what these big employers are going to do on the heels of this very controversial sometimes and important decision.
Yeah, will be very interesting to see how it all plays out. Thanks so much, Alexis. Appreciate it. Well, coming up in the next hour, we're going to continue to bring you highlights from bank earnings and some very interesting comments coming out of the conference calls, including some from Jamie Dimon of JPMorgan. We're going to get reaction as well from Hennessy's David Ellison in just a moment. Also, Snowflake CEO Frank Slootman joins us to discuss his new book, Amp It Up, on leading effectively. That's all coming up in the next hour.
we just need you.
Happy Friday, y'all. Welcome back to Yahoo Finance Live. I'm Brian Sazi alongside the one and only Julie Hyman. It is bank earnings day in America, and here's how the markets are responding to some mixed results out of JPMorgan, Wells Fargo, and Citigroup, and even BlackRock. Seeing some mixed action here. The Dow in the red, down about 143 points. The S&P 500 in the red, but look at the Nasdaq ticking higher despite some of these mixed results out of the bank, seeing the 10-year yield hover around 1.75%. Traders also digesting a much worse than expected December retail sales report, with headline sales dropping 1.9% versus a consensus decline of 0.1%. Now, here are a few other things we are watching for you right now. Out of gas, we are keeping a close eye on Ford a day after the auto giant's market cap broke through $100 billion. This morning, RBC analyst Joseph Spack downgraded the stock on valuation concerns. Meanwhile, Morgan Stanley's analyst Adam Jonas is out with a note of his own predicting Ford stock will plunge 52% to $12 a share. No fizz. Sam Adams and Truly owner Boston Beer is getting slammed after yet another big profit warning. Boston Beer says customers are just not buying as much hard seltzer as they thought. And dropping the hammer, Snowflake CEO Frank Slootman stops by to discuss his new book, which advocates declaring war on rivals and not accepting slackers in the office. Good shout out there by Frank Slootman. Well, let's get right up for Yahoo Finance's Brian Chung, who's been on the earnings calls from JPMorgan, Citigroup, and Wells Fargo. Brian, have to start with JPMorgan CEO Jamie Dimon. Really interesting comments from him just crossing the wires on interest rates.
Yeah, between now and when I was last on the show about 5 seconds ago, I did hop on the JPMorgan Chase earnings call where we are continuing to hear from Jamie Dimon, the CEO, with regards to the earnings release that we had gotten. You can see shares of JPMorgan Chase down about 5%. That's what the street would call a yikes. And that might be because of the impact of higher interest rates on their business, even right now, before the Fed has even done anything on the interest rate front. Fixed income is a place where you already saw that impact. $3.3 billion fell short of the street's estimates of $3.4 billion in terms of revenue from that fixed income currencies and commodities line of business. And Jeremy Barnum, the CFO, was saying that as the monetary policy environment evolves next year, they see that creating more tailwinds for that business. So we could see further declines in that business in the future. And when you compare that to what Jamie Dimon said immediately after his CFO's remarks, he said, actually, he expects even more rate increases than the forward implied curve is showing, which is about 3 is the expectation, 3 25 basis point rate hikes this year. Jamie Dimon saying he could see it being 6 or 7. So when you kind of compare these comments together, this shows that at least on the markets front, that normalized rate environment could provide a little bit more headwind to their businesses. And by the way, it's not just JPMorgan Chase that's experiencing that. I hopped on the media call with Citigroup, where CFO Mark Mason was saying very similar things with regards to a challenging trading environment, is how he described it in fixed income. He said that he expects fixed income revenues to be worse than 2020, however, maybe just a smidge better than 2019 for what's worth. Citigroup shares down almost 3% in the first hour of trading, at least so far, guys.
7 rate hikes, Brian. You and I better go out there and buy our mansions real quick. All right, we'll check back with you in about 3 seconds. Brian Chung, thanks so much. All right, with the first round of bank earnings out, what is your first trade? David Ellison is a portfolio manager at the Hennessy Large Cap Financial Fund. David, happy Friday to you here. So you just heard what we talked about, Jamie Dimon putting forward potentially 7 interest rate hikes this year. As someone who is invested in the financial space, does that make you more optimistic on bank stocks or less?
Well, I think, 7 rate hikes would be what? This is not the Paul Volcker era. It'd be what, almost 2%. So assuming it's a 25 basis points each. But I think if it's that much, then, the market's going to have a lot of trouble across the board just because the last time we did this, it got beat up. So, we broke open the piñata today on earnings, and the operative word is in line. And I think that's why the stocks are trading down. There's no surprises. There's nothing special under the Christmas tree. The business is good. Credit's great. Loan demand is okay. Maybe a little better. Deposit flows are still good. They're making tons of money. But there's nothing super exciting. We've had a good run in the space. And so now the question is, why do you own them? Well, you own them because they're safer than a lot of these other companies trading at, 10 times revenues, So, I can buy banks at, 11, 12 times earnings, and the rest of the market can buy companies at 10 and 12 times revenues. I'd rather be at 10 or 12 times earnings.
You also,
David,
you want to,
oh,
go ahead, Julie, go ahead.
Go ahead, Saz, go ahead.
Yeah, no, I was wanting to follow up, and there was some weakness in some of these reports, David, notably fixed income revenues, trading revenues, and the stocks, I think, are trading down on those results. But does that make the case for you to add more to your Apple position, which you also own?
Well, I think, the first comment is that, the Wall Street income, as I call it, it's wonderful for the brokers and it, pays them a nice bonus, but it's a low PE business, and it always has been, at least in my 40 years of work in this business. So if we're going to focus on bond trading, we might as well own a hedge fund. This business is about credit, it's about spreads, it's about expenses, it's about planning for the future to compete against, the Apples and the Blocks and the PayPals and whoever else decides to come along and go public with a fancy ticker symbol. So I think that's the story of the future of these companies. And I think, like, for example, JPMorgan today, they said, well, expenses are going to be higher. And that's what's driving a lot of the concern about the company, not, in a big way, but in terms of why the stock is down today. It's not some of the other fundamentals. And hopefully they're making good investments in the future, and that will bear fruit longer term. You see Citigroup divesting businesses, which hopefully will benefit them in the long term. Wells Fargo still trying to get out of the penalty box, and that's a self-help story. So I think from that perspective, there's a lot of good things to see here. The bad news is stocks have had a great run. Now, when it comes to Apple and the other fintech stuff, the valuation, Apple's not a valuation problem, but a lot of these other guys are. And so the question is, if the market, sort of lives on earnings, valuation, and conviction, the banks have earnings, they have valuation to hold it up. But the question is, a lot of these other stocks, people are losing their conviction, and that's going to create a correction. And we've seen a significant correction in these fintech financials across all of the other, including all of the other, technology names that are out there that I can't, even begin to understand. But so there's a lot of damage going on out there, which I think is healthy for the market overall, especially if you're looking at a fund manager who cares about valuation and price, which has sort of been my story for, many years. I buy value. And so it's not been a value trade, and maybe we'll get that going forward.
And maybe it'll be nudged along by the increases in interest rates. David, I got to come back to that JPMorgan, to that Jamie Dimon comment. 6 or 7 interest rate increases this year. What is he talking about? Like, does that headline not make you scratch your head a little bit?
To be completely honest, I know it's a Friday and maybe people won't listen, but here's a guy that everybody knows. In the financial business. He's been around a long time. He's roughly my age. He's made a ton of money, runs a great company. He says stuff like this, which to me, on the margin, is irresponsible. Why are you creating a situation where you're telling the market, well, we could be 8 rate increases? That tells everybody, the market could be a disaster if rates go up 8 times. And look what happened in 2018. They raised a little bit and then completely reversed because the market croaked. So I don't understand why he's doing this when he knows that everybody's listening. Very few people are going to listen to me. And I'm saying that's an irresponsible comment, but nobody's going to care. But I think if I was him, he'd be like, you got to take it back a little bit. Let's not go crazy with this stuff. Maybe you believe that, but sometimes it's important you're running a big company that people are listening to. You got to be a little careful about what you say.
David, is there anything that you see in the data out there right now that would suggest there's room for that many rate hikes this year?
Well, I think part of the problem with the market is rates. Part of the problem with the stock market is rates are too low and there's no alternative. So this sort of, I say the market's got a name, and it's Tina FOMO. And the problem is that if you sell your Apple stock or you sell your JPMorgan, you end up going into a money market fund at Fidelity or Vanguard or BlackRock that yields 1 basis point. That's your alternative. And if your alternative is 1 basis point, or if you buy the 6-month T-bill, it's 25 bips, that's not an alternative. So that keeps the market where it is, and it keeps it relatively high relative to history. And to take rates up that much, like he's suggesting, how far is the market going to have to fall? If you drive the 10-year to 4 or 5%, I'm not suggesting that's going to happen, but let's make that as an assumption. How many people are going to sell the market and buy the 5-year, 10-year? A ton of people. Trillions of dollars are going to flow into a 5% 10-year. And it's going to come out of the market where all these companies, you got tons of companies that aren't making money, trading at multiples of revenue that the banks are trading on earnings. So you've seen the data where you've got, a record number of companies that are trading north of 10 times revenues in the S&P. Okay, all that money is going to come out and flow into higher bond yields. So, that's the issue, is that you've got to prick the balloon slowly. But again, I don't think the Fed is going to take the market down because they think inflation is too high. I just don't think they're going to do that. The market, in a sense, to me, 2008 was the bonds, it was mortgages, it created a real recession and created real job loss. And now the market is the new, bond market. The market is the new sort of CMBS, RMBS, no doc liar loan. That's what the market. You take the market down 20%, the economy is going to have a serious recession because there's going to be massive wealth loss, and people are going to get scared.
Well, David, I do like that Tina FOMO reference. I made a note to use that for myself more often moving forward. David Ellison, portfolio manager at Hennessy Large Cap Financial Fund. Good to see you. Have a good weekend. All right, coming up, Snowflake CEO Frank Slootman joins us to discuss his new book, The State of the Cloud Industry, and much, much more. Stick around. Snowflake CEO Frank Slootman came to the U.S. from the Netherlands in 1984 with $100 or so in his pocket. Some 38 years later, Slootman is credited with the host of big software deals, selling data domain to AMC in 2009, taking ServiceNow public in 2012, and bringing Snowflake to the public markets in late 2020. Now Slootman is sharing his blueprint for success in his new book, Amp It Up, leading for hypergrowth by raising expectations, increasing urgency, and elevating intensity. Frank Slootman is here with us now. Frank, if there ever was a title tailor-made for me, this was it. So I really enjoyed the book, and thank you for coming on here. Look, CEOs have a lot on their plate right now, trying to find workers, trying to just keep the culture intact during the pandemic. What message do you have for them as they try to navigate this environment?
Yeah, well, the reason that we wrote the book is that, as you pointed out, we've had 3 successful companies over the last 20 years, and we have this flood of incoming requests for what do you guys do? What's the secret sauce? What's the playbook? So this is really our attempt to create as much insight from our perspective, as to, okay, look, this is how we think, this is how we, how we do things, and hope you like it. Try it out for size and see if it fits, and we'll go from there. But the message is for CEOs, and that's the title of the book, Amp It Up. There's incredible room. There's a lot of slack in organization to step up the energy, step up the intensity, step up the pace, raise your standards on everything, and it sort of unleashes that X factor in an organization where everything goes faster and quicker and better. And we sort of lose that feeling of swimming in glue and moving like molasses. So it's right underneath. It's right in front of you, but you sort of need to tap into it very deliberately.
Frank, I cover a lot of companies here, and my sense has been over the past year or so of the pandemic, a lot of them are just settling. They're settling for okay. It's okay just to have a warm body in the seat, as long as that warm body is there. But should a manager in this environment use this opportunity to just rid themselves of slackers and just start rebuilding the companies from the ground floor to come out of the other side of the pandemic?
Well, you should always be doing that, right? I mean, raise the standards, drive the intensity and the pace, have high standards all the time. It's a not now type of issue. It's an always type of issue, right? I mean, leaders are going to set the pace, right? Leaders are going to set the standards. And it's really important if you want to attract and retain talent that you have an environment that is highly energized, unpolitical, apolitical, all these kinds of things. Otherwise, you just can't hang on to people. People don't want to be in companies where they're surrounded by mediocrity and slowness and politics and difficulty. So it's in your interest to do this all the time, every time.
Hey, Frank, it's Julie here. I'll take the other side of that. How does humanity fit into this picture? In other words, we're coming through a year where maybe, to Brian Sazi's point, companies are settling to some degree, but we're also coming through a couple of years where people are exhausted by the external factors that are out there. So how do you balance that with demanding that top performance from people?
Yeah, people do get exhausted when you work in companies where everything is difficult and hard and political and slow and uninspiring, I would say, because we're just not aiming for anything great. That's what makes people tired and exhausted and looking for for other pastures. So you keep the energy up, you keep the pace up, people are going to have a much better time at work. Now, is that for everybody? Maybe not, right? But culture sorts, right? It sorts people in terms of the people that like it and people that are like, well, this is really not my cup of tea. I mean, we're not really declaring here it's sort of one size fits everybody. But when you're in a high growth and environment, yeah, it is a very energized, high pressure undertaking. There's no getting away from that. We do mitigate that a lot. At Snowflake, we make sure, because people have twice as many meetings a day as they used to have because of Zoom. So we're very aware and dialed into the fact that fatigue sets in, and we always tack on extra days to holidays between Christmas and New Year's. The whole company around the world got the whole week off. So we were trying to create these hiatuses to allow people to sort of recharge and recuperate a little bit. So I mean, your point's very valid, but at the same time, high growth companies, I mean, it is a pressure cooker.
Frank, you talk about in the book how, as a teenager, you were cleaning toilets and you rose the ranks to where you sit today. As you look at the next generation of leaders in corporate America, Do you think they still have that drive and that hustle?
I actually think they do. Just a couple of weeks ago, I was at a retreat for founders and CEOs that was hosted by one of our investors, and I saw 70, 80 founders, CEO people. They were pretty much half my age, which is another revelation. But I was there for 2 days and numerous conversations, with these guys and gals. And it just sort of left me completely rejuvenated that these people aren't the same. There's nothing different. I mean, we put labels on them in terms of generation this and generation that. They're not different, from the generations that went before them. As best as I can tell, they care about the same things. They have the same preoccupations. So I sort of walked away from that thinking we're going to be all right.
Frank, tapping into your, let's just say your veteran standing in the industry, we've seen a real sell-off in these software stocks on interest rate concerns. And someone that has seen a lot of cycles in software, are you seeing anything in your business that would warrant these types of sell-offs we're seeing in software?
No, not at all. As you guys well know, I mean, the stock market short-term is a voting machine, and obviously that creates opportunities for people to get in at a reasonable price. Over the long haul, the stock market always gets it right. So that's what you worry about. The short-term preoccupation is not helpful. I always tell our employees, look, the only stock price that matters is the one you sell it. Everything else is entertainment.
Point well taken. Really enjoyed the book. Snowflake CEO Frank Slootman. We'll check back with you soon. Have a great rest of the week. All right, we'll be right back. Energy drink Monster Beverage is entering the beer industry via a splashy acquisition. Julie is back with the details next on that and a rundown of some headlines you need to know. Stick around.
Social media companies are the latest to be subpoenaed by the House Select Committee that's investigating the January 6th, 2021 riot. Meta, Alphabet, Twitter, and Reddit provided inadequate responses to requests for documents issued back in June, the committee said. The records requested related to domestic terrorism, the spread of misinformation, and efforts to influence the 2020 election. One of the largest student loan providers, Navient, has agreed to cancel $1.7 billion worth of debt after reaching a deal with 40 state attorneys general. The settlement ends lawsuits into Navient practices dating back to 2009, when the company was known as Sallie Mae. The company will make a one-time payment of approximately $145 million to those states and also pay $95 million to roughly 350,000 federal loan borrowers who were in default. And energy drink maker Monster Beverage is getting into the alcohol market, buying the owner of Cigar City, Oscar Blues, and Deep Ellum, among other brands. Monster agreed to purchase Canarchy Craft Brewery Collective for $330 million in an all-cash deal. That deal won't include Canarchy's restaurants. It's expected to close in the first quarter of this year. Monster becomes the latest beverage company to marry soft and alcoholic drinks. A couple of other examples. Constellation last week said it would launch a boozy Fresca alongside Coke, and Pepsi is introducing an alcoholic Mountain Dew alongside Boston Beer. Coming up, one Wall Street analyst taking aim at that red-hot stock price of Ford, which has been on quite a run until today. We'll have more on this next. Well, stodgy old Ford has been on quite a run thus far in 2022. It pushed its valuation above $100 billion, but that didn't last long. Brian Sozzi, there's one prominent auto analyst who's taken aim at the company.
Yeah, the bears are starting to swirl. Julie, my day started off with reading a very lengthy note out of the always market moving Adam Jonas over at Morgan Stanley, coming out reiterating an underweight rating on Ford, which is essentially the equivalent of sell, with a $12 price target. I actually clicked out of the document and opened it again to make sure I wasn't seeing things. $12 a share is basically predicting that Ford stock could fall 52%. Now, Jonas outlining a couple of concerns here, which are totally understandable, but the stock is not really moving here on this. And then also another downgrade out of RBC auto analyst Joseph Spack today. So we're seeing dueling bear notes here, which I think underscores the enthusiasm in Ford's outlook this year that the stock's going to be moving when two prominent analysts come out here negative. But nonetheless, Jonas noting that as auto production picks back up, you could start to see some price declines on automobiles. Now, keep in mind, auto sales have been very strong in large part because automakers have been able to push through price increases during the pandemic. Jonas argues that will start to shift as more cars come into the market, as those chip supply shortages start to abate. Next up, at $25 a share or so, Jonas argues that it's going to be difficult for Ford to beat analyst estimates now on how many electric vehicles it sells. Point well taken. And then Jonas also notes that there's more competition coming in this space, and he's right to highlight that. You still have Tesla out there in a leadership position in EVs. You have Rivian. Maybe they'll be able to make more than 100 trucks this year. We'll wait and see on that. But again, a very bearish take by Jonas over at Morgan Stanley, and another bearish valuation concern downgrade by Joseph Spack over at RBC.
I find the argument that the prices on cars are going to come down interesting because, to your point, one would think they're going to make up for it with volume, right? People aren't buying cars right now because they can't get them, or if they can get them, they're finding them too expensive. So if prices come down and there are more cars in the lot, you would think that would be positive overall.
I would push back a little bit on what Jonas mentions on the price declines in autos. Under Ford's new CEO, Jim Farley, they have employed a strategy of putting fewer cars on dealer lots. So his take really has been over the past year and a half that historically Ford has just put too many cars on dealer lots. That has forced them to offer more incentives. The prices decline, and that ultimately hits Ford's profits. I think what Jonas may be just discounting here is the fact that Ford under Farley is just operating a lot differently. They're going to put less cars on lots. It's going to try to keep prices high, and we'll see what happens.
Yes, we will. All right, let's take a check on what's happening in the markets right now. We've got a mixed picture. We did have a mixed picture when I looked, 2 seconds ago. Now we're negative across the board once again. Dow is leading declines. It's off by 0.7% as we see that weakness in the banks that is quite notable in today's session on the back of earnings. That bank group is down by more than 1%. We'll be right back. $18 billion in pilfered cryptocurrency last year. That's according to research firm Chainalysis. But if you put that number in perspective, it accounts for a very small percentage of overall crypto trading. Let's get some more perspective now from Chainalysis Director of Research, Kim Grauer. Our David Hollerith, who covers crypto, is with us as well. So Kim, first of all, how do you figure this out? I'm curious. And how do you put that number in perspective for us?
It's really just the core business model of the company that I work for, Chainalysis, where we identify services, and many services are operating in the crypto space are illegal wallets, ransomware addresses, sanctioned entities, scam accounts, stolen funds, terrorist financing wallets. And so since that is the business of what we do, we identify those illicit wallets and the criminals that control them. We just have to look at the total value flowing in and out of those wallets. And then each year we take a moment and we say, what happened this year? Let's look at what changed throughout the year. And then we're able to actually identify how criminals adapted, which crime types grew, which ones fell, and then figure out why that is.
Yeah, and Kim, I think one area that I was sort of surprised about when I saw the report was just how low ransomware was compared to other types of crime like scams or theft or something like that. And could you sort of put ransomware in proportion to us? Because obviously it's a more threatening crime to most of the world, I would think. So.
Yeah, I think it's hard to directly compare the absolute values received by different crime types to each other and then draw meaningful comparisons. So scamming is in the billions and billions of dollars every single year. But and that's because a few scams can grow to be huge. We saw Plus Token a few years back was scammed multiple billions of dollars from millions of different people. And then ransomware, hundreds of millions of dollars received by ransomware funds. But the rate at which that's growing is what is really concerning. And on top of that, we know that there's a ransomware underreporting problem. So we know that we're just kind of scratching the surface of how much ransomware activity is actually happening. So there's other things to consider besides just the absolute value. You want to look at the number of criminals, the rate at which it's growing, the impact. So scamming, a lot of these scams are financial scams of people hoping to get 50% returns for life, whereas ransomware sometimes what we saw last year was the attacking of critical infrastructure in hospitals.
I also want to ask about who is perpetrating these scams, because you guys were also out with some data that North Korea is responsible for a decent chunk of it, $400 million worth of digital assets last year. So what does that tell us about who is perpetrating this stuff, and what are the implications of that for users?
Yeah, again, each crime type has a different ecosystem that's driving the trends, that has different bad actors. When it comes to hacking, which was one of the biggest in terms of growth, the biggest crime type to look out for, we know that there's a history of nation state activity behind hacking. And we know specifically North Korea in particular uses cryptocurrency hacks in order to generate large quantities of revenue for North Korea itself. But we also have other bad actors. We have organized criminal groups who doing professional money laundering. We have other types of nation state actors that are using ransomware, or we have criminal groups who maybe we don't know exactly who they are, but we might know where they're located, and we can figure out some other information about where they are based on kind of their blockchain forensics. And then on the other side of that, you have scammers who are just your everyday scammer who are creating a website and realizing that, hey, maybe I can scam someone down the street out of some cryptocurrency. So, all of these different crime profiles exist and tend to gravitate towards a different crime type.
And Kim, NFTs are obviously, they were probably the most booming sector over the last year in terms of cryptocurrencies. They're also the newest, so there's a lot less understood about how the market works. And there's been plenty of examples of scams and sort of theft in the past. And could you sort of just explain what you expect in terms of trends or sort of issues the NFT marketplace has to sort of address this year?
We're definitely paying attention to NFTs and specifically what it means for criminal activity. And what we found has been a few different ways that criminals have leaned into these new technologies for NFTs, but also DeFi more broadly. So with NFTs, we're seeing some wash trading, which you can actually prove with blockchain analytics. You can see these trends of people people carrying this activity out. We're seeing money laundering and all of this stuff we're going to highlight in the NFT section of the report that's coming out soon. But DeFi more broadly is a great example of how criminals are using the most cutting edge technologies to carry out crime, and really in two ways. One, they're targeting DeFi platforms. So let's hack these new DeFi protocols where the code is open source, the demand is there, the people are putting money into these DeFi protocols. Let's hack those places. Let's create scams around DeFi, or alternatively, scammer or criminals might be using DeFi protocols to launder money. Now, again, just to put this into perspective, this always does happen. Criminals are the most opportunistic out there. They're always using when there's an opportunity to be exploited, it will happen. But if you put this into perspective, it's still all criminal activity that we've identified accounts for just 0.15% of all economic transaction activity in 2021, which is pretty small, I think.
So Kim, is this something that people who are investing in this stuff need to worry about actively? And is there anything that they can do defensively? I mean, as to your point, it's coming from a lot of different actors and it's coming in a lot of different ways. So is there even a defensive posture that one can take?
There's a lot of things that you can do to protect yourself. And let's take scamming, for example. We've seen real powerful industry solutions to the age-old problem of scamming. For example, we highlight in our report how one exchange is actually implementing a new policy where they will alert customers if they're sending to a known scam. And then the people on the exchange can be informed. And actually, this has proved extremely effective in reducing the amount of scamming. But you can also do your due diligence. All of the same kind of red flags that the SEC has been talking about for years apply here. So is there information on the people who are creating this project? Are they promising unreasonable returns for life? Many of the scams that we identify, when we retroactively look at the website, the things they promised, the way that it worked, they were red flags. And not to say there's a silver bullet. Anyone can be a victim of a scam, because oftentimes these services can also appear legitimate. And then there's just what we saw, a rug pull where suddenly the founder will run away with the funds, and that's much harder to protect against. But there are basic steps you can take, just like to protect yourself from scams in kind of like the financial world more broadly.
Just pulling an example out of the air, maybe don't buy a piece of an island in the South Pacific that has a talking animated coin as its spokesperson. Just a random example. Google it, folks. All right, we're going to take a break. Thank you so much, Kim. This was really fascinating and useful stuff. Kim Grauer, Director of Research at Chainalysis, and our David Hollerith. All right, we're going to check on markets in more detail when we get back in just a moment.
All right, welcome back. Julie, I want to get over to you on the Wi-Fi Interactive. As for me, I'm watching these retail stocks, Dick's Sporting Goods, Target, Walmart, all these stocks getting hit on really that disappointing retail sales data.
Yeah, it was really a surprising number, that 1.9% decline in retail sales last month, and really going against some of the other data that we had gotten out from private sources in terms of the spending that we saw. We are seeing some things move around on the interactive here at this moment. But yes, we are seeing this selling going on in retail here. We also had preliminary Michigan consumer confidence, University of Michigan consumer confidence numbers coming out, and we saw the second lowest sentiment level in a decade. So really interesting there that we are seeing sentiment levels so low here, and we're seeing those retail sales numbers also way here. So that's part of what we are seeing going on at this point. In terms of retail, you see Walmart shares trading lower, and we're seeing a lot of the other retailers get hit as well today. It's not across the board selling, but it's quite a bit, Saz.
Yeah, a lot of sell-off in the retailers too. I'm also looking. I'm locked in on Disney, Julie. Guggenheim downgrading the stock here, and the analyst is, I'm looking up, Michael Morris downgrading Disney shares to neutral from buy. Disney is starting to climb the Yahoo Finance trending ticker page. And really his concern, Julie, is just the direct-to-consumer business perhaps not growing as fast as the street thinks. Disney warned about this happening a couple months ago. And then also just the parks business perhaps being a little bit slower than many people think, given everything we've seen with the Omicron variant.
Yeah, and that's quite a drop that we're seeing in the stocks there. And in addition to that, I got to go back to another story that we were watching today. Really, another couple stories that you might not think beer and paint would normally go together, but to me, some reason they're together in my head today because we got warnings from both Boston Beer and Sherwin-Williams, and maybe they're also together because they've been having perennial issues. Right, this is not the first time we've talked about profit warnings from these two companies. The issues are a bit different here. In the case of Boston Beer, seems to be the continued misjudgment and over-inventorying of hard seltzer, truly its brand. In the case of Sherwin-Williams, seems to be a difficulty getting raw materials in hand. But nonetheless, this just shows the sort of supply chain challenges that so many different types of companies are facing right now.
Julia, now let's start with Boston Beer. You're right. The company really had a challenging last 6 months of the year, just took write-downs on hard seltzer, clearly ordered just too much hard seltzer given the increasingly competitive environment. Now, Julie, we're seeing things like pop-up ranch water. What the hell is ranch water? Seeing a lot of commercials for that now, too. That seems to be hard seltzer 3.0 ranch water. Seeing it mentioned a lot during Yellowstone, one of my favorite shows. And then for Sherwin-Williams, look, we've talked to a lot of economists the past week and a half saying that the supply chain shortages and challenges in this country peaked. Well, no. Look at what Sherwin-Williams said this morning. They're still having problems getting the raw materials they need into the marketplace to make paint, which immediately has you concerned, well, can home builders continue to put up great results if these houses can't get painted? So there's a lot of concerns out there.
I don't know. Ranch water makes me think of a trough, which is not necessarily what you want to evoke.
Well, drink enough ranch water, you'll be drinking out of a trough, Julie. I'll tell you that right now.
Yeah, maybe so. Maybe you need to go in the trough the morning after to wake up. I just wanted to get a final check on the banks as well, because we are really getting underway for earnings season here. And this was not a very positive kickoff. If you look at how these stocks are doing, what a change of pace. Wells Fargo is the one that's trading higher. That doesn't happen very often over the past few years during earnings season. But JPMorgan shares down 5%. I believe this is the biggest drop that we have seen in reaction to earnings from JPM in quite some time. And the common thread between a JPMorgan and a Citigroup and Jefferies earlier in the week was that fixed income revenue came in below estimates. Also, we talked to David Ellison of Hennessy a little earlier in the show, and he flagged expenses might be a concern for some of these banks. And Jamie Dimon getting some attention, Brian Sozzi, for saying we could see 6 or 7 interest rate increases this year. Not sure where he pulled out that forecast from, but people aren't taking that one too seriously today.
Well, when you're Jamie Dimon, Julie, you could just flex and do whatever you want. You want to call, you think you're going to have 10 interest rate hikes this year if you're Jamie Dimon? Sure, why not call it out on the earnings call? Why not? But look, I think the reality is, and I think David Allison brought this up and highlighted it perfectly, if we get 7 rate hikes this year, you and I are going to be writing a lot of stories about 20% market corrections on the S&P 500, Dow, NASDAQ, and a whole other lot of stocks.
Saz, I only need one prediction from you. How many Trulies or Ranch Waters are you going to have this weekend? That's all I need to know.
I'm over the hard seltzer craze. I'm increasingly intrigued by Ranch Water. I think the Yellowstone commercial is starting to suck me in, but I'm all about the Rocks Terramana tequila, Julie.
You and me both, baby. All right. Have a great weekend on that note, everyone. And to Brian Sozzi in particular, Akiko and Zach going to take you through the next 2 hours of trading. We'll be back here on Tuesday.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. We are 90 minutes into the trading day on this Friday, and mixed earnings results and disappointing economic data weighing on investors. We've seen the Dow now fall nearly 300 points, the NASDAQ down 23, and the S&P 500 down 17 points. Retail sales in December coming in much weaker than expected as higher prices curb spending for consumers. Bond yields moving higher on a hawkish Fed speak as investors brace for 3, potentially 4 rate hikes. President Biden announcing 3 more Federal Reserve nominees, rounding out the central bank's governing body. We're going to be discussing the implications for monetary policy. Plus, crypto exchange FTX launching a $2 billion venture fund to double down on global blockchain and Web3 adoption. A conversation with Amy Wu, who's leading the charge, is coming up a little later this hour. We are kicking off this hour, though, with those big bank earnings and financials down sector-wide, we should point out, on a bit of a mixed picture coming through from those quarterly results. JPMorgan seeing some of the steepest losses in the session. Let's bring in Yahoo Finance's Brian Chung, who is tracking all of the earnings for us. And JPM specifically, Brian, we're talking about the bank warning about headwinds coming from higher expenses.
Yeah, absolutely. And that impacted their fixed income revenue stream. Now, of course, this is kind of changing, if you will, of shifting of the winds from those banks that did very well in the depths of the pandemic with regards to their trading desks in favor maybe now of the pendulum swinging towards those more retail and consumer-focused banks. But let's unpack what we saw at JPMorgan Chase. Again, $30.4 billion on the top line for adjusted earnings per share on the bottom line of $3.33, beating the top and bottom line estimates from Wall Street. Now, when you take a look again at that fixed income sales and trading, the impact of the anticipation for higher rates definitely impacting them on that front. $3.3 billion in revenue for the quarter compared to the street's estimates of $3.4 billion. That's, by the way, down 16% year over year. And management was saying that higher rates could further hurt fixed income in the quarters to come. And Jamie Dimon, the CEO, never a dull one, said he could see 6 or 7 rate hikes this year. But by the way, his calls in the past have been not so great when you consider that he called for 5% on the 10-year back in 2018. By the way, that never happened. But if we shift over to Citigroup, another big Wall Street bank that reported this morning, on the top line, they reported revenue of $17 billion. On the bottom line, they had a rare miss. Again, you don't see this too often in the banking industry. Adjusted earnings per share of $1.46 compared to street's estimates of $1.62. Very similar story with them. Fixed income coming in less than what the street had expected, $2.5 billion in sales and trading in that front compared to the street's estimates of about $2.7 billion. And you had Mark Mason telling reporters earlier this morning that he could see the further declines as rate expectations continued to notch up. Keep in mind that 2020 was a very good year in fixed income, so comps might be a little bit difficult on that front. But let's also kind of go out to San Francisco, California, to assess the situation on the consumer banking side of things with, of course, Wells Fargo. That bank also reporting this morning revenue coming in at $20.9 billion. On the bottom line, smash expectations, $1.38 compared to the street's estimates of $1.02. The big story for them was even though the loan pipeline wasn't that great, again, this is a bank that's still regulatory constrained in what they can do. They saw their loans decrease by almost 3%, but their revenue went up to $21 billion still. Non-interest income coming in 27% up year over year, although Wells Fargo, among the major banks, like you've heard other banks as well, wanting to change their overdraft fees, maybe want to eliminate their non-sufficient funds and overdraft protection fees. That could be impacting the bottom line in quarters to come. But of course, a good thing on balance for those consumers that are patrons of those banks. But again, we still have a number of other big banks to hear from. Morgan Stanley, Goldman Sachs, and Bank of America on deck for next week. Guys.
Yeah, that's the big earnings story you've been following for us, Brian. The other big thing out there is your other beat that you cover so well, the Fed, as President Biden kind of makes some key announcements to some posts we've been waiting to hear who he's going to name. What are we hearing about what his plans are on that front?
Yeah, it was in the middle of the Nets game, and then I had to drop everything because of the news that the White House was going to make the announcement of 3 picks to round out the Fed board. We did get the confirmation this morning, but Lisa Cook and Philip Jefferson, professors from Michigan State and Davidson College, respectively, to be picked for Fed governor roles. And then Sarah Bloom Raskin will be returning to the Fed if confirmed by the Senate, this time as the Fed Vice Chair of Supervision, a very important role that controls the regulatory and supervisory portfolio of the Fed, which, by the way, oversees the United States' largest banks. Now, again, they all need to go through Senate confirmation. We already saw Jerome Powell and Lael Brainerd for the respective number 1 and 2 spot at the central bank go through their testimony this week. It's interesting because the kind of composition of these nominees, if confirmed, would change the landscape of the Federal Reserve Board of Governors. There has never been a black woman appointed to the Fed board in history, and Philip Jefferson would only be, I believe, the 4th black male to head up a role at the Federal Reserve. Keep in mind, this is for an institution that's over 100 years old. And with Sarah Bloom Raskin, that would actually be a 4-3 majority women-led board if confirmed. So the landscape and diversity of this Fed, very much a priority for the Biden administration. Of course, they need to get confirmation from the Senate. We'll have to see when they're scheduled for any sort of testimony. But again, the Biden administration making it official, Lisa Cook, Philip Jefferson, and Sarah Bloom Raskin for those remaining Fed vacancies.
Yeah, certainly interesting developments. By the way, Brian can't ever resist an opportunity to say the Nets actually lost yesterday. So maybe not bad. Yeah, maybe not bad that you were distracted.
Check out the Lakers record. Yeah, check it out.
Let's not talk about the Lakers. All right, let's talk about economic data this morning, shall we, Zach? Retail sales out this morning, declining 1.9% in December. That was significantly weaker than the 0.1% drop that was forecast. And if you exclude auto sales, it was a decline of 2.3%. And online spending taking the biggest hit. Non-store retailers reporting a dip of 8.7% for the month. And Zach, this is interesting because we've been talking so much about this gap we're seeing between consumer sentiment and then what we've been seeing in retail sales, that there's a bit of a divide, that consumers were a little more resilient. This latest print here seems to suggest that those higher prices are finally starting to get consumers to maybe pull back a bit on spending.
Yeah, and I guess it's kind of an anomaly in terms of the data coming into the holiday season had really been pretty strong, right? When we looked at it, and a lot of optimism there. And then you had the Omicron wave and a lot of, I guess, concerns once we got closer. But, we had been talking about, even on this show and really any network you listen to, I think holiday shoppers would have known that there were some concerns that either store shelves wouldn't be stocked or shipping delays would really weigh on a lot of their holiday purchases. We were talking about that, I think, as early as the summer. So there's some of that maybe pressure here across the country to maybe shift up, and maybe that was the pull forward that we've already seen kind of play out in the pandemic that kind of has knocked, traditional strong holiday sales forward a bit and really just kind of smoothed it out. And when you think about how strong the year was, though, Kiko, sure, a soft December, but overall for the year, rather strong growth, and growth I think that's going to be tough to match when you think about what's planned here in 2022.
Yeah, inflation's certainly been in focus this week because we've been watching the CPI print that came out a near 40-year high, the PPI that came out yesterday, moderating just a bit, but still at a record. And then here we are talking about consumers pulling back on that spending. By the way, November gains also revised down 0.2% from the 0.3% initially reported. Let's bring in our first guest for the hour. We've got Christine Short, Wall Street Horizon VP of Research. Christine, it's great to talk to you to break down the data we got out this morning. What do you make of this print that we got in December? Are these higher prices finally starting to catch up with consumers?
It would appear so. Like you pointed out, we were already expecting lower numbers than we saw in December. Most estimates had December retail sales around flat, maybe slightly negative. And that would have continued the trend that we started to see in November. Like you just said, November even got revised downward. But this, I think, was a shock because of how off the estimates were. So it was actually much lower than we were anticipating in December. And like Zach pointed out, we've had a lot of different kind of sentiment around how consumers are doing. So in December, it sounded like it was a great holiday shopping season, maybe not a record, but considering what we were all anticipating starting in July with supply chain disruptions and inflation, it felt like we had gotten through that. We did have a couple of months where consumer sentiment was down, specifically November, but then U of M's consumer sentiment index popped up in December. But this morning, now we're seeing the prelim numbers for January, and we're back down to almost the second lowest reading in 10 years. So it's confusing. It's unsure if consumers were just hearing about inflation and sort of spooked by it earlier in the summer and the fall. But now I think they're really feeling it. And so I think you're going to see a continuation of this pattern. This, for me, solidifies that inflation is impacting consumers. And then you sort of have this natural pause at the beginning of the year anyhow with spending. Consumers kind of taking a breather. They've spent money over the holidays. And if you look at some of the categories you mentioned, online spending down, home furnishing, which was just on fire all of last year and really the last couple of years, restaurants and bars, that's obviously related to the COVID surge as well. And so there's some categories that were really doing well that we're just seeing tank now. The only two that saw increases were miscellaneous stores, so things that otherwise aren't categorized, like florists, art supply shops, pet stores. There's about a few dozen more of those. And building materials and garden centers. So expect on the retail side, when earnings come out next month, your Home Depots, your Lowe's to probably continue to do well. But overall, the sector expecting pretty muted earnings for the Q4 season.
Yeah, and that's, I guess that's kind of the thing looking forward, right? If maybe retail sales didn't deliver over the holiday season, you wonder if any of those retailers have been playing catch up, what it might do for pricing as we move into the first quarter of this year, just kind of trying to offload maybe some of the inventory that didn't come in time, or maybe they over ordered on. So, I mean, how does that maybe start to impact earnings as we look ahead for some of these retailers that were really, I guess, banking on it being strong?
Yeah, I think you have to keep in mind that year over year, earnings growth is going to normalize. We're seeing that right now for Q4. Numbers are still very high for the quarter. We're at about 22% earnings growth, but that's moderating a bit, and that's normal. It's meant to normalize. Like some of those numbers we saw in the year ago period were quite high. So historically speaking, earnings will still be high, but if you look at the 2022 numbers, those do begin to moderate. Consumer discretionary is actually one of the laggards this quarter and will continue to be in the first half of the year. But if you look at earnings growth of about 1.5% for consumer discretionary, revenue growth is still at about 11.8%. So clearly that's a pricing issue. It's everything that a lot of discretionary names have complained about so far in their earnings releases, which are labor tightening, increased costs. And so that seems to be impacting certainly the bottom line, although revenues still look strong on a year-over-year basis.
Yeah, on that front, Christine, if you think about the previous quarter, we did still see that divide between the big box retailers and then some of the smaller names in terms of their ability to cushion some of the costs instead of passing it down to consumers. Is this the quarter where we're going to finally start to see even the bigger names say we're going to have to increase prices?
Yeah, it depends. Like you said, sure, Walmart, Target, they really manage inventories really well over the holiday. They weren't, they didn't have to increase costs, but you might start to see that break down in 2022. Certainly the smaller names already have felt that impact in the second half of 2021. But if you look ahead at estimates for some of the big box retailers, those start to moderate as well. So I think you're going to see that commentary well represented in Q4 estimate or Q4 results and for estimates in 2022.
And lastly, I mean, you use the word confusing, and I feel like that's a good way to kind of sum all this up. And if you are the Fed watching some of this data and basing your decisions off some of this data, confusing isn't really what you want when you're trying to project out what things are going to look like. So, I mean, how much harder does it make the Fed's job? Of course, they've been leaning more into, I guess, the strength they're still seeing on the labor front. Inflation, though, increasingly, when you add everything up, very difficult to predict. So, I mean, how do you see them navigating that as we try and gauge whether or not 3 interest rate hikes are actually what we should be expecting?
Well, it sounds like they're pretty committed thus far, but you're right. Is inflation already moderating? I think that's what the Biden administration is trying to say from the latest CPI reading of up 0.5%. Yes, year over year, it's a 7% increase. That's the number everyone's focused on, highest in 4 decades. But we have seen a tick down month over month from what we saw in October and November, which were about 0.9 and 0.8% increases month over month. Now we're down to 0.5. So is it naturally tapering off? Perhaps, but if we are talking specifically about the sectors that benefit from interest rate gains, consumer discretionary typically is one of them, just because in environment in which you're raising rates is usually, like you said, great labor market, high growth. And so that tends to help the discretionary names. People are out there buying, but now you have this added impact of inflation. So I think it makes their job very challenging, especially because we don't know what we're going to see in the first half of the year. And is inflation naturally already tapering? We're not sure that there's evidence of that yet. But right now it looks like everyone's predicting a March hike, and that's come up. I mean, I don't know about Jamie Dimon's prediction of 6 to 7. That sounds a little exaggerated. At most I've heard 4. But yeah, they're going to have to watch the situation closely because it is a bit of a balance.
Yeah, the number of rate hikes aside, it seems like the consensus is increasingly, at least that first one will come in March. Christine, it's good to talk to you today. Christine Short, Wall Street Horizon VP of Research. We're going to take a quick break here, but coming up, a setback for the Biden administration's push to mandate COVID vaccines, what the Supreme Court's decision means for large businesses as they struggle to bring employees back to the office. Welcome back to Yahoo Finance Live. Some good news and bad news for the Biden administration's push to mandate COVID-19 vaccines in the workplace. The Supreme Court ruling on Thursday that vaccines cannot be mandated for large businesses, but can move forward for healthcare workers. To break down that decision, let's bring in Yahoo Finance's Alexis Keenan. And Alexis, I realize the president is kind of spinning this as a positive because of the healthcare part. But what does this mean for large businesses who still want to move forward with a mandate?
Definitely. So the administration taking the win that they did get, this was a split decision coming down with an apples and oranges kind of result here. Some companies are sticking to their own employee vaccination requirements, which they can do in most cases. Others are relieved that they don't have to implement this because there are plenty of businesses out there that were worried that they would lose too many of their staff over this. So just to recap what these rulings are, the first one is the Supreme Court blocking the Biden administration's large employer mandate. That's the one that was supposed to apply to 84 million U.S. workers, and it would have imposed fines on companies that have 100 or more workers unless all of their employees were fully vaccinated or tested each week for the virus and wore a mask at work. Next is the Supreme Court allowing the Biden administration's healthcare facility mandate. That will apply to 10.4 million U.S. healthcare workers. And that one imposes fines on healthcare companies that receive federal funding unless all of their employees are vaccinated. And that one does have exemptions for religious and medical reasons where employees decline the vaccine for those two reasons. Now, what private employers are now going to do, that is a question. Majority of jurisdictions, for them, the ruling does not really prevent employers from having their own vaccination requirements. Most private companies can go it alone and do what they want there, being even more restrictive than what the federal government was providing. So there are, though, some cases where state and local laws say otherwise. And one of the places that's tracking those states is the National Academy for State Health Policy. They show here that private companies, you can see their Montana private companies in states, Montana and Tennessee, they are banning their private employers from requiring employee vaccination. Also, and when we switch it over and look at the healthcare employer map, there were 22 states that had already mandated healthcare worker vaccination. So you can see that's where the sweeping change is going to occur. Now it's going to be across the nation. All of the healthcare employers are going to have to be vaccinated if they don't have an exemption. Now, when I've been talking with labor and employment experts, they are cautioning, though, that private employers still have to follow OSHA's general rules, and that obligates employers to have a safe workplace for their employees. They say that the companies should watch for new legislation that is following the Supreme Court's decision, and also they're going to have to still wait for the lower courts and possibly the Supreme Court to decide ultimately whether that rule is or is not constitutional. That could change things down the road. There's also a chance here that the White House could amend its mandate. They could try to tailor it, make it more narrow so that it fits the vision that the Supreme Court kind of intimated would be possibly okay. It just couldn't be as sweeping as the administration envisioned. So we're watching to see how these large employers are responding. Will they keep these vaccination requirements for those that have them in place, or are they going to scale it back? A lot to keep track of here, but we'll keep watching and let you know what we're seeing.
Yeah, Alexis, what does it mean, though, I guess, for maybe some of the companies that were more aggressive, already put these policies in place, already may have made some employment decisions, maybe some workers leaving companies to kind of follow all these rules? What does it do for those ex post facto?
Right. So we have some large employers that are already requiring these vaccinations and don't have a lot of workarounds or exceptions for their employees. Of course, airlines has been a big one. Also, Tyson, Disney, Starbucks, Raytheon. JPMorgan has a rule saying that in-office workers could be fired by the end of today if they're not vaccinated. Also, Citigroup warning its unvaccinated employees that they could be fired by January 14th. 14th, so again today, if they're not vaccinated. Facebook then made boosters required for all in-office workers, and again, Starbucks saying that all employees have to be vaccinated. That was a rule by January 9th, though Starbucks has carved out a weekly testing option for its employees. So just a moving target here, certainly. And as the courts continue to consider this issue, they're going to have to grapple with the fact that transmissibility is changing over time and that treatments are changing over time as well.
All right, Alexis Keenan bringing us the latest there. Appreciate that. Going to take a quick break here on the show, but when we return, some big moves to account for in the crypto space as crypto giant FTX is launching a huge venture fund and bringing on a power player to lead it. We'll chat with her on the other side of the break. Stay with us. Well, crypto giant FTX is doubling down on its efforts to grow the entire crypto space. That is the subject of today's Crypto Corner segment presented by Tastyworks. And not just growing the space with little efforts, but $2 billion worth of firepower here to invest in Web3 and other crypto projects and bringing on an extreme power player in the crypto space as well in Lightspeed Venture Partners head Amy Wu is now going to be leading that fund of $2 billion, and she joins us here, FTX Head of Venture and Commercial, the new title, I think, Amy, if I'm reading that correctly here. But nonetheless, interesting to pair the dots as you kind of led the round in FTX before, now joining to run this fund. I mean, what are the goals here with $2 billion to put to work?
Yeah, super excited to join FTX, and we're launching FTX Ventures today. Thanks for having me on. What we want to do with the $2 billion first fund is we want to back great teams in the crypto and Web3 space predominantly. We're looking to be strategic capital and leverage our very large sort of resources and also expertise in crypto and on the exchange side, also and the engineering side, with the projects and teams that we get to work with, and also to be really flexible capital. We don't have external partners in the fund, and so we can write a check of pretty much any size, like $100,000, $500 million, and at any stage of company as well. We're long-term thinkers and partners here, and are super excited to get to work with great builders.
It might be the best job to highlight here in terms of also on top of this. We know FTX is building the compound down in the Bahamas. Now you're down there too. But when it comes to, I guess, what has you most excited for the role too? Obviously, Sam Bankman-Fried's been on the show, been very excited about what Solana could offer to the crypto space, and play to earn in gaming. I mean, what do you think right now is maybe the biggest sector or piece of crypto to watch in 2022 you'll be chasing?
Yeah, I mean, the interesting thing is crypto is still so early. There's on the order of still, I would say, under 20 million people that are actively trading in DeFi, and a few hundred million people who are holding crypto. And so in the next, we're excited to be in it early. I mean, FTX has been early, and we're looking to invest cross sector. So some of the areas we're really excited about: Web3, gaming, I would say DeFi, sort of what's going on in the ecosystems across L1s, certainly Solana and others. You're seeing, Near and Arbitrum and some of L2s coming online this year, and also some of the newer categories like healthcare, exploring blockchain as well. So we're really excited to invest across the board.
Yeah, let's talk a bit more about healthcare. What kind of adoption do you see? I mean, we've seen so much money pour into this space. Now you've got $2 billion that you can deploy. What do you see? What applications do you see in healthcare?
It's super early, I would say, in healthcare, right? I mean, you have a regulated industry in crypto, and you have very regulated industry in healthcare as well. So I think that one is still going to be really early. Obviously, with smart chain technologies, there's a lot of ways to be adopted in healthcare, but we'll see. And we're going to be looking across applications and also in life sciences.
Amy, I got a weird one here for you, but just kind of reflecting on what Web3 really means and kind of the way that some of those projects have been built out, it does kind of seem odd to see venture now kind of playing into this space. Of course, we've kind of seen some crypto Twitter spats between Jack Dorsey and other people in crypto venture. But what does it look like? I mean, what is kind of the mandate? I assume in building all this out, it's not necessarily all about profit or returns, but also kind of how big you can grow the space. And Sam's an outside of the box thinker. So, I mean, what is really, I guess, the goal as you calculate it?
Well, I would say, there's the FTX's goals, and then our venture team's goals. On FTX, we want to power the financial services and also users of crypto. I would say both individuals and companies as well. I mean, today it's the second, third largest crypto exchange, and also depending on how you look at it. But then the company in the last year has also built out the wallets, payments infrastructure, and we're looking at other categories as well. And so I think we're well on the way to becoming a super app for users in interacting with crypto across the ecosystem, and also as a platform, middleware infrastructure platform for companies, Web2 and otherwise, who are looking to build into Web3 and on blockchains as well. And so both FTX and also FTX Ventures is looking to accelerate this vision and support companies in the ecosystem that share this vision.
Yeah, and lastly, I guess it's just a follow-up to that question too. There's a lot of ways to raise money now in the Web3 space. We've seen that with kind of crowd funds and tokenizing some of your efforts out there. But I guess that would kind of overlook what the FTX team and what you and your career at Lightspeed kind of brings to the table and what you get from a VC in terms of guidance and stuff like that. So, I mean, how active is that to be a piece of, I guess, the offering here as FTX launches this fund?
It's really important. I would say in the early, the last 5 years in crypto, there's been a lot of index funds and it was definitely a rising tide of lifting a lot of boats in the sector. But I think we're moving into a next phase in which funds and investors and partners really need to differentiate themselves in terms of the value they bring to the table. And so, it's everything from being that 2 a.m. call from a founder who really needs some critical advice on a decision they're making, to thinking through how they're designing a protocol, security for a protocol, also, go to market, how to reach users, leveraging the experience that we're seeing across the portfolio and also with FTX itself. And so, we're launching with a team of 8 people, all very experienced in this space. And, we're all sort of ready for at a team's disposal to be able to support them in building their business.
Certainly exciting times ahead. Amy Wu, FTX, head of venture and commercial, joining us from the Bahamas. I hope you get some time to go out to the beach eventually. Thanks so much for joining us, Amy. Eventually. Coming up, another roadblock for tennis star Novak Djokovic as immigration officials in Australia revoke his visa yet again. Plus, North Korea back to test firing missiles in response to U.S. sanctions. Those stories are coming up in our worldview after this break. In our worldview today, tennis star Novak Djokovic is facing deportation yet again after immigration officials in Australia canceled his visa Friday, putting his bid to defend his title at the Australian Open in jeopardy. The immigration minister reversed course 4 days after a judge handed Djokovic a legal victory, releasing him from immigration detention. Now, the minister said his decision was made with public interest in mind, saying he was committed to protecting Australia's borders in the pandemic. Djokovic's supporters gathered outside his hotel Friday to protest the decision. He was first detained at the Melbourne airport last week, despite local officials granting him an exemption from the COVID-19 vaccine mandate. A federal investigation revealed he provided false information on documents he submitted to border officials. His lawyers say he will appeal the decision. North Korea is lashing out against U.S. sanctions, test firing what appear to be 2 short-range ballistic missiles. The launch marks the 3rd this month, and it comes after the Biden administration imposed fresh sanctions against 5 North Koreans for their role in sourcing equipment and technology for the missile program. That prompted the country's foreign ministry to criticize the U.S., vowing to take stronger and certain reaction in their words, a confrontational stance. North Korean leader Kim Jong-un has so far rejected overtures from the U.S. to resume talks with the Biden administration. North Korea has ramped up its missile testing since September last year and launched hypersonic ballistic missiles twice this month in violation of UN Security Council resolutions. And Hong Kong is tightening its borders yet again, suspending transit flights from 150 countries to control the spread of the coronavirus. The move comes in response to roughly 50 new infections reported in the city since the end of last year. The restrictions will take effect this weekend. It bans travelers from high-risk areas, including the U.S., from passing through Hong Kong's airport. The cities followed China's zero-tolerance COVID policy and already banned incoming flights from Australia, Canada, France, and 5 other countries. The restrictions will remain in place for a month. Coming up, a conversation with cloud services company NetApp. CEO George Kurian is going to be joining us to discuss the outlook for the space after this short break. Cloud services company NetApp shares dipping into the red after hitting a new high in the session today. NetApp, which has collaborated with some of the biggest names in the cloud industry, including Amazon Web Services, Google Cloud, and Microsoft Azure, is seeing strong growth in the last few quarters, most recently smashing estimates for both revenue and earnings per share. Let's bring in George Kurian, NetApp CEO. We've also got Yahoo Finance's Brian Sozzi joining in on the conversation. George, it is great to have you on. You know, we've seen a number of notes from analysts cross through talking about, or at least warning about, the slowdown that could come in this space from the enterprise side. What do you see as you look to 2022?
We see continued strong demand. We have really good drivers behind our business from a demand side, both the use of data to make businesses go faster and the core idea of cloud and digital driving business transformation. So we feel really good about our prospects for this year.
George, have you seen any easing in the supply chain challenges you talked about a couple weeks ago on your earnings call?
We continue to work to improve availability of parts and to meet our strong customer demand. I think it's going to continue to be a bit choppy for a few more quarters, but we are got good, deep relationships with our suppliers, and we're starting to see improvements.
And George, where are you seeing those shortages?
I think we see issues specifically to select pieces of the semiconductor supply chain. And then, of course, logistics and freight is another area where we've had to pay premiums to use air-based distribution and expedite parts to certain parts of the world.
Hey, it's been interesting to kind of watch the growth and the different companies here operating in the cloud space compete to continue some of that growth. I mean, as you see it right now in this chapter of where things are at, I mean, what's NetApp kind of doing to kind of help all those players in the cloud space and what the needs have shifted to now?
I think we see businesses now moving their core applications to the public cloud infrastructures. And we are able to bring technologies and work closely with the biggest cloud providers, Amazon, Microsoft, Google, to help businesses deploy those applications on the public cloud. This has profound implications for how we can make businesses go faster. So we've helped vaccine makers bring vaccines to the market faster. We helped Ducati Motors, for example, reduce the time to bring new motorcycle prototypes to market by about 30%. So these are the core idea of using data to help businesses go faster, and we're a cornerstone of that.
Yeah, we've been talking so much about how that transition, the use of more digital, more data has accelerated during the pandemic. And I think there's a lot of questions about how much of that runway you can maintain now that a lot of that transition has happened. Can you give us a little more insight on what you see? Where are the big growth opportunities that you're especially excited about?
I think we see data-driven digital business as in its first chapter, meaning data used to be a byproduct of how businesses operated. They'd sort of have a big store and they collect a little bit of data around how, customers, participated in that store. Now they're using data as an input to drive business rather than as a byproduct. And we're in the early innings of that. I think you can see data growth being phenomenal, right? There's statistics which say there's been more data created in the last couple of years than in the preceding several centuries of human history. So I think that pace is not going to go away.
And George, I've been talking to a lot of tech CEOs lately, and they're starting to spend even more time on recruiting top talent within your company. How much time are you spending right now making sure you have the right talent to meet this really strong demand backdrop?
We do that as part of our daily job, right? I think a big part of my job is to both build confidence in the outlook of the business and spend time building our team. We have a very strong culture of trust, communications, as well as inclusive opportunity for all of our employees. And that has stood us in good stead over many years and is clearly an area of strength as we recruit new talent.
And George, to follow up on Brian's point, I mean, how competitive is the landscape for you right now? We've heard from so many companies who've talked about higher expenses they're looking at because of the competition for those jobs, to fill those jobs. What does that look like for you right now?
It's always been competitive in our market. We are a talent-driven business. And so we've done many things over the years to continue to be able to bring really good talent to NetApp. I think the innovation that we are working on is a source of inspiration to a lot of people. I think the idea of flexible working models where we can bring talent into our organization regardless of their physical geography is another area of strength. And then honestly, the culture.
George Kurian, NetApp CEO, joining us today alongside Yahoo Finance's Brian Sozzi. Appreciate the time. Coming up, a warning for AirTag users, new reports pointing to the product's tracking capabilities. Dan Halley is on the case in this week's Tech Support. That is coming up after this break. From your wallet to your car keys, Apple's AirTags can help you keep track of pretty much everything, but an increasing number of reports pointing to the product's tracking capabilities are raising fresh concerns about its usage. Yahoo Finance's Dan Halley joins us now to explain as part of our tech support segment presented by Verizon. Dan.
That's right, Akiko. This right here is an AirTag. It's a tiny little guy. It's about a little bit larger than a quarter, and you can use it to track things like your keys, your wallet, anything that you think that you would usually lose. I've seen a lot of people actually, when I go to the park, put them on their dogs because it really does allow you to get incredibly accurate positioning on something that you may lose. But as you said, there's been an increasing number of reports of people having AirTags being planted inside their bumpers or inside their license plates of their cars, inside their jacket pockets, all of this unknowingly, and that is very concerning. So there are a few things that you can do if you think that you have an AirTag with you or you actually get an alert. And the first thing is that alert. If you're an iOS user, you have an iPhone, if there is an AirTag that is not with its user for a certain amount of time, the person that actually owns it and it's registered to, if it notices that they're away from them, they will send an alert to the nearest iPhone saying that there's been an AirTag found. Now, there's two reasons for this. One is perhaps you're sitting on a park bench and someone forgot their keys. It'll let you know that there's an AirTag there and keys, and then you can use that to identify who the owner is and get the keys back to them. The other, though, is in case someone plants one on you in your vehicle, puts it in your jacket pocket without you knowing. That's the security aspect of it. And so when you do get that alert, it'll show up on your iPhone. You can see that it's an unknown AirTag, and then you can actually see how much it's tracked you. So from what point it started tracking to where you are now, over how long of a period of time. And then from that setting, you can also go ahead and disable it using the software that Apple provides in that notification. So that's part one. Part two is that after between 8 and 24 hours, so in that timeline, you're going to start to hear audible beeping from an AirTag if it's with you and not with its original owner. Now, the beeping isn't incredibly loud. If it's, for instance, outside of your car and you're driving it, you're not going to be able to hear it. But the point is, if it's in your purse, if you find it, you hear something and it's beeping and it's coming from your pocket, that would be the AirTag. And then what you can do is scan that and see whose it is. If you're an Android user, things are a little bit more difficult. It's not exactly as well done as on the iPhone. In fact, you have to download an actual separate app on your Android device to be able to scan the AirTag. And that's only troubling because, if you're an iPhone user, you get that alert. If you're an Android user, you don't. You have to rely on the sound. So my advice is, if you're nervous about something like this, download that AirTag tracking app. It's called Tracker Detect from the Android store, and it will allow you to then scan for nearby trackers that are compatible with Apple's Find My network, and that includes the AirTags. You'll still hear those audible noises, but it's better to be able to pick that up. And really, these have been reports. There was one on Thursday about 2 women in California who had been tracked. There was a report of a Sports Illustrated model recently who said that someone placed one in her jacket pocket when she was at a bar. So it does happen. It's not incredibly common, but it is something to watch out for. So if you take those steps, you'll be able to keep yourself safe. And then, as Apple says, if you do find one, then reach out to the police if you feel like you're in danger.
Yeah, Dan, I mean, this is like so many stories in tech where, you find a product that's not necessarily used in the way the creators intended it to be. I mean, sure, you can turn it off, but there's got to be concerns about what data is already available at that point. What is Apple saying about that?
They basically say that the features that they have built in are designed for safety and for tracking. And to Apple's credit, there are other tracking devices out there that don't have the kind of safety features that AirTags have built in. So these are a way to help prevent you from being tracked. And look, if you have a pair of AirPods, they also have a Find My tracker on them, just in case you misplace them. But someone could use that as well to see if your destination or your location. So it's not just the AirTags, but they're relatively cheap compared to a pair of AirPods. So, it's not something that is completely unheard of. But I think, the safety features that Apple has built in are good. The question is, do they go far enough? And seeing the kind of reports that we're seeing, they just might not.
All right, Dan Halley there with an interesting look at some of that tracking technology there. Got to keep an eye out for it. Appreciate you bringing us that. Going to take a break here on the show, but when we return, digging deeper into the sell-off we're seeing play out, this time some of those cyclical names we've been talking a lot about as the banks kick off earnings season, providing some weakness there to the Dow, off about 0.2%. We'll highlight much more in the next hour here on Yahoo Finance Live. Welcome into Yahoo Finance Live as we reset for the noon trading hour. I'm Zach Guzman alongside Akiko Fujita. Happy Friday, everybody, as we're watching some of the big headlines play out today. Weakness in terms of what we heard from some of the big banks as they kick off earnings season, denting the Dow off more than 240 points right now, bringing the latest moves there. Plus, one of America's largest crypto exchanges out with their annual research report, setting up what could be a wild ride in 2022. We're going to chat with Kraken's head of business operations and strategy for more on what to watch this year. And pressure mounting on big tech. The House Select Committee investigating their role in January 6th insurrection, issuing subpoenas to get at what happened there in the violence, how that battle is shaping up for Meta, Google, Twitter, and more. We'll dig into that as well. But first, I want to focus in on some of the action we are seeing play out after the banks reported, and as I said, providing some weakness in the session today. JPMorgan shares off more than 5% as Jamie Dimon highlighted some headwinds that could be coming this year, including, of course, all tying back to what else but inflation in the form of wages. And for more on all those moves, I want to bring in Yahoo Finance's Jared Blickery to kick us off in the noon hour. Jared.
That's right. We have another mixed market. It seems like the Dow and the Nasdaq flip positions just about every day. Today, the Nasdaq is the outperformer, but it is not up much, up 6 basis points. You can see very choppy day there. Let's take a look at what's happened over the week. You can see somewhat the let's call it the bottom third of its weekly range. Looking at losses of 84 basis points, about 0.8%. S&P 500, pretty similar chart right there. And the Dow, let's check out the Dow here. Not that different as well, except closer to its session lows, or I guess the lows of the week here. I do want to get to the NASDAQ. We've had a little bit of a turnaround here, a lot more green than we were seeing on the open. Nice to see that. Microsoft up 1%, Tesla and Alphabet each up about 0.8%, Facebook and NVIDIA each up more than 1%. Tech, this is some interesting sector leadership we're seeing today. So energy and tech, you got a value stock, you got a growth sector, excuse me. You usually don't see those as the number one and number two leaders here, but that is the case nevertheless. Also note that Staples is right behind in third place, so kind of a strange setup. Real estate, materials, and financials, those round out the underperformers. Actually, industrials too, that are down by more than 1%. Travel was looking pretty bad on the open, and it's gotten a little bit worse. The airlines suffering here. Delta, American, United, each down more than 3%. The cruise lines, they had a nice pop yesterday, but not really seeing much follow through today. In fact, Norwegian Cruise Line down 2.5%. Chip stocks, and we'll get to financials in a second, I promise. Chip stocks, those are why tech is flying high today. We're seeing Lam Research, that's up over 4%. Applied Materials hitting a record high yesterday, up 3%. And there are other names on this list too. Let's check out software. Software has been under a tremendous amount of pressure this year, and it's not looking that great today. Let's take a look at the week, and we can see some of the leaders to the downside. Vroom, let's take a 5-day look at Vroom, down 18%. We also have MongoDB, that's down, 11% over the 5 days. So really just kind of taking it on the chin here. As promised, we got to get to the big banks. JPMorgan, this is a 5-day look. I'm going to change this back to an intraday. JPMorgan down 5%. This is the worst earnings day reaction they've had since 2011. And in the grand scheme of things, not the worst case here. JPMorgan has been a steady recipient of some of the value trade that we've seen permeate the markets recently, up 12% over the last year. It was fixed income and equities trading that hurt both Citigroup and JPMorgan on their revenue. You can see Citigroup here down 2% today, down 4% for the year. Wells Fargo bucking the trend. They had some nice net interest margin projections. They're expecting 8%. That is huge for net interest margin. You can see Wells Fargo has really taken off over the last year, up 66%, Zach.
All right, Jared Blickery bringing us some of those latest moves. Not optimistic there in terms of the early results out of the big earnings reports we've gotten. Appreciate that. I want to turn our attention, though, to what it means for the rest of the year and maybe how you should be trading off of some of the early headlines that we are getting. And for more on that, let's bring in Marcy McGregor, Bank of America Merrill Lynch Chief Investment Office Senior Investment Strategist, joins us now. And Marcy, I mean, I don't want to read too much into maybe what we're hearing out of the first earnings reports here. Keep in mind, JPMorgan actually beat on earnings and revenue. But the look ahead, I think, is something that a lot of companies out there are probably going to be reiterating a lot of the same points. Unknowns and inflationary pressures may be impacting results to come. So, I mean, when you digest that macro theme, what does it tell you about maybe how some of the pressure there is on the part of these companies to really beat expectations?
Yeah, the pressure is on, but I would say if you look at the big picture for banks, many of the banks emerged from the pandemic stronger, with stronger balance sheets. The good way to position for inflation, because as rates rise, net interest margins are going to expand. But it's also a way to position for the supply chain stress that's going on, because as companies and different industries rebuild their inventories, that means loan growth for the banks. So as we headed into this earnings season, it was banks, semis, and energy that actually saw the most analyst upgrades. And I think ultimately the cyclicals lead the way, because they're going to likely report revenue growth above the average for the S&P. But I think we got to look at the big picture and position for sticky inflation and a strong economy.
What we heard from the banks today certainly feels like something that we're likely to hear over and over throughout the earnings season, and that is those rising expenses largely coming from higher wages. And I wonder how you're looking at that. Is that something that will continue, well into the second half of the year? How do you think investors should be looking at that as companies continue to report their results?
Yeah, I think the reality is real wages have not kept up with inflation, and real wages haven't kept up with profits either. So that's part of the story of why companies have been able to protect their margins so far in this. But I would expect upward price pressure on wages to continue. And I would say wages and even rents, those stickier measures of inflation, haven't even really worked their way into the headline data yet. So I think inflation is going to stay. Wage pressure is going to be a story for the entire year. But it's companies that pass through price increases. So I think of it almost as quality companies in each sector that are going to be able to continue to exceed expectations on profits despite rising wages.
Yeah, Marcy, we just showed the 10-year there. You see it ending the year around 2%. We've been seeing it creep higher and higher. And obviously, I think that prompted a lot of investors to kind of shift back into cyclicals because of what we saw in the tech sell-off. But now, if those are getting dented just as bad here, what's kind of the strategy, I guess, as we reset for maybe positioning around a 2% yield on the 10-year?
Yeah, I think we have to remember a 2% yield, even though it's significantly higher than where we're coming from, especially in 2020, is still a historically low level. So I think it's more even about the speed at which rates increase. We saw a quick move at the beginning of the year, but I think it gets steadier from here. And I think what we're looking at is especially a bond market that has accepted and not overreacted to what is a sharp pivot by the Fed. It's going to be all about the Fed this year, especially as we head into FOMC meetings. So positioning wise, I would say below benchmark duration, up in quality and fixed income, because we do see rates rising from here, but not significantly higher. Like I said, 2% at the end of this year, maybe 2.25% as we look ahead to 2023.
All right, Marcy McGregor, Bank of America Merrill Lynch, Chief Investment Office, Senior Investment Strategist. It's too late to say Happy New Year, I think. We're 2 weeks in, but it's the first time I've seen you, so Happy New Year. Thanks again for coming on. Going to take another quick break here on the show. When we return, shifting from the year ahead in equities to the year ahead in crypto. A closer look at that with the annual report from Kraken. We're going to chat with their head of business operations and strategy, one of the largest crypto exchanges in the United States. Stay with us. We're back in 2 minutes' time. thought 2021 was an interesting year in crypto, buckle up because 2022 may deliver some headlines well beyond what we saw last year. And of course, so one of the stories was the outperformance from some of the altcoins out there relative to what we saw Bitcoin, even on an up year, still getting outperformed by a margin of about 4x, 5x, depending on which ones you're looking at. Much more if you go further into the DeFi space. And for more on what to expect this year, very happy to welcome in here with us one of the heads in terms of operation and strategy of America's largest crypto exchanges, Thomas Perfumo, Kraken Digital Asset Exchange Head of Business Operations and Strategy, joins us here alongside Yahoo Finance's crypto reporter David Hollerith. And Thomas, I mean, when we look at it, I don't know if it's fair to say that you can expect a lot of the same things to carry over in 2022, but it doesn't seem like the trends are really going anywhere. So talk to me about what you expect to see.
Yeah, so I mean, obviously, you never say never with crypto. Things go pretty wild in this industry, but I think the most important takeaway from the report that we released, the Crypto in Review 2021 by Kraken Intelligence, is just this constant uptrend with respect to things like adoption metrics, seeing this enormous proliferation of new applications and services on smart contract platforms. And we saw it in the tremendous growth on DeFi, where you have hundreds of billions of dollars of total value locked in collateral, NFTs, billions of dollars of artwork, and thousands or even millions of people starting to engage in digital art networks and stuff like that. So for us, we're a little less focused on the price action. We think that tends to be very choppy, but all the signals underlying it are still continuing to trend positively.
And Thomas, David here, by your analysis, NFTs proved to be the highest growth sector by far. The report also highlighted too that the space has plenty of issues that sort of need to be addressed, in the coming years. And you mentioned security and counterfeiting and storage hosting, and just to sort of take one of those details, how do you think counterfeiting in the NFT space can be addressed, and sort of what have you seen in that regard?
Yeah, it's interesting. In terms of counterfeiting, it's pretty juxtaposed in the sense that NFTs by their own nature in some ways are not counterfeitable. And so it's really has to do with serving UI UXs that are able to verify the authenticity of an NFT by using or leveraging the strength of blockchain information to do so. And so I think this is more of just a presentation issue and making sure people are familiar or understanding that when they interact with an NFT or they're going to purchase one, that they are doing so directly from an authentic source like a creator, an artist, for example. We had issues with hacks and whatnot in the industry, historically speaking. This is as simple as you being able to manage your own Bitcoin balance in your wallet. And we're seeing a lot of these kinds of phishing attempts and whatnot, targeting people who are in the NFT space who are relatively new to crypto. And so these are people who perhaps have never touched crypto in the past. And we saw this years ago as well in 2017, 2018, when you had all these new people enter the space. And so naturally speaking, I think the industry is going to continue to mature as people become more familiar with how to safely engage with cryptocurrency, and services like ourselves at Kraken help serve experiences that provide better safety for consumers in a mass audience.
Thomas, you mentioned you're less focused on the price action, but I'm looking through your report and you say that Bitcoin could climb to as much as $142,000, but fall to as low as $26,300. That's a pretty broad range. Can you walk me through that?
Yeah, and I just want to be very clear. We don't provide any kind of price targets. What we try to do is expand on perspectives. The information that we were sharing there was really trying to provide some technical analysis that people are interested in seeing. Bitcoin is an asset that has trended exponentially over the last few years and over its entire history, actually. And people just naturally don't think in terms of exponential terms. And so when you think about this industry, you have to understand that there is plenty of volatility. I think one of the things that we're trying to demonstrate with respect to that kind of technical analysis is that not only is it a volatile asset, but the risk reward in some ways is something that we are trying to present as Bitcoin. We think still has plenty of upside, and there is some level of downside, but it's multiples less than what we think the upside might look like.
Yeah, what's interesting to do, to kind of watch play out, I guess, more recently has been kind of this break in correlation between Bitcoin and the rest of the other assets in DeFi. I mean, for an investor out there, that'd be a dream come true. That'd be kind of what's not been the case for years in crypto. I mean, how do you see that evolving, I guess, as people kind of understand the use cases here and they get built out to show, all right, these things are definitely not at all the same?
Yeah, I think it's just a natural progression or maturation of the industry where we're starting to really see that these applications don't have to correlate with one another. And so Bitcoin still continues to hold that top spot when it comes to thinking of it as a store of value. This is also true in the case of institutional investors who are not crypto native players. However, within the crypto industry itself, you have extremely different communities that are engaged in things like DeFi or NFTs, and their activity in many respects is not at all correlated with Bitcoin. And so I think that this is just a maturation of the asset class, broadly speaking. It's good for people using the networks. It's good for people who are interested in getting exposure to this asset class. Again, to your point, just being able to access different cryptos in a way that creates a more robust portfolio with uncorrelated assets is great for everyone. And so I think it's just a natural progression, again, of this proliferation of just different use cases of crypto and seeing the adoption trend that way in a totally uncorrelated basis.
And Thomas, it seems like Bitcoin can mean a lot of different things to a lot of different people, but it seems like one of the main sort of stories of like what the asset is used for is sort of store value in emerging economies. That's sort of what we've been seeing lately. And I thought it was interesting in your report, you hit on countries and governments that have sort of put BTC on their balance sheet. And we talk about El Salvador all the time, but they're actually fairly small on the list compared to, say, Bulgaria, and the Ukraine and Finland even. So I was sort of curious about that to ask you, and then sort of given, what we might expect this year in terms of governments adopting Bitcoin or putting it on their balance sheet.
Yeah, I think the best way that I can provide perspective on this is that with any kind of frontier technology with the S-curve, you're always going to start with that earliest adopter. And they tend to be the most important because they're the ones that are really showing the public case for whether it's beneficial to them or not. And so what we've seen, at least on the government standpoint, is El Salvador taking this very strong position, like we want Bitcoin to be part of our economy, part of the interaction we have with our citizens. And what's fascinating about that is it is a country that I think is well prepared to adopt crypto in a meaningful way. So for example, it was a dollarized country historically. It is a smaller country. And so they're able to move not only much more quickly, but much more creatively as well. And that's just, in my opinion, going to create a really nice test case for how governments can use cryptocurrency and introduce really infect the idea across the world to the extent that other governments see the same benefits. We've also seen this not just in the case of legal tender, but other governments, Kazakhstan, for example, who are looking at Bitcoin mining as a way of growing economic activity within their countries. So there are different applications for how governments are getting involved, and starting at this level is a great start in the first place. We wouldn't have thought this would happen 5 years ago. So it's awesome to see.
Yeah, and Thomas, just lastly, I know you don't get into price here, but when we're trying to tease out some of these more in the weeds crypto projects to watch this year, I mean, it's been the L1s that really got away with things in 2021. All the hype was there, whether you look at Luna, the Terra Luna project, or you look at Avalanche or Solana even. I mean, when you look ahead, early on in the year, I was calling some attention to Atom and FTM. I mean, when you look at kind of how these things are being traded, though, I mean, what are maybe some metrics you're watching to say, all right, some adoption's actually coming to some of these chains, or maybe in the trading activity you see as well in terms of the diamond hands-ism, if I can create that word, around people looking at it?
Yeah, I think for us, again, like we're really focused on-chain signals to the extent that we can find them. We do publish a monthly on-chain report that dives into some of this activity. And what we're really looking for are activity, things like unique addresses holding the crypto, how many people are engaging on-chain transactions, what is the level of transaction activity, transaction fees, et cetera. But most importantly, all of these metrics are going to be a signal for demand and in the network itself. And and what it provides. On the supply side, just seeing the growth in terms of applications built on it. So, a lot of the DeFi applications, for example, on Ethereum are being ported over to different layer 1 solutions, and they might be tweaked just slightly to increase the relevance of that application or just increase the utility it provides. And so I think you're going to want to look at both, not only the signal of people using these chains, but also the signal of just applications and developer communities building around these chains, because that's going to really create that kind of network effect growth that you want to see to the extent that the networks are providing value.
Maybe some of that correlation will be put to the test in 2022. Maybe I'm optimistic, who knows, but we'll see what all plays out. Thomas Profumo, appreciate coming on here to chat. Kraken Digital Asset Exchange Head of Business Operations and Strategy, alongside Yahoo Finance's crypto reporter, David Holler. Thanks again. Going to take another quick break here on the show. When we return, from crypto back to banks, as we're watching some of those stocks get hit today after reporting their earnings. Again, JPMorgan still off more than 5%. We'll chat that with an analyst to dig into the numbers on the other side. Stay with us. Pressure continues to mount on big tech. Less to do with monopoly pressure this time around, as the House Select Committee investigating their role, big tech's role that is, in the January 6th insurrection, issuing subpoenas to get at big tech's impact on all the events we saw play out there. How that battle is shaping up for Meta, Google, and Twitter, and more companies really attached to that. I want to bring in Yahoo Finance's Rick Newman, who has a bit more in terms of what is going on there. And Rick, I mean, obviously there are some answers, and Congress didn't seem like they were getting enough of them. So this is the next step to take. I mean, what do you see playing out?
This seems like a pretty standard script to me, Zach. I think these companies do not want to hand over this information voluntarily, because it will just feed the myth that Donald Trump puts out there about these companies being biased against conservatives. What the committee in Congress obviously wants is they want to know to what extent did the people who rioted at the Capitol use these platforms, Twitter, Facebook, and so on, to communicate among themselves and perhaps share information that contributed to the insurrection there and made it worse. So I think these companies actually want a subpoena. I think they want to be able to say, we didn't want to hand over this information, but the government made us, and now we have no choice. That basically sets the stage for Congress getting what it wants, and gives the tech platforms, to my mind, a kind of a plausible deniability that they're voluntarily like putting some of these Trump supporters in the crosshairs. They can say we had no choice and we had to do it.
Rick, this comes on the heels of a big arrest we saw yesterday from the leader of the Oath Keepers in connection with this investigation. I mean, certainly it feels like Democrats are trying to ramp things up largely because there is a very limited timeline they can work with, right, with the midterms just around the corner.
Well, there are two tracks here. The first is this committee, which Democrats established. They obviously have a very slim majority in the House. So they established this committee with there is a wee little bit of Republican support. There are like 4 Republicans in the House who supported it, and 2 of them, of course, are on it, Liz Cheney and Adam Kinzinger. But there's a good chance Republicans are going to take the House in this year's midterm elections. And it's 100% clear that if that happens, they're just going to shut down this committee. So anything this committee publishes in terms of new information or findings, basically, unless there's some surprise outcome in the midterms, has to happen by the end of this year. That's the first track. The second is what the Department of Justice is doing through its normal legal channels. And of course, the Justice Department has longer. They have, I would say, at least the other 3 years of the Biden administration to pursue these cases. That seems like long enough to get these prosecutions going. So that will continue for several years. Who knows what's going to happen with the House committee after 2022?
All right, Rick Newman bringing us the latest there on the fallout still around January 6th. Appreciate that. Going to take another quick break. As I said, we'll be back with more earnings coverage here and the results from the big banks on the other side. Stay with us. Welcome back to Yahoo Finance Live as we continue to watch the market sell-off accelerate a bit. The Dow off more than 300 points here, getting dragged down by some of the big earnings news we got when it comes to the big banks there. I want to highlight the action we're seeing play out among those names. JPMorgan right now off more than 5%, despite the fact that they beat estimates on the earnings and revenue front, but the look ahead, not necessarily delivering any confidence there, as JPMorgan's Jamie Dimon is highlighting some more inflationary pressures that could bring some weaker performance issues later on in the year. Of course, you see some of the other names there, Citigroup as well in the red. Wells Fargo, rare standout here, up 3%, one of the only ones in the green in that space. And for more on what we did learn, I want to bring on Gerard Cassidy, RBC Capital Markets head of U.S. Bank Equity Strategy and Large Cap Bank Analyst here with us. Gerard, I mean, when we're looking at it, obviously, the big banks are what people look for kind of the sentiment around earnings. When you dig into the numbers, though, what do you make of what we heard? I guess we can start with JPMorgan just because that's the big one a lot of focus is on right now. What do you see there?
Sure. The actual quarterly numbers for all these banks, including JPMorgan, were actually quite good. But it's really the outlook is what people are concerned about. Particularly, JPMorgan highlighted that the operating expenses for the company were probably going to come in around $77 billion in 2022. And that was against our estimate of about $72 billion. And I believe we were around consensus for that number. Now, they also highlighted, though, that the revenue, net interest revenue, which is the revenue generated between what they earn on their assets less their funding costs, they also guided that up, though, 10%. So that was also a positive guide. But the focus has been on these expenses, and the expense growth that they talked about is driven by two things. First, compensation and salaries, and second, technology spending. So I think that's what the market is focused in on in the trading today is their guidance on expenses, whereas Wells Fargo, which you highlighted as being one of the few stocks that's up today, they've been on a cost savings program ever since their new CEO, Charlie Scharf, came on board back just over 2 years ago. And so their expense numbers and their guidance was much more favorable than JP Morgan's. And I think that's really accounting for the difference in the way their stocks are performing today.
Yeah, Gerard, how do you think we should be looking at that competing dynamic? On the one hand, you're talking about expenses going up, wage pressures going up, and yet we've heard from many guests on our show who've said financials are the place to be because as interest rates rise, net interest margins rise.
And I would agree with that. That's where we want to be, is in the banks, because there's optionality to the upside on revenues. Expenses are fairly well known for the banks. So when they give guidance, there's not too much of a variable when it comes to those expenses. But when it comes to revenues, they have to make some assumptions about where interest rates will be and where loan demand will be. And so when we look at the outlook for Fed fund rate increases, if they come in higher than expected, that will benefit the banks, of course. In addition to that, when the Fed fund rate increases come in, assuming they do, and we're sitting here, let's say in the third quarter results in October, and we've already had, let's assume for a moment, 3 Fed fund rate increases, there probably will be talk of further Fed fund rate increases, which will benefit the banks even more. So I think that's why you still want to own the banks. Days like today is when you want to buy them on dips because the outlook for rates is favorable. And also the loan demand numbers, and we saw this from JP Morgan as well, is loan growth is starting to accelerate, not just in consumer, but in commercial lending as well.
Yeah, bear with me in kind of pairing these dots, but I guess the story does matter, right? When we talk about kind of the drivers. And I'm thinking about Disney and the drivers there were kind of all streaming. And then now as we kind of shift over to reopening and now the parks business can be the thing, the big banks, we talked so long about kind of issues around what's going to happen with lending and the consumer side in the pandemic. And really it was kind of the trading and other activities that we saw come through and some big deals kind of on that side. Helping them weather the storm. Well, we'll use one example here in the green, though. I mean, it's a punching bag all the time, but Wells Fargo up today as they beat earnings too. I mean, as you kind of look at some of those strengths, as you see it with yields rising, which one of these do you think is best positioned to kind of deliver on the upside there as the story shifts among the big banks?
No, you said it well, and it's the diversity of the revenues that the big banks have. And JPMorgan even highlighted that on their call about the investment banking strength during the pandemic more than offset some of the weaknesses in loan growth. But in terms of asset sensitivity, which is a measure of who benefits the most from rising short-term interest rates, Wells Fargo is clearly the top of the list. And it's somewhat ironic that this cease and desist order that they were given in 18, which froze their balance sheet, has made them actually more asset sensitive because they can't grow the balance sheet to grow revenues, but they can make it more asset sensitive, and they've done that. And so the asset sensitivity now is working in their favor, and that showed up today as their guidance too was for greater revenue growth, net interest revenue growth, about 8% in 2022, which was higher than expectations, which is a contributor to why the stock is doing well today.
Gerard, Citigroup, another one of those stocks that is seeing some downside in the session today. We've seen the bank under Jane Fraser really try to reduce its consumer operations globally, more shuttering happening in 14 different countries. And I wonder on the other side of it, what that repositioning looks like. How do you view that stock?
That's a very good way of presenting the story for Citigroup. They're going through a transition. It's a refresh, as they like to call it, a strategy refresh. It's going to take time. It's turning around a aircraft carrier, not a speedboat. And so it's going to take time for the full benefits of what the actions that under Jane Fraser's leadership have already started that she has taken. For example, last night they announced the sale of their Asian businesses that they were planning to exit. The surprise this week also was the exiting of the Mexican consumer banking businesses. And so what the company is doing is trying to simplify the business lines, have economies of scale in the business lines that they're going to compete in, and those economies of scale will deliver higher levels of profitability. And then any excess capital that is created by slimming down the size of the company will be given back to shareholders through increased buybacks, which makes a lot of sense when the stock is trading at such a discount to book. So if we have investors that are looking out onto the other side at these price levels, Citigroup is very attractively priced and should be purchased.
All right, RBC Capital Markets Head of U.S. Bank Equity Strategy, Gerard Cassidy there, helping us break it all down. Appreciate you taking the time, sir. Be well. Let's take another quick break here on the show, but when we return, Getting Technical, our segment there, as Jared Blickery is going to walk us through why the markets might have a case of Fed indigestion, what that means. We'll cover it on the other side. Get them some Pipto Business Mall. Am I right? That's not the way I want to go out. We're going to take a break. We'll be back in 2. what is ailing the markets now? Perhaps a case of Fed indigestion. And to dig into that theory, you want to bring in Yahoo Finance's chartmaster Jared Blickery to get a bit technical here, standing by with a special guest. Jared.
That's right. We got Callie Cox. And Callie, you have a brand new position. You are an investment analyst at eToro USA. So congratulations on that. But we want to get to the market here. We've been teasing enough. What do you mean the market has a case of Fed indigestion?
Well, Jared, take a look at the market and you can kind of see what I mean. Markets are having a little bit of trouble processing this idea that the Fed might hike rates once or more than once this year. It could be 4 times based on Fed members. And it makes a lot of sense. Investors can feel the ground kind of shifting underneath their feet, and rate hikes do change the risk reward equation a little bit. So again, it makes sense that investors are really, taking time to process it. We look at the market though, and we see, a market that's really chewing through this. But whenever we see a market processing moves ahead of time, we think that could open up the door for more relief rallies once the Fed gets to the point where they actually hike rates.
Well, you've brought along a couple of charts here, and I'll let you kind of just navigate the show here. What do you want to prove, or what do you want to demonstrate with some of this material?
Yeah, definitely. Well, Jared, I see you brought up the TINA chart, and TINA is actually, there is no alternative, by the way, is what I'm talking about. TINA is actually one of the big concepts we're really, stressing on this year, especially to our customers, because right now the environment feels incredibly uncomfortable. And yes, we are processing a Fed that is likely going to make some policy changes this year. But at the same time, there's a lot of cash on the sidelines and not a lot of places for it to go. As you can see in the chart right here, if you look at the 10-year yield and adjust it for inflation, adjust it for CPI year-over-year growth, you're losing about 5.5% on average. And obviously that's very unattractive, especially if you're looking for more growth-focused measures. So that's going to be a defining theme in the stock market, we believe. And we're kind of seeing it these days too. Yes, the headlines are scary. Yes, markets are processing this, but at the same time, we're seeing money come in and buy the dips, these relatively shallow dips.
Yeah, and they're not buying bonds. We've seen that huge surge in bond yields, and it really kind of drives home this point that anybody in bonds right now is kind of losing their shirt. I want to head on to your next chart. This has to do with the Fed rate hike schedule. Let me clear this. And we can see this goes back to 1971. We got that huge spike up to 20% that was the short-term rate in 1980, 1981. And now we've been at near zero since basically 2009. So what are we to make of this?
Yeah, well, what we're telling customers too is to really step back when it comes to the Fed and think about what the story is. Rate hikes are inherently a good story for the economy. It shows that the Fed is confident in economic growth enough to ease up on the gas a little bit. And that's a great story for growth ahead. The fear here, and a fear that we understand and we hear a lot about, is the Fed losing control. And if you look at this chart, that's ultimately what's led to downturns in the past. The first few rate hikes that the Fed embarks on, especially if they're gradual, typically don't upend the market. In fact, the market hasn't gone through a bear market during the first few rate hikes of a cycle since the 1970s. And to me, that shows that, as long as the Fed is gradual, and we all know Powell's middle name is gradual, right? As long as the Fed is gradual, measured, and transparent on its policy changes, and really takes this economic growth and real-time data into account, then it should be able to guide this market into the next phase of policy changes. Of course, there is a risk of the Fed making a mistake here. There's always a risk. But again, this Fed regime is very gradual, and that's kept us very encouraged on the market this year.
Yeah, and before we go, we got time for one more. Just want to highlight those retail numbers, retail sales numbers we got this morning. Real disappointment on that front. We also have earnings season. So how are you putting all of this together? The big banks today, but eventually we'll get to those retail names too.
Yeah, well, the data was ugly today, not making it easy for the Fed. Retail sales was an especially ugly number, but we look at it and we see, one print and a sea of really, really good prints. And retail sales, not to explain it away, but they are contending with the fact that there was a lot of pull forward spending toward the end of last year with the fear around supply chain issues. So that could have been a number that could have been hard to quantify for economists. Big bank earnings, also very messy. Not a great start to earnings season, but we feel pretty encouraged on financials as long as the growth outlook looks good, especially considering consumers and corporates are kind of burning down on cash, and eventually they'll need to tap credit, and likely they'll tap credit at banks. But overall, not a great start to the earnings season. We think Wall Street is still underestimating companies, so hopefully that comes to fruition, because that would be great news for the market.
Yeah, and we are just at the beginning here, so a lot more to come. Callie, always great to see you here. Callie Cox, eToro USA investment analyst. Kicking it back to you, Zach.
All right, appreciate that, guys. Coming up, we're going to be digging into our social poll. We asked and you answered. What has you potentially weighing the idea of starting a new job right now? What our viewers said. The results on the other side. Stay with us. Welcome back. To wrap up the show today, a closer look at the phenomenon of big-time quits. Of course, we've seen that pile up as more and more Americans continue to do just that. And that was the topic of our social poll. In what we asked this week, we asked, what's the biggest reason you would start a new job right now? And maybe this isn't all that surprising, Akiko. More than half of our respondents said compensation. It's all about the big bucks out there, followed by flexibility and what we've seen around work from home and everything like that. Maybe not terribly surprising results.
Yeah, I mean, I have to say I was surprised at just how much more people said it was about compensation. Because we've heard so much from businesses, executives who said that, look, it is about flexibility. They're finding workers are increasingly looking for that kind of option. And of course, to back up here, the reason we're asking this question is because we've been talking so much about what has been known or come to be known as the Great Resignation. You look at the most recent numbers that came out from the Labor Department, a record 4.5 million workers quit their jobs in November. That number marked a near 9% increase from October. And as we look at the labor market right now, those job openings still outnumber the job seekers. Certainly a lot of workers have leverage. And it's interesting to me that compensation is the one, because it feels like there's a number of other factors that would lead to that kind of record number. One comment I should say, somebody saying that it was an option. It wasn't an option, but company culture was one reason why she quit. Another person pointing out relocation too. So certainly a lot of reasons out there that have led to that record number.
Yeah, I liked another one of those comments we got on there too, which was, "I do not want a job. I do not want to work," which kind of sums up.
Well,
just
that's
kind
not
of,
an option.
Yeah, it just kind of sums up where a lot of people are, I think, in this pandemic. And just shout out Maria for laying some truth into our Twitter poll there, just kind of around what might have you thinking about moving on at a time like this, you know?
Yeah, I mean, it's interesting to me to see how this is going to shift. Flexibility, I'd imagine, increasingly is going to be a factor, because there's a lot of employees who are saying, well, if I can't work remotely, I'm just not going to come back into the office, because there are plenty of jobs out there that allow me to work remotely. And then there is benefits too. That's another big one. And we're not just talking about something like healthcare. There's a number of companies out there that are offering up free college education, for example, as a way to bring in people through the door. So, that's certainly another thing that I think could increasingly become important for companies to offer.
Will I go ahead with the the comments that we saw there in terms of the quits here too? I mean, I would be remiss. It's kind of weird to be addressing this as part of the Twitter poll. One of the reasons there in the Twitter poll is exactly what led to this announcement here. But Akiko, as you know, it's the last show for me on Yahoo Finance Live today.
Zach, I was going to say, we didn't plan it this way, but somehow fitting that we're talking about quitting jobs on your very last day here at Yahoo Finance. And for those who've been following along, Zach, of course, joined Yahoo Finance in the fall of 2018 when we first launched 8 hours of live programming. And Zach, you've taken on a number of roles, right? The host of Wi-Fi PM, you got elevated to the senior dating correspondent. It has been an eventful ride, to say the least, and we could not let you go without taking a look back.
Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman. I have met some people on the Hinges and the dating apps of the world.
How was that?
Sophia, it feels like you're interviewing me right now, and I'm a little unnerved, but it wasn't. There are pros and cons to dating apps, I guess I would say.
I'm asking the questions now.
Oh my good sweet Lord. Dating expert Meredith Golden is here to help, and I actually gave her permission to totally revamp my dating profile. No, thank you, because you did this for me. We've got some before and after pics, obviously the before on the left, the after on the right here. You've heard about being in the hot seat, of course, but this time around on the business of cannabis, we found it only fitting to put you guys in the blazing hot box. There it is. We made a graphic. Do not cry, because it will not go your way. There you go.
But you
Kristen.
can cry, by the way, because it would be refreshing.
I never cry.
Oh, yeah. Well, I never show my emotions, so there we go.
Compared to the photo we just showed, this is highly unappetizing looking.
It looks a little bit different.
I don't know how I feel about this.
I feel like I'm on a Hinge date. How accurate? Oh my God, sweet Lord. Wow. That looks like me.
That's great. Whomst is this?
That is amazing. Oh my God.
Wait, so what painting is this?
This is
Zach's lovely face on?
This is Charles V, the Holy Roman Emperor.
Oh.
After his victory in a battle.
We'll see you guys in 2022. Cheers.
Happy New Year, everybody. Thanks for watching.
Zach, we were hoping you'd bring out the tux for the last show, but we have brought back familiar faces here. Of course, Heidi Chung used to be here at Yahoo Finance, and of course, Mackenzie Strategopoulos, who has been your producer by your side over all these years. I'm going to hand it over to them to give a few words.
Hey, Zach, surprise! I mean, we couldn't do a tribute without popping on and me showing my lovely face once again, right? I mean, that video was fun, but it also didn't capture the fact that you could also do such serious stories as well. I mean, CEO interviews, countless amazing interviews with movers and shakers in the industry. But I have to say that robot one is still one of my favorites. And just on a personal level, Zach, I wanted to say thank you so much. I mean, you were there for 3.5 years. I've been gone for a year and a half, but what people don't know is that you were always just so down to do anything, including chowing down with Chung. I made you eat some pretty questionable things on air, and you were always down. No complaints ever on that front. So I know whatever it is that you do after this, wherever you go, you're going to absolutely crush it. People adore you, and you always have smart things to say. So I'm so lucky to be here to pay this tribute to you. Miss you so much, and thank you for all your work.
You. Thank you, Heidi. I appreciate that. Amazing to have you on the last show, too. It's great to see you again.
And Zach, I'm going to pop in here. You got me to do something I've never done before, which is be in front of the camera. You know, I much prefer to be behind the camera. But as your producer, ever since Yahoo Finance Live went live, this is over 3 years ago now, I've been your producer. And like Heidi said, you've always been gamed for my crazy ideas. We had a robot bartender slinging drinks on Fridays for a little while. I got you to put a picture of your face on a painting. And so I just really appreciate not only you being just really good at your job, but also just being a great coworker and making me laugh every day. It's always been great to come into work with you, and I'm really excited for your next chapter.
You know, thank you, Mackenzie, and you have been there since the first day. It's a lot to take in here. I didn't know any of this was planned, but I watched Kristen Myers sign off in this exact seat, and now doing it here today is kind of weird. But obviously, hosting a show has been a dream of mine, and to do it with all you guys has just been kind of something I still don't really feel like I deserve to have done. You know, it's pretty wild to think that the dream did come true, but with all the team here. And I would go through all, obviously, this is just a few of them on screen, but to go through all of them, I know I'm going to miss names. But, you know, I can't thank you guys enough for helping me out, because it's not just what Akiko and I do on camera, but it's all the work behind the scenes beyond just our team, but everybody at Yahoo Finance Live. So I can't thank you guys enough. And lastly, to my compadre, Akiko here, you know, sometimes I wonder why the higher-ups paired us, just kind of given our vastly different areas of interest, but not once did I stop thanking the gods for them doing that, because it's been great to work alongside you. It made me so much better over the years, as did everybody here. And I really can't thank everybody enough for the work.
Zach, we are going to miss you all. I mean, all of us are going to miss you here. But I want you to promise us that you will come back with some dating updates occasionally. I mean, I don't know who's going to take over the role. I think Brian Chung maybe might step in. Is maybe dating correspondent, but not senior. He won't get that title yet.
I think as my dating history has shown, there's plenty of other people here who are much more qualified than I am to cover anything on that front. But no, it's been an honor, absolute honor. And I guess just lastly, to the most important, I guess, people for everyone in terms of all the work we do, to the viewers, for anyone who's ever watched anything that we've done, including, you know, even if you accidentally clicked on one of our interviews and stayed to watch it. It's been an honor to just do this for all of you guys watching out there. Can't thank you enough. Can't thank Yahoo enough. And the team, from the bottom of my heart, thanks again for the final sign-off. I don't know if I should do it, if you should do it, Akiko. Who wants to take the honors here?
Zach, I'm going to let you do the sign-off. One last sign-off for us.
It's sad to say the markets are in the red to sign it off, but appreciate everything that I've gotten to do here, and appreciate you all for watching. For Mackenzie there, for Heidi coming back even, for Akiko and for myself. Thanks again for watching, everybody, one last time. From Yahoo Finance Live here, stay tuned. Much more coverage coming your way right after this.
Earnings on deck, banks kicking things off. JPMorgan, Citigroup, and Wells Fargo split in their results, giving us a glimpse of how they navigated a fourth quarter filled with challenges. Is it a sign of the season ahead? Retail sales for December slumped by the most in 10 months. Is inflation finally catching up with consumers' wallets, or was Omicron the Grinch that stole Christmas? We'll find out what consumer appetite looks like moving forward. And new data show that 22 months after the pandemic hit, the restaurant industry continues to reel from its effects, with nearly 1 in 2 facing possible bankruptcy without federal support. We speak to an industry insider who is feeling the stress firsthand. Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christoforous. And I guess there is good news and bad news today. I guess, Alexis, the good news is it's the final trading day ahead of a long weekend. The bad news, I take your pick. You know, bifurcated bank earnings, retail numbers for December disappoint, and consumer sentiment near a 10-year low.
Yeah, I think Friday couldn't come fast enough, right? There you see it, stocks now at their worst level of the day, the Dow off more than 400 points. You mentioned consumer sentiment. It fell this month to the second lowest level in a decade as that high inflation starts to chip away at Americans' confidence. Also, production at U.S. factories unexpectedly fell last month, pulled down by that decline in output at auto plants because we still have that ongoing global semiconductor shortage. In the broader market, the S&P 500 down 33, the Nasdaq Composite off now 66 points, just piling on to the losses we've seen in big tech lately. Want to take a deeper dive, though, into the Dow for a moment, because that last check, I had about 6 of the 30 Dow stocks on the plus side. So we'll start with the winners, shall we? Microsoft, Chevron, P&G among the winners, but it is the financials taking a beating today after those mixed earnings reports from some of the big banks. JPMorgan in particular disappointing the street. That stock getting pummeled, down now more than 10%. American Express off or down, I should say more than 6%. American Express down more than 4%. Also on the downside, Walt Disney, Home Depot, Goldman Sachs among the big losers there. And as we see folks exiting equities, they are piling into the Treasury market. The yield on the 10-year rallying nearly 4% to 1.76% now, and the yield on the 30-year at 2.11%. Want to bring in Jared Blickery for more on the markets and see what is catching his eye today. Been a long week, Jared.
Yes, it has. And I think we could use a much-deserved break at the end of the trading day. I want to get to those numbers first. You were talking about the University of Michigan consumer sentiment number. So that came in, as you said, near a decade low, but it's really the inflation expectations that were catching my eye. 1-year inflation expectations are 4.9%. Now, remember that CPI is greater than that, 7%, but still both of those numbers are greater than the hourly earnings. And those gains, we have not seen anything close to 5%. So University of Michigan 5 to 10-year inflation, looking out, that's 3.1%. That is at odds with the Fed's goal of 2%. So just highlighting that the Fed is really in a pickle here. Also want to get to those retail sales numbers. The headline number was a big disappointment, negative 1.9%. So that was a drop, biggest drop since February of 2021. So last February, but it's also the control group. So it's kind of like how we talk about CPI and take out the volatile components of food and energy. Similarly, we have a retail sales control group that was down 3.1%. That's a little bit more concerning. So we have consumers retrenching, we have unemployment rising, we have inflation out of control from the Fed's perspective. What are we going to do about it? Well, let's take a look at the Wi-Fi Interactive. We got some charts here. First, I'm looking at the Treasury market. I'm with you, Alexis. Lots of action there. 6 basis points, pretty big move for the 10-year. I want to check out a chart here. And from the opening until the current, we've seen a rise in the 10-year today. Now, here's a 1-month chart. Let me actually put this on a 2-month chart. And there we see we are inching up to those highs we saw earlier in the week. Well, I want to get to some heat maps here. And all of the action today, at least to the upside, has been centered in energy. Tech actually was positive, if ever. Well, actually, it was positive most of the day. It has flipped to negative. But inside the energy sector, we're going to take a look at that in about 30 minutes, or excuse me, an hour and 30 minutes. I'm not going to do a deep dive just yet. Want to note that real estate, financials, materials, consumer discretionary, all of these sectors here are down by more than 1.5%. And here are those bank numbers that we're looking for. JPMorgan down 6%, worst earnings reaction since 2011, more than a decade ago. The trading was just horrendous for them. It wasn't horrendous, but it was disappointing from an investor standpoint. Citigroup, similar problem. They're down 2%, but bucking the trend here is Wells Fargo, and they came up with a number for net interest margin of 8%. That is a huge, huge number. And just look at what Wells Fargo has done over the last year. They broke out within the last month, and I believe they're testing record highs as we speak, but not there quite yet. I want to also look at Chinese stocks, and here we go. We did see some positive movement today. This is a sector we've talked about so much over the last year, getting beaten down, but we are seeing a little bit of a mixed picture here. So JD.com up 1%, Pinduoduo up 3%, but Yum Brands China down 4%. And finally, for the tech stocks, they were beaten down earlier, and ARK Innovation Fund, a lot of its components are still beaten down here. DraftKings down another 6%. The old Square block, that's down 5%. Spotify down 5%. Just take a look at what's happened in the first 10 trading days of the year. Some of these stocks knocked off nearly 30%. Just look at Roku there. So sending it back to you guys, but not the best way to end the week.
Not the best way at all, Jared. Thanks for that breakdown. We'll see you a little bit later on in the show. I want to stay on the markets and bring in our guest, Ava Ottos from ER Shares, the COO there. Thank you so much, Ava, for being with us. I want to turn your attention, first of all, to the bank earnings that came out, and Jared touched on them just a second ago. Wells Fargo sort of bucking the trend today and coming out stronger. It said loan growth based primarily on consumer borrowing increased, and that it also made huge cuts in its cost and its expenses. On the flip side, JPMorgan said that investment banking did help it, but it had a big miss on equities trading, and it was helped along by that $1.8 billion loan reserve release. Otherwise, EPS would have missed street estimates. So my Citigroup, similar sort of thing there. So I'm wondering, my question is this a harbinger for the rest of the banking sector as their earnings roll out? And have we seen the peak in banking?
I think it's a lot of company-specific information. As you said, we have more news towards the downside rather than the upside, but Wells Fargo is up. So, and as you said, we see in some cases, such as First Republic down because of unforeseen expenses, JPMorgan, same issue. Then you have BlackRock down because of missing revenue. So it's mixed results. Overall, we do like the financial area because of the inflationary environment, and these companies are able to pass along cost increases associated with interest rate hikes. So we continue to like financials as we move on into 2022. There's one company that we have on the spotlight, that's Signature Bank, and it's a hidden gem because that company combines an inflation hedge, a commercial bank, and also a fintech play all in one. So you get the conservative inflation value-oriented bank side of it, but also it's a leader in fintech. It's one of the few solutions that allow peer-to-peer over immediate clearance of payment. So two companies under their umbrella can transfer money and clear instantly 365 days a year and 24/7.
Would like to get your take on what's happening in the Forex markets, because I know the dollar has been trending lower. It looks like it's higher today, maybe snapping that 3-day losing streak, but just by a little bit. So how does a declining dollar play into a portfolio allocation right now?
That's exactly right. So as we think now that we're moving forward, that we might see more and more funds flows towards non-US equities. And the reason is, as you mentioned, the dollar declining because of two reasons: rising interest rates and also rising trade deficit. The other reason for that is the fact that the relative valuations when it comes to international investing are much more attractive. So both those reasons make international markets and emerging markets very attractive. And the trend has already started. If you see at year-to-date numbers, the 40 largest French companies, the CAC index, is outperforming the S&P 500 by 2.5%.
So I want to turn your attention to inflation. Obviously, we just got the latest handle at 7%. Do you see that as a peak or does it go higher? And then how many rate hikes do you envision? We just had Lael Brainerd at her confirmation hearing saying hike in March.
We believe that inflation is peaking, but we're very concerned when it comes to interest rate hikes. The 10-year and the 30-year both increased by 1/3 over the last month. That's a significant increase, and that happened without the Fed taking any specific action. So what we're most concerned is not how many rate hikes the Fed will actually implement, rather than what's going to happen when the Fed tapers back to zero. So they have been buying $120 billion of US debt a month. That is soon going to end. So the question is, who is going to buy the US debt? And in the absence of foreign buyers, that the interest rates can skyrocket.
Outside of energy and outside of financials, what else do you like right now? And is there anything in particular that you are unloading or staying away from?
As we see 2022, we believe the first part of the year, we will see slow and steady win the race. And by slow and steady, I mean companies that are more conservative, not just in financials or energy, but in general, any category, more conservative, modest PEs, and very good revenue, cash flow generation. And that can be found in financials, also in some technology pockets, some very cash-rich, mature companies can offer an inflation hedge if you see it from the fact that they're not dependent on external financing. So that's very important when it comes to an inflationary environment. So there are some technology companies that we do like. And for the latter part of the year, as the yield curve, we believe, will start flattening, then we'll see investors embrace more risk and a return to growth assets.
All right, we'll have to leave it there. Thank you so much, Eva Ados, ER Shares COO. Thanks for your time today. And you can step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. You can check it out today at yahoofinance.com/plus. And much more ahead. Hospitals continue to feel the colossal weight of a surge in Omicron cases. We'll ask a doctor how the healthcare system is holding up. Stay with us.
The Supreme Court blocked vaccine mandates this week for big private businesses, but allowed it for healthcare workers at facilities receiving federal funding. But is it enough to save an industry already under tremendous strain? Harvard Medical School professor Dr. Ali Raja joining us now to discuss this and the latest in the ongoing pandemic. Doctor, good to see you again. President Biden yesterday promising to deploy military medical teams to 6 U.S. states as they deal with extreme staffing shortages. Is that enough? What should be, what could be done to alleviate these issues at our area hospitals?
Alexis, thanks for asking. It is a start, but it's not nearly enough. We have so many staffing shortages across the country. I've got to tell you, we've had the Massachusetts National Guard here at Mass General for the past few weeks, and they've been so helpful and so great. But it is just a little bit of help when we need a lot more. The fact is that with Omicron and the number of breakthrough cases that we have with it, even our fully vaccinated and boosted staff is getting sick. And while the symptoms are almost always mild, we need to be out for at least 5 days. And so that's making it really hard to staff our hospital and our emergency department.
How worried are you, doctor, about the influx in hospitalizations? Because as we know, hospitalizations lag cases. And while cases are dropping in some parts of the country, they're still going up in other parts. And that means hospitalizations will continue to go up before they come down.
Karina, you're absolutely right. There's a lot of data out there that shows that in some states, overall prevalence of COVID might be plateauing out. But that doesn't mean that the patients who are unvaccinated or the patients who are elderly or have medical comorbidities won't continue to come into hospitals. And I've got to tell you, our numbers have not plateaued. Right now, today at Mass General, we have about 260 patients admitted to the hospital. That number has not plateaued. It has not dropped. So even if we're starting to see some of that plateau in and around Massachusetts, the hospitalizations are still on the rise.
Doctor, I'm sure you've seen the reports that some hospitals are in such dire straits, they're calling back COVID positive personnel who are asymptomatic. I know they put on all the protective gear, but does that make sense right now? And is that truly how bad things are?
I think it is reflective, Alexis, of how bad things are, but I still don't think that makes sense. But what I think it is it's reflective of the desperation that our hospitals and healthcare systems currently are in a state of, because we need to staff these beds. We have sick patients coming into ICUs, to medical and surgical floors. They need nursing and physician and other clinician care. But it just doesn't send the right message to staff to say that even when you're still testing positive, come in, because the biggest and most important thing to our staff is we want to help people get better. We don't want to put them at risk of maybe asymptomatic transmission.
Now, doctor, it also kind of flies in the face, right, of the federal vaccine mandate for healthcare workers that they do need to be vaccinated. And then, of course, on the flip side of that, the Supreme Court then just blocked President Biden's push to make sure that all big corporations make sure their employees are vaccinated. So I'm wondering how much confusion on the healthcare side, for me on the consumer sort of side, trying to navigate it, it's completely overwhelming and confusing. But even on the healthcare side, doesn't it pose a lot of sort of chaos and just it's confusing?
It is, Karina, and you're absolutely right. I think that when we all thought that OSHA mandate would be enforced, it made a lot of sense. It's really disappointing, actually, that it was blocked because, quite honestly, it was very smart. It required vaccination, but it allowed for mask wearing and weekly testing if for some reason you couldn't get or chose not to get vaccinated. So it made a lot of sense. Now, with that being blocked yesterday, a lot of healthcare workers are really puzzled, especially because we know how much Omicron is disrupting workplaces all over the country right now already. And not having that vaccine mandate just doesn't make sense.
Dr. Raja, what about the need for these Omicron targeted shots that vaccine makers say they are now trying to come up with? Is there evidence out there that supports the need for these tailored doses?
I don't think so, Alexis, not just yet. Now, the concept of having targeted vaccinations and targeted boosters for specific variants makes sense. But what we've seen with Omicron is actually that the current surge has likely peaked or is peaking. Hospitalizations, as we already talked about, haven't peaked yet. But if this current surge is going down, what we probably need is actually the shot specific for the next variant rather than the one whose peak has likely already come or passed.
And then, Dr. Raj, I want to ask you really quickly, when is it time to pivot and turn this from a pandemic to an endemic? We've already seen some countries in Europe making that push. We've sort of heard it a little bit here and there, but it hasn't been something that has come out of the White House. It's not something that they've really pushed forward on. But when does that happen? When's the right time?
Well, Karina, one of the things about a pandemic is that it's not just about the number of cases, but also the potential for overwhelming the healthcare system. And we are still there. If we could get our country to a point where the vast majority of people had not just vaccines, but also boosters, I think we could get to the point where when there were breakthrough cases, they would have hopefully mild symptoms and we could get along with our lives as normal. But when we're still in a situation where a lot of unvaccinated patients can end up so critically ill and potentially overwhelm the healthcare system, we're definitely still right in the middle of a pandemic.
And doctor, real quickly before we let you go, what is the key to keeping our kids safe in school? We see school attendance way down across the country as parents hold their kids back and they're not sending them in.
It is absolutely, without a doubt, testing. I'm fortunate to live in a town where our public school system has a lot of rapid tests available. Both our kids in two separate grades, 4th and 2nd grade yesterday, we got emails that they had a close contact, but they're in a test and stay program where they'll keep going to school and getting tested every day. Unfortunately, that's not available at most school districts in the country, but that's what we need is testing.
All right, Dr. Ali Raja, thanks so much for making time for us today. Coming up next, a conversation with the CEO of Snowflake, Frank Slootman, who's going to talk about the leadership game and how to get yours on.
Welcome back to Yahoo Finance. Well, looking to level up your leadership game, Snowflake CEO Frank Slootman sat down with Yahoo Finance Live to discuss his new business management book, in which he makes a case that most leaders can improve performance without making costly changes to the company. Take a look.
Yeah, well, the reason that we wrote the book is that, as you pointed out, we've had 3 successful companies over the last 20 years, and we have this flood of incoming requests for what do you guys do? What's the secret sauce? What's the playbook? So this is really our attempt to create as much insight from our perspective, as to, okay, look, this is how we think, this is how we, how we do things, and hope you like it. Try it out for size and see if it fits, and we'll go from there. But the message is for CEOs. I mean, that's the title of the book, Amp It Up. There's incredible room. There's a lot of slack in organization to, step up the energy, step up the intensity, step up the pace, raise your standards on everything, and it sort of unleashes that X factor in an organization where everything goes faster and quicker and better, and we sort of lose that feeling of swimming in glue and moving like molasses. So it's right underneath, it's right in front of you, but you sort of need to tap into it very deliberately.
Frank, I cover a lot of companies here, and my sense has been over the past year or so of the pandemic, a lot of them are just settling. They're settling for okay. It's okay just to have a warm body in the seat, as long as that warm body is there. But should a manager in this environment use this opportunity to just rid themselves of slackers and just start rebuilding the companies from the ground floor to come out of the other side of the pandemic?
Well, you should always be doing that, right? I mean, raise the standards, drive the intensity and the pace, have high standards all the time. It's a not now type of issue. It's an always type of issue, right? I mean, leaders are going to set the pace, right? Leaders are going to set the standards. It's really important if you want to attract and retain talent that you have an environment that is highly energized, unpolitical, apolitical, all these kinds of things. Otherwise, you just can't hang on to people. People don't want to be in companies where, they're surrounded by, mediocrity and slowness and politics and difficulty. So it's in your interest to do this all the time, every time.
Hey, Frank, it's Julie here. I'll take the other side of that. How does humanity fit into this picture? In other words, we're coming through a year where maybe, to Brian Sazzi's point, companies are settling to some degree, but we're also coming through a couple of years where people are exhausted by the external factors that are out there. So how do you balance that with demanding that top performance from people?
Yeah, people do get exhausted when you work in companies where everything is difficult and hard and political and slow and uninspiring, I would say, because we're just not aiming for anything great. That's what makes people tired and exhausted and looking for for other pastures. So you keep the energy up, you keep the pace up, people are going to have a much better time at work. Now, is that for everybody? Maybe not, right? But culture sorts, right? It sorts people in terms of the people that like it and people that are like, well, this is really not my cup of tea. I mean, we're not really declaring here it's sort of one size fits everybody. But when you're in a high growth environment, yeah, it is a very energized, high pressure undertaking. There's no getting away from that. We do mitigate that a lot. At Snowflake, we make sure, because people have twice as many meetings a day as they used to have because of Zoom. So we're very aware and dialed into the fact that fatigue sets in, and we always tack on extra days to holidays between Christmas and New Year's. The whole company around the world got the whole week off. So we were trying to create these hiatuses to allow people to sort of recharge and recuperate a little bit. So I mean, your point's very valid, but at the same time, high growth companies, I mean, it is a pressure cooker.
Frank, you talk about in the book how, as a teenager, you were cleaning toilets and you rose the ranks to where you sit today. As you look at the next generation of leaders in corporate America, do you think they still have that drive and that hustle?
I actually think they do. Just a couple of weeks ago, I was at a retreat for founders and CEOs that was hosted by one of our investors, and I saw 70, 80 founders, CEO people. They were pretty much half my age, which was another revelation. But I was there for 2 days and numerous conversations, with these guys and gals. And it just sort of left me completely rejuvenated that these people are the same. There's nothing different. I mean, we put labels on them in terms of generation this and generation that. They're not different, from the generations that went before them. As best as I can tell, they care about the same things. They have the same preoccupations. So I sort of walked away from that thinking, we're going to be all right.
Frank, tapping into your, let's just say your veteran standing in the industry, we've seen a real sell-off in these software stocks on interest rate concerns. And someone that has seen a lot of cycles in software, are you seeing anything in your business that would that would warrant these types of sell-offs we're seeing in software?
No, not at all. As you guys well know, the stock market short term is a voting machine, and obviously that creates opportunities for people to get in at a reasonable price. Over the long haul, the stock market always gets it right. So that's what you worry about. The short-term preoccupation is not helpful. I always tell our employees, look, the only stock price that matters is the one you sell it. Everything else is entertainment.
U.S. restaurants are struggling as the pandemic continues. In fact, a new survey out by the Independent Restaurant Coalition shows that out of nearly 1,200 businesses, 42% say they are in danger of filing for bankruptcy without federal relief. With more on that, we are joined by Gabriel Stuhlman, CEO and founder of Happy Cooking Hospitality. That's a restaurant group based in Manhattan's West Village. Also joined by Yahoo Finance's Danny Romero. So Gabriel, thanks so much for being here. I know that your group has 4 restaurants. Now that the winter has set in and outdoor dining is not really so much an option anymore here in New York City, what are you seeing in terms of demand for eating out?
Well, for starters, Alexis, thank you very much for having me on. And thank you for shining some light on this very important subject. To directly answer your question, what are we observing right now? And I would say for the last 4 weeks is a massive slowdown in dining. We're seeing that for a multitude of different reasons. We're seeing that as a direct relation to Omicron. We're seeing that because some of our staffs that are vaccinated and boosted are still contracting the virus, and we are being forced into situations where we don't have enough staff to open the restaurants. We're seeing a slowdown, and so that would result in a slowdown. We're seeing it as a result of diners canceling parties, canceling New Year's reservations plans, canceling holiday plans, a slowdown in diner interest. And then exactly as you pointed to, with the temperatures dropping, a lot of diners that were more comfortable dining outside that option's also being removed away. So we're seeing a massive drop off as a result of Omicron and the continuation of this pandemic, unfortunately.
And Gabe, it's Danny over here. Restaurants have done so much to really adapt. You kind of highlighted that, right? That from takeout only to outdoor dining. But I guess how much more can the restaurant industry really take, especially under the circumstances we're in right now?
Not much more. And I don't think that is unique to restaurant industries. I mean, we look at what's happening in hospitals and nurses and medical professionals, and you look at what's happening in transportation and, all of the trucking. Like, people are fatigued. I don't think that this is a matter of continuing to look at restaurateurs and ask us to keep pivoting and innovating. We've been doing that, and we have demonstrated some of the most amazing grit and fortitude and perseverance amongst most industries in this country throughout this pandemic. There's not much more we can do, right? What we need government support. We need the government to replenish the Restaurant Revitalization Fund. We need them to make good on what was so far an empty promise. Over 200,000 restaurants that initially filed for the RRF are left without it. That is 2/3 of the applicants. And so essentially, by the way that the government has fumbled the RRF so far, it's created a situation of winners and losers. And those that have the financial support that the RRF was supposed to provide are in a much more secure position to pay backlogs of rents, to keep their employees employed through slowdowns of dining, to not have to go through layoffs, to be able to continue to offer competitive wages. And those that don't, the 2/3 that don't, are left behind and at risk of closing. And when we are at risk of closing, it has this massive domino effect, right? Sorry to interrupt. Please go ahead.
No, I was just going to say that, I think it's also important to note, at least in the reporting that I've done when I've spoken to restaurant owners, they're really trying to do their level best to keep businesses open because they recognize they have a responsibility to their staff and to their families as well. So some of these owners, it's not just affecting their own business, but it's affecting their personal finances as well, right? Some of them declaring bankruptcies, so many taking on additional debt.
You're absolutely right. And I love the way you framed that, actually. How you said so many restaurant owners feel a sense of responsibility to our teams. I wish our government felt that same sense of responsibility to us as businesses and citizens and the impact that we have on this economy. It would be great to feel the responsibility sent back to us that we give to our teams. You're absolutely right. I mean, people that did not get RRF are taking out personal loans. They're literally taking on new investors and liquidating themselves out of their own businesses. They're trimming down and canceling services because if you can't get enough of a healthy staff or you don't have enough of a dining population, we are eliminating breakfast and lunch services and only going towards dinner service, which is chopping at revenue. And the more that we chop at revenue, then we buy less. We buy less beverage. We buy less coffee. We buy less dairy, fruit, fish, meat. And when we buy less, then the third-party distribution companies, they've got less work to do. So then they're laying off people. And then the farmers that they buy from are selling less product. It's the trickle-down effect of a restaurant shrinking goes so beyond the waiters, bartenders, and cooks. And there is this blind spot that the government, I don't think, is recognizing about how restaurants generally, 90 cents out of every dollar goes back into the economy in one way or another. And so when you give us RRF, it actually goes out to everyone else in one way or another.
And Gabe, let's just say the Restaurant Revitalization Fund does get replenished, right? What do you expect? What changes need to happen? Because according to reports, it seemed like there was a mishandling on how and who got those funds first, right? So what are you expecting this time around? Can you wrap that up real quick?
Yeah, I mean, just at a very basic, I just think the nearly 200,000 applications that were in the portal before it expired should just be funded at the same pro rata rate that everyone else was. It creates some equality and equanimity. It allows us to all offer competitive wages to people. It allows us to all survive through this downturn. The reality is we are still in a crisis. It's not over. People are at home. People are getting sick. Staffs are wearing masks. We're requiring proof of vaccination. These are not signs that this thing is over. So we just need to make good on everyone else and recognize that the impact that restaurants have on the economy as a whole is so much greater than our immediate staffs.
Thanks for outlining all of those challenges you and your industry continue to face. Gabriel Stuhlman, CEO and founder of Happy Cooking Hospitality. Thanks so much and good luck to you and your staff. We know the housing market has been red hot, but what about the outlook for the luxury home market? We speak with the CEO of Sotheby's Realty next.
Welcome back to Yahoo Finance. Well, the housing market was on fire last year, and thanks to low inventory and wealthy home buyers flush with cash, 2022 is set to be an even bigger year, according to a new report from Sotheby's International. Here to discuss the outlook for the luxury real estate market is Philip White, Sotheby's International Realty President and CEO. So thank you so much for being with us today, a real treat. You know, there's this famous line, greed is good. And you say the only thing that can derail the luxury market right now is greed.
Well, you know, people, do look at it that way. I mean, there's just great opportunity, continues to be great opportunity in the real estate business, particularly the luxury side. What's interesting about the pandemic is that really the luxury side of the market led us out of the pandemic in 2020, and it's really never stopped. So the sellers are taking advantage of, a really strong real estate market. Yes.
Philip, I know mortgage rates are ticking up. In fact, they hit a two-year high this week, the 30-year mortgage now topping 3.6%. But I'm wondering if higher borrowing costs really have that much of an impact when you're talking about the high-end luxury home market and higher wage earners. What's the correlation, if any?
Well, it's kind of a double-edged sword in a way. Of course, interest rates matter significantly. They matter in terms of the upper end market because it impacts the stock market, the equity markets. Because many of the buyers for luxury homes, they may not be borrowing that much money, but they're tapping into their investments and borrowing against those on occasion. So it does have an impact, but with the higher rates, due somewhat to inflationary pressures, with real estate, it's a tangible asset. So some of that inflation actually goes into the price appreciation. So, it's not necessarily that big of a negative impact, particularly with these historically actually very low interest rates.
Overseas investors have always looked to the U.S. to make investments, and China has been very interested in U.S. properties, but they have clamped down on overseas properties. So I'm wondering, what is the overseas outlook? How much foreign investment are you seeing, and is it coming from different areas now?
Well, international buyers into the United States last year were down about 27%. Year over year. So there was, given the, borders being shut, airline travel being curtailed, it really did impact the international buyers. However, we've seen evidence that they are coming back. This latest round of Omicron is not helping that. But actually in 2022, we really think the international buyers will be re-entering the market here in the U.S.
I'm wondering what you're hearing from clients about some of their biggest concerns. We know there were a lot of folks who want to see the repeal of that $10,000 SALT deduction cap, namely in big states like New York and California. Tell us about what some of their big concerns are right now as they head into the market.
Well, we still hear that. I don't think it's been as big an impact to the market as maybe we thought it would be. However, it has certainly encouraged people to move to the no state income tax states like Florida, Tennessee, Nevada, other places like that don't have a state income tax. So that has really fueled that. I know that the big states, California, New York, New Jersey, certainly are trying to fight the SALT and repeal that. So that would be very beneficial to the real estate market if that were to happen.
Sir, I wanted to ask you, are you seeing a lot of wealthy people come in and buy second homes, maybe for a family member? And what they're doing is taking out money out of their portfolio, taking a cheap loan, paying all cash deals, which are also helping driving up the market. And, they get out of paying high capital gains taxes.
Yes, we certainly see that. And the evidence also is that, millennials are becoming a bigger part of the real estate market. We've been waiting for them to enter the market. There were about 4.8 million millennials that turned 30 in 2021. So we really are starting to see much more activity from that group of buyers. So yes, we are seeing, families actually buying properties near one another. So there's a lot of activity in that respect.
All right. Well, the market is certainly on fire. Thank you so much for stopping by, Philip White, Sotheby's International Realty President and CEO. We're going to take a quick break, but on the other side of it, much more ahead. Coming up, we finally know who the nominees are to fill the open seats on the Federal Reserve Board. Find out who they are.
Welcome back. President Biden today announcing his picks to fill 3 top spots on the Federal Reserve's Board of Governors. Our Fed correspondent Brian Chung here now with those details. So Brian, who are these nominees and exactly what would they bring to the table right now at the Fed?
Yeah, well, I've been waiting for these picks for about a month now. The Biden administration had originally promised to name the 3 picks for those remaining vacancies back in early December. We only finally got the news in the middle of January, but the names are Sarah Bloom Raskin for the Fed Vice Chair of Supervision role. She would actually be, this would mark a homecoming for her because she used to be a Fed governor. She was there after the great financial crisis for a few years. And then for the other 2 positions, Lisa Cook, a professor from Michigan State University, as well as Philip Jefferson from Davidson College. This would be interesting because if Lisa Cook is confirmed, she would be the first Black woman to serve as a Fed governor in the Fed's over 100-year history. Philip Jefferson would also be, I believe, the 4th Black male to ever serve in that role if confirmed by the Senate. Again, all 3 will have to go through Senate Banking Committee confirmation as well. We saw that Jay Powell for his 2nd term as Fed chair, as well as Lael Brainerd for vice chair, had their hearings earlier this week. But if they are confirmed, it would make up for a fully loaded 7-member board of governors that would be very much diverse, again, because of the unprecedented nature of specifically Lisa Cook's nomination. We spoke earlier today to Betsy Duke, a former Fed governor who served, by the way, alongside Raskin post-Great Financial Crisis, with regards to the importance of diversity. Take a listen.
It's always been really important to have diverse voices around the table. And I think these picks are notable for that reason, not just in that they bring a different perspective, but also that, future economists, future Fed governors, people who are maybe in high school now or just getting ready to go to college will look at this and say, that's a possible career for me. And the economics profession in particular has been not very diverse for quite some time.
So Duke saying there that this could actually set up for more diversity in generations of the Fed boards to come. Very interesting to see that highlighted as well. Again, we'll see what the Senate does with these nominations now that they're official, guys.
Hey, Brian, and then will you zoom in on Raskin for us? As you said, she's no stranger to the Fed before, and she is taking on a top regulatory role. And then when, if all going well, do we see these confirmations come to fruition?
Yeah, this is a really interesting question because that Fed Vice Chair of Supervision role has specific purview over the way that the Federal Reserve supervises what is kind of the most important, seen to be one of the most important roles in D.C. with regards to bank regulatory policy, because the Fed is the primary regulator for the nation's largest banks like a JPMorgan Chase or the other banks that reported earnings earlier this morning. So Raskin has experience with regulation. When she was at the Federal Reserve as a governor, she worked with Betsy Duke, whose clip we just played earlier, in the implementation of the post-crisis Dodd-Frank financial regulatory framework, in addition to some other international rules like the Basel Capital Accords. Now, Raskin would be very much in the same role if she is confirmed as Fed Vice Chair of Supervision, but could be different types of issues that come to the table in this new Fed because of the fact that there is a priority on not just the way that, for example, the Fed considers racial wealth gaps in this country, but also with regards to climate policies, because we know there's been a little bit more fixation on the risks of climate change to financial regulation and bank capital. So that could indeed be something very interesting to watch as well. As far as the timing of all of this, your guess might be as good as mine. It's customary for the Senate to wait about 2 weeks after receiving the official nominations to hold a hearing. So at the earliest, we can see a hearing perhaps in the late part of this month or early next month.
Okay, we'll be watching. Brian Chung, thanks so much. Let's get another check of the markets because investors having to deal with a mixed bag of bank earnings today, also a miss on retail sales. And here's how it's playing out with the Dow off now more than 360 points, was down more than 400 a bit ago. S&P off 25. NASDAQ trying to make a comeback, now down just 25 points. In the next hour, we're going to dig a little bit deeper into President Biden's Fed nominations with Heather Boushey of the White House Council of Economic Advisors. She'll also weigh in on inflation and a whole lot more. So do stay with us.
President Biden has made his picks to round out the Federal Reserve Board. We speak with Heather Boucher from the White House Council of Economic Advisors on what the move can do to help tame red-hot inflation and falling consumer sentiment. The Supreme Court blocked vaccine mandates for big business at the federal level, while the White House takes the defeat. The Hispanic Business Council calls it a victory for its community. We'll ask why. A new report finds college enrollment across the board has dropped sharply since the start of the pandemic as the cost of tuition drives some students to just sit it out. Our expert crunches the data. I'm Karina Mitchell along with Alexis Christoforous on this Friday afternoon. It is a sea of red on Wall Street as earnings season kicks off. Bank shares retreating after big guns JPMorgan and Citigroup failed to impress. Here with more on what's moving markets, let's bring in our Jared Blickery. And Jared, first, I want to take a look at week 2 of 2022, and it is not looking pretty.
No, and in fact, energy, if we go to the Wi-Fi Interactive, I'm going to put a 5-day view, and energy is the only sector in the green here, up notably 4.5%, by far and away the outperformer, and just continuing the strength that we saw in the first week of the year. Now, to the downside, real estate is the biggest underperformer. That could be a function of rates, and then we have consumer discretionary with stocks like Amazon and Shopify. Then we have utilities, and then financials. Financials are those big banks that we're reporting today. I'll just show them real quickly again for an update. JPMorgan down 5%, Citi up 1% this week, by the way. Wells Fargo up 5%, but Citi down for today, as JPMorgan is as well. But I want to take a look at the energy sector because that is where the gains have been centered. And this is a 5-day look. I'm not going to spend too much time on here because we can do a deep dive in 30 minutes when we cover the oil close. But I just wanted to point out we do have a number of names up considerably here. And if you look at the 10-day, this would be 2022 to date, Occidental Petroleum up 20%. Also want to get a look at the ARC components because those have been flagging. This is the 10-day view. Here's the 5-day view. Only Tesla in the green here, along with one other stock. There we go, Exact Sciences. But I just want to sort by performance, and you take a look at the bottom row. This week alone, NTLA, that's Intellia Therapeutics, down, 16%. So some more heavy losses for the ARC Innovation ETF components. And then we got to take a look at the travel sector as well, because the sea of green in there, it's a sea of red with some bright spots. Those green spots are the cruise lines. They had a decent day a couple days ago with some positive news from the CDC. But for the most part, a lot of these stocks in the red, especially the hotels, Marriott, Hilton, and Hyatt down 3% to 5% respectively. All three of those stocks either at or very near record highs recently. And then finally, we got to take a look at the meme stocks, which got slaughtered this week. Not a lot of green there. Some of the old stalwarts like AMC, they're down 11%, GameStop down 17%. The worst performers this week, let's check out Naked Brands. That's down 34% over the trailing year, down 62%. And you can imagine off of those highs even more. Another stock we want to take a look at, finally, here is Virgin Galactic. That stock down 20% this week, 70% over the trailing years.
And then, Jared, some woes for tech geeks. Apple's hotly anticipated headset risks being delayed until next year.
Yes, and so let me get the details on that. That's pretty interesting. Apple had this mixed reality headset. Now, this is going to be blending virtual and augmented reality. They were going to announce it at their Worldwide Developer Conference in June, but people inside the organization talking to Bloomberg, this is an exclusive for them, say that's not going to happen. They may push the announcement to the end of the year, and that means that they're not going to hit shelves by 2023. Now, all of this is predicated on Apple coming up with one of its next big things. They haven't done that in quite a while. We had the AirPods several years ago, and not anything major since. But this is a device that they see eventually replacing the phone, the iPhone. Everybody's going to wear glasses around, I guess. I'm not sure exactly how it's going to work, how the tech is going to work out, but you got to imagine these things are going to get a lot smaller. Also, I just want to add here, Apple recently said that their supply chain partners that this device probably not going to release until 2023. So that's more confirmation of the delay. And then also I want to add that in total, they're probably going to list this thing for $2,000 or more, only expecting to sell 1 unit per day per Apple retail store, maybe 7 to 10 million its first year. But at that price point, you know it's going to be a luxury item. By the time it becomes the next iPhone or replacement for it, hopefully be a little bit cheaper.
And then, Jared, this is a company that was red hot a while ago and then sort of lost relevance. But Yahoo Finance Plus's investment idea of the day is a bullish call on Abercrombie and Fitch as the store shifts to digital.
That's right. And we have this coming by way of Yahoo Finance Plus. We have a research report that was distributed to subscribers. And let me just pull up a chart here, and then we'll get to the reasoning behind Argus research. So here's a 1-year chart. You can see over most of this time, basically trading sideways. We did have an exciting breakout towards the end of the year, lost steam, lost a lot of momentum. But you said it was a high flyer. And in fact, it was from the pandemic lows to up here. It was one of those. Now, here's what Argus Research is saying today. Now, they have a long-term price target of $42. They're saying that recent weakness offers a buying opportunity. Shares have underperformed over the past quarter, falling 12% compared to a 2% gain for the S&P 600, and that would be the mid caps, and a 3% advance for the industry. ANF has shifted its focus away from the physical stores and toward digital sales. They now account for about 50% of revenue. And on the fundamental side, the shares appear favorably valued at 9 times their full year 23 EPS estimate. That's below the peer average of 10. And their 12-month price target is $42, or 10 times their full year 23 EPS estimate. Guys?
All right. Well, it is in with the kids right now. Once again, Jared Lickery, thank you so much. And we'll see you back here in a little bit. We're going to keep it on markets and bring in our next guest, Charles Sizemore is from Sizemore Capital Management. He's a CIO there. Sir, thank you so much for being with us today. Just want you to weigh in on the bifurcated bank earnings that we received so far. Wells Fargo doing well because borrowing is up. JPMorgan, a different kind of story, missed on trading equities and helped along by that loan reserve loss that it released, $1.8 billion. Otherwise, it would have underwhelmed with earnings. Is this the peak of the sector that we're seeing, and is it a harbinger for what comes down the road next week when more bank earnings come out?
Well, not necessarily. So looking at the banks, there's some good there's some headwinds and some tailwinds. The headwind, of course, is that the economy does appear to be slowing. We saw that in the retail sales data today. It seems like some of that post-lockdown boom is starting to fizzle out. But the tailwind, what should help the banks is the rising interest rate environment. That should be good for them so long as rates don't rise at such a fast pace that it starts to choke off the economy. So if we do get that sort of Goldilocks scenario where the economy does continue to grow, it just doesn't grow at a blistering pace, and the Fed continues to raise, well, actually not continues, starts and then continues to raise rates, then that actually should be a good macro backdrop for the banks.
Charles, we know that the market is, I guess, borderline obsessed with inflation right now, but you say we shouldn't be focused on that so much as the possibility for disinflation, even deflation later this year. How might that play out for the stock market?
Sure. Well, you look at the headline numbers recently, and they look absolutely awful. You have 7% year-over-year inflation, which, of course, sends chills down the spines of Wall Street. But you look at going forward, if inflation were really that big of an issue, bond yields would be significantly higher than they are right now. The bond market is pricing in a more benign environment there. Gold prices as well. Gold has really not participated in, commodities have done well, but gold has not participated in that, which does suggest that the market is really, not really seeing a lot of inflation down the road. If you look at what's driving the inflation, it's two things. It's cost push and it's demand pull. The cost push is easy enough to understand. You have all the disruptions due to the pandemic that are being worked out little by little. That's it's not like the world's industries are just waiting for things to happen. They are proactively putting things in place to help get that done. Taiwan Semiconductor is investing $100 billion in increasing chip capacity, for crying out loud. So a lot of that log jam should be broken in the coming months. And then, of course, on the demand side, the Fed is committed to draining the liquidity out of the system, which should dampen that as well. Come 6 months from now, we may be wishing we had more inflation. I would say that kind of in the medium term, it's not a particularly big risk, but if you look kind of 6 to 12 months down the line, that's going to be a major headwind for the market.
And then what is the health of the consumer this year? We've already got consumer sentiment down. We saw retail down in December. How much before this sort of 7 inflation handle, maybe higher before it goes lower, impacts their pocket further?
Well, there's a bigger story there. And part of it is retail spending was really constrained during the pandemic, particularly those first 6 months. And so what we had after that was an explosion of spending, also aided by government stimulus, low rates, you name it. We had all of these factors that really boosted spending. Well, all of those have slowly drained off. Government stimulus is largely done. The Fed's already committed to raising rates. So a lot of the things that juiced retail spending earlier last year and in 2020 is just slowly draining off. So I think it is fair to say that the consumer was running out of steam even before inflation became an issue. You add to that rising prices, and that does have an effect for sure.
What are you looking at in terms of pouring money into particular sectors? Because you've got still sectors of the stock market that are quite frothy, stretched valuations, not a lot of opportunity for yield in the bond market, even though we are seeing yields move higher. So where are you concentrating the cash right now?
We're doing a couple things. Looking at specific sectors, energy looks great right now. Energy is one of the few sectors of the market that has been cheap for a while and is still cheap in an otherwise overpriced market. So we do like energy. Beyond that, we're keeping things fairly short term. Rather than kind of take large positions to buy and hold, we're focusing more on week to week, day-to-day trading, trying to eke out kind of some short-term profits. I think that's what really makes sense in this environment.
All right, sir, we will leave it there. Thank you so much for your time. And we have much more coming up after a quick break. The Supreme Court has blocked the vaccine mandate for big business, and ahead, why one group is happy about that decision. Stay with us.
Welcome back. Our next guest says the Supreme Court's decision this week to block President Biden's vaccine mandate for large employers is a victory for the Hispanic business community. Joining us is Javier Palomares, President and CEO of the U.S. Hispanic Business Council. Javier, welcome back to the show. Good to see you. So why do you say that? Why do you see this high court decision as a victory for the Hispanic community?
You know, Alexis, as you know, our association represents the interest of the 4.5 million Hispanic-owned firms in this country that collectively contribute over $750 billion to the American economy. And despite all of the challenges in the pandemic, we remain resolute and energized, trying to make a go of it here in 2022. We're in touch with the White House constantly, and we realize that they're working very hard to provide us the resources to battle the pandemic, and we're very appreciative of their work and their effort. And it appears to be working. From our estimation right now, 80% of Hispanic adults have received a vaccination. And in the past month, there was a 27% increase in the number of Hispanics who received their booster. On this issue, we agree with the United States Supreme Court. Our association of privately owned businesses believes that we should have the right to run our own businesses as we see fit. And while we certainly appreciate all of the effort of the White House, and we understand and appreciate the motivation, this was just a bridge too far. We do not want to politicize this thing. We have been supportive of the Biden administration, and certainly we were supportive of the passage and got very involved in trying to get the Infrastructure Investment and Jobs Act, or the infrastructure bill, passed. We were delighted when that happened. But right now, our number one challenge is finding and retaining qualified employees to put this additional mandate upon us. It is just untenable, and we simply had to speak up, and so here we are.
Sir, thanks for coming on. You know, in your note, you say entrepreneurship and innovation will get us out of this pandemic, not mandates. But then I'm sure your businesses in your council have been affected by Omicron, where businesses have had to shut down because they want to keep their staff safe, as well as the people that come into them. So wouldn't having a vaccine help that situation? And if it was regulated to make it easier and less confusing, then isn't that a plus?
It is a plus, and we certainly understand the motivation behind what's transpired here. And that's why we want to be very careful to make sure that this does not get politicized. But listen, I'm speaking to people on the ground. If you can imagine the United States map, beginning in the Northeast, I just spoke to Carlos Medina of the New Jersey Hispanic Chamber. He and his chamber and their business owners stand with us in opposition. Go all the way down to Florida, Julio Fuentes from the Florida Hispanic Chamber. Him, his chamber, and all their members stand in opposition along with us. Go to Texas, Massey Villarreal, the vice chair of the Texas Association of Business. Him, their members, their employees, their businesses stand with us in opposition. In California, Taide Aburto of the Hispanic Chamber of E-Commerce. In Illinois, Jaime De Paulo of the Illinois Hispanic Chamber of Commerce. All of their businesses, all of their members stand with us. We understand the gravity of it. No one is feeling this more than we are, believe me. But our number one challenge, again, is finding and retaining employees. To put this additional burden upon us is simply untenable. There is no way that we can get into the policing of who's gotten a vaccination. What we have put in place on our own, and it's working for us, is strict regulation, strict policy within the company to ensure that everybody is being encouraged and incented to get their vaccination. Secondly, a rigorous testing protocol. And then thirdly, putting instruments and policies in place that will help mitigate the spread and localizing it and quickly removing it from the workplace. That is working for us. We understand, again, the motivation and appreciate it. But at this point, it simply was too much for our business owners. And I'm hearing this all over the country, that all these businesses and these business owners stand with us in opposition of this. And this is why we felt that we had to speak up.
You alluded to it just a moment ago, but the numbers bear that the Hispanic community has been disproportionately impacted by the pandemic. Can you briefly just break down for us how so?
Well, we are catching up, and a great deal of credit goes to the White House for their efforts in understanding our challenges. As we stand right now, as I mentioned earlier, 80% of adult Hispanics have received a vaccination, but that compares to 83 and 84% in the African American and Caucasian counterparts. So we're slightly behind, but catching up. And a lot of that catching up is happening at the very local level. The White House has done a great job of keeping us abreast of what they're doing, providing the resources, getting all the way down into the communities to make sure that wherever possible, we are allowing people and encouraging people to get their vaccination.
All right, Javiera Palomares, President and CEO of the U.S. Hispanic Business Council. Thank you. And coming up, we've got a check of the oil markets for you, and we're going to hear from the CEO of the cloud server company NetApp right after this.
Welcome back to Yahoo Finance. Well, George Kurian, CEO of cloud services company NetApp, which works with some of the biggest cloud providers, Google, Amazon, and Microsoft, just spoke with Yahoo Finance a little bit ago to discuss the outlook for the cloud industry in 2022 and how NetApp has been aiding businesses with the cloud. Let's take a look.
We have really good drivers behind our business from a demand side, both the use of data to make businesses go faster and the core idea of cloud and digital driving business transformation. So we feel really good about our prospects for this year.
George, have you seen any easing in the supply chain challenges you talked about a couple weeks ago on your earnings call?
We continue to work to improve availability of parts and to meet our strong customer demand. I think it's going to continue to be a bit choppy for a few more quarters, but we are got good, deep relationships with our suppliers, and we're starting to see improvements.
And George, where are you seeing those shortages?
I think we see issues specifically to select pieces of the semiconductor supply chain. And then, of course, logistics and freight is another area where we've had to pay premiums to use air-based distribution and expedite parts to certain parts of the world.
Hey, it's been interesting to kind of watch the growth and the different companies here operating in the cloud space compete to continue some of that growth. I mean, as you see it right now in this chapter of where things are at, I mean, what's NetApp kind of doing to kind of help all those players in the cloud space and what the needs have shifted to now?
I think we see businesses now moving their core applications to the public cloud infrastructures, and we are able to bring technologies and work closely with the biggest cloud providers, Amazon, Microsoft, Google, to help businesses deploy those applications on the public cloud. This has profound implications for how we can make businesses go faster. So we've helped vaccine makers bring vaccines to the market faster. We helped Ducati Motors, for example, reduce the time to bring new motorcycle prototypes to market by about 30%. So these are the core idea of using data to help businesses go faster, and we're a cornerstone of that.
Yeah, we've been talking so much about how that transition, the use of more digital, more data has accelerated during the pandemic. And I think there's a lot of questions about how much of that runway you can maintain now that a lot of that transition has happened. Can you give us a little more insight on what you see? Where are the big growth opportunities that you're especially excited about?
I think we see data-driven digital business as in its first chapter, meaning data used to be a byproduct of how businesses operated. They'd sort of have a big store and they collect a little bit of data around how, customers, participated in that store. Now they're using data as an input to drive business rather than as a byproduct. And we're in the early innings of that. I think you can see data growth being phenomenal, right? There's statistics which say there's been more data created in the last couple of years than in the preceding several centuries of human history. So I think that pace is not going to go away.
And George, I've been talking to a lot of tech CEOs lately, and they're starting to spend even more time on recruiting top talent within your company. How much time are you spending right now making sure you have the right talent to meet this really strong demand backdrop?
We do that as part of our daily job, right? I think a big part of my job is to both build confidence in the outlook of the business and spend time building our team. We have a very strong culture of trust, communications, as well as inclusive opportunity for all of our employees. And that has stood us in good stead over many years and is clearly an area of strength as we recruit new talent.
And George, to follow up on Brian's point, I mean, how competitive is the landscape for you right now? We've heard from so many companies who've talked about higher expenses they're looking at because of the competition for those jobs, to fill those jobs. What does that look like for you right now?
It's always been competitive in our market. We are a talent-driven business. And so we've done many things over the years to continue to be able to bring really good talent to NetApp. I think the innovation that we are working on is a source of inspiration to a lot of people. I think the idea of flexible working models where we can bring talent into our organization regardless of their physical geography is another area of strength. And then honestly, the culture.
Okay, and that was George Kurian, CEO of NetApp. We're going to take a quick break. On the other side of it, a check of the energy sector and where oil settled, along with a conversation with Heather Boucher from the White House Economic Council. Stay with us.
Welcome back, everybody. The oil markets closing out the week here after another volatile one. Jared Blickery is going to recap it for us. Jared, how does it look oil's going to settle today?
That's right. I'm looking at a settlement price for February futures at $83.82 per barrel. And let's pull up the Wi-Fi interactive so we can see the price action. Here is the let's call this year to date. This is the first 10 days of the trading year. You can see we've definitely been in an uptrend. No coincidence that every other day or some days, some weeks, several days consecutively, we're just talking about energy being the leading sector. This is the highest level that we've seen in some time. Let me pull up a 3-month chart, and you can see we are back up, knocking on that $85 per barrel high that we saw in, October, November of last year. So everything moving higher on the energy front. Only yesterday we were discussing how there's speculation that President Biden is going to put pressure on other nations or Congresses to lower oil prices. They would do that vis-a-vis OPEC, so maybe a dialogue there. There's also the Strategic Petroleum Reserve of 40 million barrels were already released from it. Speculation that Biden might release even more. But as we've seen equities flag this week, been really notable to see the strength, the continued strength in not only crude, but also the energy market. And let me show you what's happened on a 5-day basis here. We got ExxonMobil up 4%, Royal Dutch Shell up over 5%, Conoco up 6%, BP up 7%, and Occidental Petroleum up 5%. So a lot of strength in this sector. Have to see if this continues into the following week.
All right, Jared Blickery, thanks for the roundup. President Biden announced 3 additional nominees for the Federal Reserve Board today. Former Fed Governor Sarah Bloom Raskin and economists Lisa Cook and Philip Jefferson. If confirmed, they would round out the central bank's governing body as it prepares to tackle the highest inflation in nearly 4 decades. Joining us is Heather Boucher, a member of the White House Council of Economic Advisors. And Heather, welcome back to the show. It's good to see you again. Outline for us briefly why the president believes these 3 individuals are right for the Fed board at this pivotal time.
Well, these 3 individuals are extremely well qualified and they're ready to go. And they will be a valuable asset to the Federal Reserve Board. So each of them brings skills and qualifications, years of experience as economists. They've all in some way been at various, played a role at the Fed before, either as a visitor at one of the regional banks or as Sarah Bloom Raskin, having actually served as a governor before herself. One of the other things about this slate of candidates is that when you put it together with the other 2 nominees, Jerome Powell and Lael Brainerd, that the president announced last year, if they are all confirmed, this will be the most diverse Federal Reserve Board of Governors ever. And that's important because the president is committed to making sure that those who are making economic policy represent the diversity of the American experience. And so that's an important facet of this as well. These are extremely well qualified people. They're ready to go. They have the experience and the skills that they need, and they're going to bring a different set of voices into this really important conversation about getting us to full employment while maintaining price stability.
Shay, thank you for joining us today. A quick question about Ms. Raskin. Obviously, she is no stranger to the Fed board. She's been on the Fed before. Obviously, the primary concern is monetary policy and taming inflation, but she's been very outspoken on climate as well. Do you see that becoming more of a focus in the Fed's world as we move forward? Does it become important to the economy?
Well, one of the things we know is that climate has become important to the economy in a world with an unstable environment where, we are seeing years where there's over $100 billion in damage due to climate-related disasters. Climate is not something that fiscal or monetary policy makers can avoid. The climate is changing, and with it, we need to make sure that our policy toolbox in all ways around economic policy is taking into account the risks that climate change is bringing, both the physical risks and the transition risks. So it is really important that as we think about economic policy, those risks are not seen as a nice to have, but they really are now a must have in terms of their importance for our getting our economy to full employment and ensuring price stability over the long run.
And that's actually one of the Fed's mandates, right? Creating stable prices, but also trying to maximize employment. I know, at least on the part of the White House, President Biden has tapped into the Strategic Petroleum Reserve to try to ease some of these high energy prices that we've been seeing. He's met with the meat industry to talk about, possible gouging there. What else can the White House do realistically to put a stop to these high consumer prices?
Well, we have to remember that the real reason that we have high consumer prices today, a lot of it does stem from this historic pandemic and the challenges that that's created for our nation's supply chains and global supply chains. Let's remember that inflation is not a US phenomena. It is actually global, and other countries are seeing high inflation just like we are here in the United States because the pandemic has really challenged the way that we've been doing business. Global supply chains bring a lot of efficiency, but they aren't resilient, as we can see in the face of shocks, like workers getting sick and not being able to produce necessary pieces across the chain. And I start there because that has been a core focus of President Biden since the campaign, that we need to make sure that our supply chains are resilient, that Americans can get the goods that they need. And so that's been a focus of this administration all along. And that is one of the ways that we will help to keep prices down. We've already seen the effectiveness of those policies. We've been doing that work, making sure to keep the ports open on the West Coast, helping truckers be able to do their jobs. And as a result, we were able to see those shelves stocked for Christmas and the holiday season. And that's a really important piece of the puzzle, having government do its part to make sure that the private sector can do its part to get goods onto shelves for consumers. But at the end of the day, inflation really is the job of the Federal Reserve. And they have their tools to deal with inflation, but the federal government can really deal with the supply side issues in terms of supply chains, but also, as you mentioned, in terms of making sure that markets are fair and competitive, people are paying a fair price, and making sure that we're dealing with the productive capacity issues on the side of families, making sure that families have access to healthcare or home health aids that they need in order to get to work. All of these things are going to keep prices down for families.
And then want to turn your attention, the president is talking today on infrastructure and building bridges. I understand the long-term benefits of this project, but is this the right time to push it forward? Because we're dealing with a hot economy, we have a red hot labor force. Does this sort of exacerbate things at a time when we need to sort of take a step back?
Well, here's the thing. We just talked about the lack of resilience of America's supply chains. This investment that's going to go out from the bipartisan legislation that was passed back in December, that's going to be a $27 billion investment in bridges all across the country. This is the kind of thing that makes sure that our supply chains function, right? You got to get goods across American waterways. You got to have people getting back and forth to work, all the things. It is so important to invest in American resiliency in our economy. And that's what these investments in infrastructure and specifically these investments in bridges will do. I'll also note that it remains the case that employment in the kinds of heavy engineering and construction that goes into making these bridges, that employment remains below its pre-pandemic peak. And we are not seeing wage pressures in that sector of the economy. So there is room there to get out there, hire those workers, put them to work, making sure that Americans can get to work and goods can get to store shelves because bridges don't fall down. So this is an important piece of building our long-term productivity while getting workers to work in the here and now.
I want to pivot for a moment to the pandemic because the Supreme Court yesterday struck down the Biden administration's vaccine mandate for large private employers. What do you think that ruling means for worker productivity in this country, especially at a time when so many industries are grappling with labor shortages?
Well, we know that this economic crisis that we've been in has been due to the pandemic. That's where it started. Getting the pandemic under control has been job one for this president because it is important to people and families. And as an economist, I think about how important it is to the economy. So the vaccine mandate was a way of making sure that when people went into work and when people went into American places of business to engage in economic activity, to go shopping, go to a all the things, that for those large businesses, they knew that people would be vaccinated. They knew that they would be safe. So I think this is a real challenge for the economy. Now, individual employers are going to have to make that decision one by one. But the important thing is that we've seen that when employers have made that decision, they say that it's been effective. So, the United Airlines CEO wrote a letter, I believe last week, noting how effective that vaccine mandate was for their own business in making sure that they had fewer workers that were out of work sick so that they could do their job. So the point is that we need to contain the pandemic so that people can get back to work, so that we can get those goods on shelves, so that people can go back to services. So it remains the case that is core to our economic recovery.
All right, Heather Boucher of the White House Council of Economic Advisors, thanks for your time today. And coming up next, why a growing number of students are rethinking higher education.
Welcome back to Yahoo Finance. Well, a new report finds since 2019, undergrad enrollment has dropped off by more than 1 million, raising concern about a potential shift in attitudes towards higher learning. And here with more on why kids are hitting the brakes on a traditional college degree, we are joined by Doug Shapiro, National Student Clearinghouse Research Center Executive Director. Doug, thanks so much for your time today. You have a really comprehensive report, and we'll get into that in a minute. But I'm just asking for your sort of sense, why are people deciding to sit out? Is it the pandemic? Is it the higher costs? Is it the craziness involved with trying to get into college at this point?
Well, last year, I think it was pretty clear that this was being driven by all the disruptions of the pandemic. Almost all of the declines last year were in community colleges. And those are the institutions that serve many of the lower income students and communities that were most affected by the impacts of COVID-19. And also that often had difficulty adapting to online instruction. But this year, it's a very different phenomenon. We're seeing a much broader base of declines. The pain is evenly split this year between 2-year and 4-year colleges, especially the less selective and public 4-year schools where affordability and student debt have become larger concerns. So I think that suggests that more students are questioning the value of going to college, not just whether this is a good time to go. I think they're less confident about what the payoff will be. particularly now when there is high demand for low skill workers without a degree, and their wages are rising.
So, Doug, do you know where these students are going if they're choosing to not go to college? Is it that they're taking a gap year or two, or do they not have plans to go to college and they're going to get into go to trade school, or do they have other plans?
Yeah, we don't really know their plans. It's hard to say. What we assumed when the numbers fell so dramatically last year, that this was a gap year phenomenon. Students were choosing to sit out for a year, hoping that the conditions of the pandemic would improve and planning to come back the next year. But what we found this year when we followed up on those students was just the opposite. Very, very few of them came back this year, even though the conditions on campuses had been much improved. Obviously, we have vaccines, we have much better ability of the colleges and universities themselves to handle kind of pandemic protocols and to reassure students and parents about students being on campus again. And yet, virtually none of those students who didn't enroll last year have come back this year.
Was there a difference, sir, in the drop-off rate at private versus public? And were there certain sort of areas or majors that saw more of a drop-off than others?
Well, it's a very interesting question, because again, this is something that's different this year, very different this year from last year, where we're looking at the situation in four-year colleges that in many cases there has been a slight rebound in the number of new freshmen coming in, but only at the most selective, the most elite colleges and universities. So the public flagships and the most competitive private nonprofits, their numbers did increase this year. But all the rest of the four-year institutions, the less selective, maybe your regional public institutions and smaller private nonprofits, saw continuing declines.
Can you tell us what some of the majors are that are seeing this decline? What are some areas of study that students are not necessarily going into right now?
Well, most of these declines are pretty much across the board. Certainly, they're larger in some of the areas like liberal arts and the humanities, which have been declining for years, foreign languages, communications and journalism, sorry to say. And even in places where there are increases, like in computer science, for example, the increases are quite small, only a couple of percent. So nowhere near the kind of level of increase that you would expect in the current economy for computer scientists, and certainly nowhere near sufficient to meet the future need for computer scientists in the years to come.
All right, we will leave it there. Doug Shapiro, National Student Clearinghouse Research Center Executive Director, thank you so much for your time today. We're going to take a quick break, but after that, crypto back in the news. We'll tell you why. Stick around.
Elon Musk is at it again, moving the price of Dogecoin after saying the alt crypto can be used to buy Tesla merch. Yahoo Finance's Jennifer Schoenberger now with more. And last check, I saw Doge up about 16%. Jennifer, what did Elon have to say?
Hey there. Yep, that's right. Elon Musk yet again giving Dogecoin a pop. The CEO of Tesla saying, as you said in a tweet, quote, Tesla merch buyable with Dogecoin. That single tweet sending the dog-themed Dogecoin up as much as 18% to 20 cents and change in the session now, as you said, around 16% up to around 18 cents and change. And this isn't the first time that Musk has tweeted about the ability of customers to purchase Tesla merch using Dogecoin. And it isn't the first time he's moved cryptocurrencies. Back in December, Musk said that customers would be able to begin buying Tesla merchandise using Dogecoin, sending Doge higher. But back in May, when he appeared on Saturday Night Live, Musk, sort of playing a character, admitted that he didn't know what Dogecoin really was, and it was, quote, just a hustle, and that sent the token lower on the session. Customers can buy Tesla merchandise ranging from apparel to model Teslas and mugs with Dogecoin. But when it comes to purchasing the electric vehicles, Tesla is not accepting Doge for that. Dogecoin getting a bid today as other cryptocurrencies have been flipping back and forth between the red and the green, now mostly back in the green here late in the session. And while Doge is getting a bid today, it is still down some 75% since its all-time high of around 74 cents back in May. Alexis.
I'm going to jump in and switch gears a little bit. President Biden just nominated Sarah Bloom Raskin for Vice Chair of Supervision, big regulatory role tied to banking. What implications, if any, do you think that has on crypto?
Hey there, Karina. Yeah, the vice chair of supervision for the Fed is going to play a leading role in formulating regulations for crypto. And we know that Sarah Bloom Raskin is a bit more progressive and so would likely take a stricter stance on formulating those crypto regulations. We do know that the Biden administration has recommended that stablecoins, which is what regulators are focused on mostly right now, should only be issued by banks. So if Sarah Bloom Raskin is indeed confirmed by the Senate, she could look at levying bank-like regulations on stablecoins.
All right, Jennifer Schoenberger, thanks so much. Elon Musk seems to have the Midas touch when it comes to Doge, at least. All right, everybody, let's get another check of the markets because it looks like the broader market trying to make a comeback right now. The S&P down just 16, the NASDAQ hugging the flat line, down just 5 points, but it's tough for the Dow to come back today, down more than 300. Big reason why JPMorgan Chase, the biggest loser there, down more than 6% after a disappointing earnings report. Profit actually fell by double digits in Q4, even though profit was at a record high for all of last year. Citigroup, not a Dow component, but also reporting some disappointing earnings there. Also on the downside for the Dow, American Express, Home Depot, and Walt Disney. As for the broader market, we are seeing strength right now in energy, just, continuing the momentum we saw last year. That is helping to lead the broader market higher. Technology also bouncing back a little bit here, but of the 11 sectors in the S&P 500, only energy and tech are higher. On the downside, financials, understandably so, after those disappointing big bank earnings. On the downside, real estate and materials as well. It was a packed 2 hours for myself, Alexis Christophorous, and Karina Mitchell. Thanks so much for being with us. Our colleagues will take you through the final hour of trading and the closing bell in what has been another volatile week on Wall Street. Stay with us.
It's a muddled picture after banks report mixed earnings and data shows retail sales fell in December. Akshata Balkiri from Bruderman Asset Management will help us focus on next steps as investors prepare for the weekend. Then 5G, or as Hans Vestberg at Verizon would say 5G, is supposed to make life better. But airplane and helicopter pilots worry 5G C-band transmissions will interfere with flight control instruments. John Shea from the Helicopter Association International joins us to explain what is at stake. Hey, and you telecom investors, you have added incentive to pay attention to this one. Then luxury developer and car collector Gil Deser shares details of Deser Development's latest project, which merges the iconic Bentley Motors with the best in Florida shoreline living. We're an hour from the closing bell. I'm Adam Shapiro.
And I'm Emily McCormick. Stocks are trading lower this afternoon at the end of a volatile week, particularly today on the Dow. As we can see, that index is off session lows, but still down nearly 1% or more than 300 points. And it is some of the bank stocks that are leading the way lower today. And particularly JPMorgan Chase, which is a Dow component, is underperforming in that index today, down more than 6.5% after posting some mixed fourth quarter results that included disappointing fixed income and equities trading revenues for JPMorgan Chase, as well as from Citigroup, which also reported this morning. But let's head over now to Yahoo Finance's Jared Blickery for a deeper dive on today's market action. And Jared, what are you watching?
I'm watching the Dow components heat map here on the Wi-Fi Interactive. The big standouts are JPMorgan, as you just went over there. Also Home Depot off of that disappointing retail sales number. We'll get to that heat map in a minute, but coming in at the lowest level since March of last year, February, March of last year. Also American Express down with the banks in sympathy. Financials not outperforming today. Goldman Sachs also down more than 2.5%. But it's been a day where tech has been somewhat in favor here. Microsoft and Apple each up, Apple just barely, Microsoft up over 1%. If we switch over to the tech-heavy and biotech-heavy NASDAQ 100, we can see of the mega caps, only Amazon down 6 basis points. Also, the one mega cap in here, not known, is Berkshire Hathaway, Warren Buffett's firm, trades on New York Stock Exchange. That stock just hit a record high about 10, 15 minutes ago. So let's take a look at the retail sector, because a lot of disappointment off of that headline number today. Should also mention that University of Michigan consumer sentiment hit the lowest, well, is almost at the lowest level in over a decade. But back to the main point here on your screen, we can see some dark red really focused on some of the small, well, I guess it's a mix of names here. BJ's is down about 6%, Nordstrom down 5%, Buckle down 4.5%, Home Depot, we covered that, Macy's is in that mix. So a lot of these big box retailers and I guess some standalones here having a little bit of trouble. Macy's, a department store, noting that. In the energy sector, if you're looking for some green, well, there you have it. Not much else in the way of that. You're not going to see that on any of the other of our heat maps. But I do want to point out ConocoPhillips up more than 3% and BP up 2.5%. We'll do a deeper dive on the week's price action later in the show, but I just want to close here with the sector action for the day and the week. We're seeing energy that is in the forefront yet again, a very common story this year, up 2%, followed by tech and consumer communication services, and then staples. In fact, the number of staples names today have hit record highs, including Coca-Cola, Hershey's, Pepsi-Cola, Mondelez, Archer Daniels Midland, and Keurig Dr. Pepper. So interesting to see that there. The worst performer today is ending up to be financials, not benefiting from an expanding yield curve, which I want to end on here. The 5-year T-note yield, that is up 6 basis points. Pretty big move there for it. We have the 10-year T-note yield up 5 basis points, and the 30-year up another 5%. So interesting to see that growth is marching higher in lockstep with energy today. Guys?
All right, Jared, thank you. We're going to be checking in with Jared and watching these markets as we head toward the closing bell. Remember, the last 20 minutes, last 15 minutes, things always accelerate. Let's talk about where we stand right now at this moment in time. And let's bring into the stream Akshata Balkiri. It's good to have you here. And she is Bruderman Asset Management equity analyst. When we talk about inflation, and I should point out, Netflix just announced they're raising the price of their standard plan. Fortunately, in this house, we finished Emily in Paris. That aside, when we look at inflation and the Fed, which should we as investors be more concerned about? Raising interest rates or the speed with which they roll off the $8.8 trillion?
I mean, honestly, from our analysis and expectations, we expect the Fed tightening to really create some market volatility at the outset, but more widespread volatility not really likely until the end of that tightening regime. For us, we expect tapering to create more volatility in general than the first couple of rate increases in general overall.
Akshata, looking at this morning's economic data, retail sales fell by the most in nearly a year in December. Consumer sentiment is at the second lowest in a decade, according to the University of Michigan. And that's after 2 hot inflation prints out earlier this week. Where are we now in the economic recovery, and what does this mean for investors?
I mean, you can't talk about these retail sales without talking about the elephant in the room. The Omicron variant definitely is one of the main factors kind of affecting some of the lower sales levels. It's more contagious than previous variants that we've seen. And even though some of the people get more milder symptoms in general. And there is a very strong negative correlation between virus cases and personal consumption expenditures. And that's really affecting some of this retail spending. Personal consumption expenditures make up around 66% of overall GDP, which had recovered quite a bit last year, but they have a negative correlation with this virus. So if Omicron continues continues to peak, we will still be seeing some of that negative pressure on retail.
What would you say to investors who are looking at the big picture? We have consumer sentiment falling at lows we haven't seen in several years because of a fear factor that may not actually represent the true facts on the table. But that aside, if you're an investor looking at this thinking, you know what, I will always be safe in healthcare, is that the way to look at this, or in that sector should you be considering something else?
Healthcare has been really interesting. We had the JPMorgan healthcare conference this week. There were a lot of interesting takeaways. We've seen a lot of the large pharmaceutical companies outline their strategic priorities, and some names like AbbVie, J&J, and Merck kind of highlighted some of their growing pipelines to replace their blockbuster, be it Humira or Keytruda, that have more impending loss of exclusivities coming up. So some of those were very positive notes to deal with. And in medtech, we've also seen some appetite for M&A. So that's a space that investors to keep an eye on, because especially J&J has noted that they're interested in developing that area for themselves and looking at smaller M&A deals that can really support them in that endeavor. So it's definitely some areas of change that could be good opportunities for investors to keep an eye on.
And when you think about these 3 main areas of healthcare, you mentioned the large pharmaceuticals, medical devices, and of course, managed care providers. Where do you see perhaps the most opportunity, if you can rank and pick one of these out amongst the rest, considering the backdrop that we still have with the coronavirus?
I mean, there's opportunity in all of these spaces. When we invest, we look at a long-term secular trends in general. And one of the spaces that you wouldn't expect is animal health. Animal health has done phenomenally. People are getting pets. People want to make sure their pets are healthy and stay with them for a long term. And as we move more into hybrid models, people want to make sure that their pets can stay with them. So names like Zoetis or even Merck, that has a very large animal health division, are real beneficiaries of this overall secular trend. And within overall larger pharma, we see AbbVie, for example, one of the stronger names, has Rinvoq and Skyrizi as 2 drug candidates to kind of replace Humira's loss of exclusivity. So that's been really great. And Organon, which is a spinoff from Merck that focuses on women's health, another great growing area, with fertility being a space that there's a lot more investment in and a lot more trends that support people needing to use fertility treatments.
Realizing your specialty is equity, I am curious, will you be paying attention? Well, you will be paying attention, I know you will, but what will you zero in when we get the statement later this month from the first FOMC meeting? Are you looking for liftoff in March, or are you going to be looking for something else in that statement?
I mean, when we're looking at that, we expect that the initiation of the liftoff would be probably around in March. It's come down from that July estimate. The Fed is, seen to be responding to these inflation pressures, and we have already seen many people come out saying, we're expecting these interest rate hikes as well. But that liftoff, at least, or we expect to be around March, and they'll respond accordingly. That's what we believe.
I'm sure we will be speaking with you once again, and we will be talking not only about the Fed meeting in the rearview mirror, but the ones that are coming up and most likely liftoff. All the best to you, and thank you for joining us today. Just want to remind everybody that Akshata Balkeri is a Bruderman Asset Management equity analyst. When we come back, we have much more for you.
COVID-19 is pushing hospitals across the country to the brink of capacity limits as cases continue to soar. Yahoo Finance health reporter Anjali Kamlani joins us now to discuss. And Anjali, break down the latest on the virus for us as we continue to track Omicron spread.
Well, Emily, unfortunately, we know that the numbers keep on rising, especially for hospitalizations in the U.S. And I know we've touched on that, especially after we saw the cases rise. The expectation was, just as we've seen with all the previous waves, that after cases spike, then come hospitalization rises. And that's when we start to look out for the deaths that come as a result. Now, while Omicron has been sort of milder, and again, I put that with an asterisk that it has been reportedly milder compared to Delta, but that doesn't necessarily give everyone the escape. We have seen some deaths already in the UK and the US reported from this new variant. Now, what's here in the US is a little bit different from what we saw out of South Africa, which I know we've largely relied on to really look at what the situation is. And a couple things stand out. Number one is that we have an older population than South Africa. We are also in the winter months, which means more gathering indoors and easier transmission, especially for something that's as transmissible. So it's important to keep that in mind. And right now we're seeing hospitals report about 20% say they're critically short on staffing, while about 23% say they expect so in coming weeks. And we know this wave is likely to move in waves around the country as we have a large landmass to contend with by comparison to other areas which have seen surges rise and fall. Meanwhile, I also want to bring up something that is going on with the free at-home rapid test. That's something that the Biden administration just gave reporters an update about. We know that there has been the push for delivering these, and President Joe Biden himself said there was going to be a website. That website is now live, and that is going to start taking orders as of January 19th. We're going to see, there you see it on your screen, covidtest.gov. They did say that there's a limit of 4 tests per household, and delivery will be in 7 to 12 12 days after that goes in. They have confirmed that these are going to be tests that will detect the Omicron variant. And there's also a line to call for those without intranet and access. So just to keep an eye out on that. And of course, just looking at everything that's going on, we all, of course, have to stay updated on what the latest studies show about vaccines. Now, while here in the US, we do have access to 3 of the different types of platforms and technologies, there is some reporting out that looks at different vaccines that have been used abroad, largely made by Chinese companies or the ones in India. So those, by the way, do not work against Omicron. There's some studies that show they might be even less effective. And there's some concern there, as we know that about 1 to 2% of the early vaccinations for Africa did come from those Chinese companies, which is important because we're still looking at vaccine equity here. So this all plays a role in sort of that road to ending this pandemic. Back to you.
Yahoo Finance's Anjali Kamlani, thank you so much. Let's stick with this topic and bring in Dr. Andre Campbell, professor of surgery at UCSF and ICU physician and trauma surgeon at Zuckerberg San Francisco General Hospital. Dr. Campbell, thank you so much for your time this afternoon. As an ICU physician, in the past several weeks, what have you been seeing in terms of the volume and severity of cases of patients with COVID coming through your hospital?
Well, first of all, thank you for having me. It's unfortunate that the pandemic continues. So what have we been seeing here in San Francisco? And that is the numbers of cases have gone up dramatically from just a couple weeks ago. Now we're up to about 40 in our hospital. At the worst of the first wave or the second wave, so to speak, in California, we had up to 71 patients. We had about 8 in the ICU. But what's happening even more now, which is really dramatic, when we didn't have it last time, and the virus is burning through the staff at the hospital. So we have hundreds of nurses, support staff, even some of the doctors are fell ill from this virus. So this virus is accelerating in a way it's burning through the population. There are about 145,000 people who are hospitalized, and that's way more than before. The incidence of daily infections are twice of what it was before. They mentioned milder. Now remember, 62% of people have 2 vaccines, but only 20 to 30% of people have 3. Fully vaccinated, and my estimation now is 2 shots plus a booster. That gives you the protection. So if you get it and you're fully vaccinated and boosted, then the incidence of your infection may not be as bad as it was before. But we're really teetering on the brink in healthcare because we're getting really strapped to the max with respect to the numbers of cases that are happening amongst the healthcare providers providing health, but not only the doctors, the nurses, the support staff, the janitorial staff. It's really affecting us tremendously at this point in time.
Dr. Campbell, good to see you. I'm almost ashamed to ask this question because the medical people, whether they be doctors, nurses, anyone in the hospitals who have been working now 2 years to protect people, certainly need a break. But we're hearing stories that in some medical facilities, if someone tests positive for COVID, they're still saying, if you're not ill, but you've tested positive, you can keep working. Now, we have not independently confirmed that. It was a story that might not be 100% accurate. But have you heard of anything like that? And would that be a foolish thing to do?
Well, what has happened now, this is the reports I have heard now. At our facility, it is not like that. So you get tested, you go out for 5 days, then you get retested. And then at that point, they decide whether or not you can come back or not. So many times people come back at 8 or 9 days after they've been infected, but we do not have that policy. I've heard that. I don't think that's right. I think that's wrong. But what has happened is people are running out of healthcare providers to take care of patients. So that's why you're hearing these stories, not at our place, but it is beginning to creep in. But I think that is the wrong thing to do. I think if you're sick, you should stay home because you do not want to spread the infection to someone else. What happens in our system, you get sick, you get reported to the healthcare authorities here, and then they guide you through the path back to work. That is the correct way to do this.
In San Francisco and the surrounding areas, do you think you're past the peak for this wave of Omicron, or do you still think there's a certain amount of time still to go for there still to be strain on the healthcare system with this current surge?
So we hope that things will get better. You mentioned the South African experienced a little bit ago, being the lead up to this. It went through and then it went down. Britain, that's going down. It is evidence that in New York, that it may be peaking and going down. In Maryland and in Washington, D.C., it may be going down. And there was some evidence, well, maybe we may be going down here, but that is not any guarantee, because one day it may go down, but it goes up. So we may have 35 patients, but then today we have 44. So I think it's a little bit early to say that, but we're hoping against hope that things will get better in the short term.
We've seen lots of doctors addressing this issue of some people who just, let's get the Omicron variant, get it over with because, quote, it's mild. And there was a doctor on television this morning saying that is just very foolish. Mild is not necessarily a cakewalk. What advice would you have to people who, when we hear that the symptoms of this are mild, get reassured and don't worry about contracting this?
That is absolutely wrong. Because if you're unvaccinated, and 80% or 90% of the people in the hospital are unvaccinated, they're not having mild cases, they're dying. Remember, 1,600 people are dying a day in the United States. 1,600, that's a lot, right? So that means in a 10-day period, that's 16,000 people. Right now, it's 64 million cases, 850,000 deaths. There's nothing mild about that at all. So my advice to you is don't get it. Wear a mask, make sure you're vaccinated and boosted, so getting all three. So to me, 3 is the new 2. So make sure you do that. It is really important that you get vaccinated and you take care of yourself so you don't get it. Don't get this virus because you don't want to get sick, because we don't know what long COVID looks like for Omicron. We know that something like 25% of people who get of the Delta variant may have long COVID, and some people estimate it's 50%. Long COVID, you don't even want to entertain that. So don't get it. That's my advice to you. That is absolutely wrong. Protect yourself, protect your family.
Dr. Andre Campbell is professor of surgery at UCSF and ICU physician and trauma surgeon at Zuckerberg San Francisco General Hospital. And we thank you so much for your time. Coming up, as telecommunication companies try to expand their 5G rollout, the safety of helicopter flights could be compromised. We'll discuss with John Shea, Helicopter Association International Director of Government Affairs, on the other side of this break.
So AT&T and Verizon both agreed to delay the implementation of 5G, or as Hans Vestberg would say, 5G, C-band transmissions, especially around airports, because of the concerns that the C-band transmissions might interfere with the flight devices aboard aircraft. What we didn't talk about when this was all breaking news was, what about helicopters? We need to talk about it now. John Shea is Helicopter Association International Director of Government Affairs. And not many of us are pilots. I certainly am not. So help us understand. We get that you can have interference within the band where the transmissions are taking place. I guess it's the same for helicopters as it is for the devices on airplanes. So what do we do about it?
Yeah, that's right. And thank you for having me on. You hit on something. It's exactly the same. If anything, it's actually more of an issue for helicopters if you consider the fact that we're flying much lower in urban environments and in places where we're likely to see 5G towers come out first. So this is definitely a concern for us. And we've got certain helicopter missions that are really critical to this nation, not just the economy, with offshore, but with air med and firefighting and law enforcement. So I think there's a real public interest in this issue. Of course, we understand that the commercial airlines have been kind of front and center, but I think folks are starting to realize that we've got a big problem on our hands if we're not flying.
John, this is Emily here. So what is the solution in this case? Like, is there a way for these new 5G signals to operate while avoiding this kind of interference with aircraft and helicopters in particular that you're talking about?
So the FAA, in close partnership with industry and the radio altimeter manufacturers, that's the critical piece of safety equipment that measures the distance from the ground to the aircraft, have been in communication for some time, and they've been trying to identify certain areas and radiuses from the towers where the interference will be an issue. And there's certain mitigations that may be available to operators and pilots that mitigate some of the interference concerns. Those could be filters, and then again, maintaining a safe distance. But the issue that we're running into is there's a number of different configurations with helicopters and radio altimeters. So the aircraft varies and the radio altimeter varies, and a simple filter will not work in most circumstances. And the bigger issue is we're looking at being years away from having a 5G resistant radio altimeter. So this problem is one that doesn't have a silver bullet anytime soon, and that's why we've been pushing back so hard to get the FCC to press pause until we can figure out exactly what's going on and how we can mitigate it.
If we heard correctly, though, 5 years, is it realistic to delay the implementation of 5G for 5 years? Is there some other alternative that gets everybody safe, because safety is first, but gets us to where we're headed?
Well, I completely understand the situation where the wireless carriers are right now. They purchased for $80 billion the C-band spectrum with a very clear direction that they would be able to turn on December 5th. And they have delayed twice now and set agreements with the FAA. However, the mitigations that they have offered voluntarily only are in place for 6 months. So we're looking at a situation where we're going to have to be updating equipment and what are called notice to airmen and AMOCs, which are an alternative means of compliance, almost on a quarterly basis. So while I know 5 years seems like a long way away, and that's not a number that we're particularly pushing for, we're trying to find a way to coexist. But in the current environment and with the unknowns that we have in front of us, it seems very premature to turn on at this point. And that's really what we've been trying to say is let's really understand this issue before we move forward and start jeopardizing some of the safety of life missions that we conduct.
So, John, after January 19th, when AT&T, Verizon, these telecommunication providers have said that they will delay this rollout until, what should consumers and passengers be looking out for in order to make sure that they're still flying on aircraft and maintaining their safety as well?
Well, I think I know the airlines are taking this very serious, and as are the manufacturers. Very, very the communication and the work that's happening around the clock in order to maintain safety. I believe that plus the FAA, they've taken a very conservative approach to safety and their exclusion zones and protection zones that they're providing through the 1,600 plus NOTAMs that are notice to air missions that protect a certain airspace area. But the traveling public, I think they're going to be looking at a very difficult situation come January 19th. COVID has already caused a very massive disruption to the airlines, but as far as cancellations and delays, and that's only going to be exacerbated by what we're looking at with 5G. So I think they can expect to hear from the airlines, and they'll hear plenty, I'm sure.
John Shea, Helicopter Association, International Director of Government Affairs. I'm sure we're going to have you back as this issue moves forward because that 2-week pause is about to expire. But thank you for helping us understand what's at stake. When we come back, in New York City, there's a game that they like to play. People play it all over the country, actually. How low is your mortgage rate? Because people like to brag. Well, you say, I got 3%. Someone's sure to say, well, I got 2.75. Anyway, mortgage rates are going up. So when we come back after the break, is it the end of the ultra low rates?
Time now for our 2 and 2. 2 stocks Adam is watching and 2 stocks I'm watching during today's session. Let's take a look at shares of Disney. Now, it's one of the laggards in the Dow Jones Industrial Average today after a downgrade from the Wall Street bank Guggenheim. Now, the firm cut its recommendation on shares of Disney to neutral from buy and also slashed its 12-month price target to $165 from $205 per share. Those shares are currently trading around $151 a piece. Now, this downgrade is primarily due to concerns over the rate of earnings growth for Disney, and specifically Guggenheim analysts said in their note earlier earlier today that the downgrade accounts for, quote, our updated view of the pace of profit growth at the company's direct-to-consumer and parks businesses, which is now below consensus through fiscal 2024. Disney is expected to next report quarterly earnings results on February 9th, so we'll get an update from the company again then. But for now, consensus analysts are looking for Disney's adjusted earnings per share to jump 90% over last year to reach 61 cents a share for its most recent quarter. Now, that jump would come, though, we should note, as Disney lapsed the period last year when most of its theme parks were still closed or at limited capacity during the pandemic. And shares of Disney have fallen by about 18% over the past 6 months. Then there are shares of Sherwin-Williams Company. Now, the household paint and supplies company is also seeing its shares coming under pressure, and that is after it announced preliminary quarterly results that missed estimates, mostly due to both labor and raw material shortages. Now, Sherwin-Williams said it expects adjusted earnings will be about $1.35 a share for the fourth quarter, compared to the $1.69 that consensus on Wall Street was looking for. Now, CEO John Morikis said in this morning's earnings statement, quote, we are disappointed in our weaker than expected earnings results. We faced meaningful labor challenges in the Americas group in December related to the COVID Omicron variant, as our workforce, including store managers, field sales reps, and drivers, experienced reduced staff availability and store hours in some locations. Now, Sherwin-Williams is expected to report its full fourth quarter results on January 27th, but for now, that stock is down nearly 3%. Adam.
Emily, I love when I get to pick Ford as one of my stock. I always think of my grandmother's 73 green Ford Gran Torino. This stock was trading down slightly after the opening bell, but right now it's actually trading up just a bit. Brian Sawsey wrote about this today. Story still on the yahoofinance.com page, and the potential for the share price for this stock to fall. Here's what's going on. Their market cap now $100 billion. But Sawsey points to Morgan Stanley analyst Adam Jonas, who's well known in the field, saying that Ford shares got ahead of themselves, and he's lowering his rating on the Ford shares to the equivalent of sell, now underweight. Thinks that the stock price, which is around $25, could fall to $12. So he said, quote, the stock market's attraction to the Ford EV story continues to take us by surprise, but still thinks the stock and the investors are getting ahead of themselves. That's at least what Morgan Stanley's Adam Jonas is saying. Then you got Wynn. Who doesn't love to go gaming? Have you ever been to the Wynn Resort in Las Vegas? They got great buffet. Anyway, shares were up 7%. They've stayed there roughly most of the day, up about 8% now. This is news out of Macau. The government there has clarified their position on the gambling law changes that are coming down the pike. Bottom line, those who have casino licenses are going to probably get to keep them, and in fact will be able to renew them. So there was concern that the length of the license would be halved, but the bottom line for investors is that it looks as if Wynn Macau will be able to extend its license past June and for several years, and investors like that. Emily?
Adam, the era of low mortgage rates may be over. The average 30-year fixed rate mortgage jumped to its highest level since March 2020 this past week, reaching 3.45%. As rates rise, our next guest joins us to help make sense of where we may be heading in this housing market. And George Retu is Realtor.com Economic Research Manager. George, thank you so much for joining us. And as I mentioned, we have seen this rise in mortgage rates that's tracked the jump in the benchmark 10-year Treasury yield. How much further do you see mortgage rates rising this year?
Well, Emily, we are forecasting mortgage rates to reach 3.6 by December, at least as of our December forecast, right? So what we're seeing, mortgage rates are really making solid gains based on, to your point, the 10-year Treasury. We're seeing the Federal Reserve also pull back its massive support of the mortgage market, particularly considering that the Fed had been purchasing about $40 billion a month worth of mortgage-backed securities until about November. And the central bank has sped up its tapering. And in addition, markets are also expecting the bank to make tweaks to its overnight rate, which will have a trickle-down effect all the way onto the bank's willingness to extend loans. So I think, in essence, mortgage rates are likely to continue rising. It's worth noting, mortgage rates tend to be somewhat volatile. So I'm sure we're going to see some retrenchment from maybe the current rate and then another push towards a new level. Looking historically, however, I'll note that, yes, the ultra low mortgage rates might be behind us, but we're simply moving into the low mortgage rate territory. If you look at the 90s, the 80s, even the 2000s,
Yeah, George, when you say the low mortgage rate, I can remember having a mortgage at about 4.25%, thinking back in the day, whoa, this is pretty good. What's the real impact, though, on house price acceleration? Because there's still great demand and very limited supply.
Great question, Adam. And I think there the truth is we're seeing prices beginning to moderate the stratospheric pace that they sustained in 2021, where as of December, our listings data showed that prices were up 10%. That's pretty solid. However, when you look back to March, April of this last year, prices were up 17, 18% year over year. So we're beginning to see a moderation in price growth. Looking ahead at the rest of the year, I do see that an improvement in the supply, both new construction as well as existing, is going to temper a lot of the price growth. So that's really good news for buyers. They're going to see more options and more approachable prices. And to your point about mortgage rates, I do see mortgage rates tamp down some of the demand. The millennial wave is not going anywhere. So that's going to be with us. But some first-time buyers might have a challenging time qualifying for a mortgage as rates increase.
Well, and to that point, how do you expect consumers to really respond to this rising rate environment for mortgages? Like, do you expect that we may see a near-term jump in home buying as people try to get ahead of the Fed's interest rate hikes, or do you think that opportunity has already passed?
Emily, I see that already in the data. In fact, we're in the middle of winter, as it were, and the market is a lot more active than historically has been the case. So to your point, I already see consumers responding to that. Today's buyers are hyper aware of what's happening in the mortgage markets. So they're already pushing hard to find their right home while rates are still low. Looking forward, I think we'll have a couple of factors to look at when it comes to consumers. One, there'll be the psychological one. As Adam mentioned earlier, right, if you have a mortgage at 2.7, 2.5 for some people, there's a serious psychological threshold to overcome to say, well, mortgage rates at 3.5, that's a lot. The other one, of course, is financial. It really will make a difference whether people's incomes and wages keep up with these mortgage rate increases. If we see a significant increase in wages, which a lot of companies are contemplating right now, that might compensate for some of the higher mortgage rates. Otherwise, for a lot of people, it might mean postponing that purchase by a few months.
Is there a way to, if you've got a very good credit rating, and you're trying to negotiate the mortgage, to use that as leverage to get a lower rate? Is there terminology or language you should use to pressure the other side, the bank or the lending institution?
That's a great question, Adam. And here I would like to point out that what we're seeing, 3.45, are really averages. A lot of lenders, depending on what market they're active in and what credit score their customers have, might offer below that. So to your point, I think for consumers, the best advice I would give is contact multiple lenders. Don't restrict yourself to one or two, maybe talk to 3 or 5, because many times within a competitive market, some lenders will be willing to make concessions, particularly to borrowers with excellent credit scores.
All right, we'll leave it there for now. George Ratu is Realtor.com Economic Research Manager, and we thank you so much for your time. Coming up, we'll get the Chief Financial Officer of Booz Allen's take on hiring top talent as job openings hold near record levels. Stick with us.
So we always talk these days about the Great Resignation. Perhaps we should expand the discussion to the Great Retention and talk about what companies are doing to retain the people who they consider to be the talented among their staffs. Let's bring in Lloyd Howell, Booz Allen Hamilton, CFO, to talk about this and the trends we're seeing, not only in hiring, but in people who are perhaps leaving to better their situation. Thanks for joining us. What do you see in the recent job reports, whether it be the JOLTS number or even the labor employment situation, that our bosses should be paying attention to?
Well, it was clear in the November jobs report that was released on December 4th that what we've seen is a record 4.5 million workers quit their jobs in November. Furthermore, in the January 7th, December jobs report release, we saw that the economy is adding fewer jobs in December than what was expected. So only 199,000 when 422,000 was expected. The report also highlighted that unemployment rate dropped to 3.9%, which is better than the 4.1 estimate. But the collection of these reports clearly point to, it's clear that to be an employer of choice, you have to recruit and retain top talent.
This morning, JPMorgan Chase reported quarterly results that showed an increase in costs due to greater compensation expenses. And CEO Jamie Dimon said the bank wants to be very competitive and on pay to attract talent, even if it squeezes margins a little bit for shareholders. Is Booz Allen taking a similar approach?
We are. It is clear that we are collectively weighing into a very competitive labor market. And we at Booz Allen have been fortunate to see an increase in our labor to the tune of 4.3 over the course of getting to a 2.1 billion record revenue. We saw an increase of about 6% year over year, as well as headcount growth of 2.3 on a consecutive quarterly basis. So compensation is very important. We are in a position where we're able to pass on that increase. Our clients also recognize the tightness in the labor market and are demanding that skill set. So we are recruiting and sourcing the best talent we have and trying to meet the expectations of the labor market.
How should your clients or even bosses react when an individual says, look, I am going to move on? Should it be an immediate decision? I'm going to attempt to retain?
It should be. We feel at Booz Allen, we've got a holistic view as to one's career. So part of our retention is really the retraining, retooling of our folks, redeployment, and really engaging them on what are their career aspirations. And for the most part, we've been able to do that successfully. Again, very competitive labor market, lots of opportunities for candidates to pursue. But we feel that we've got a very strong value proposition for our workforce and apply lots of different techniques and are able to invest in them in a manner that certainly through the pandemic has resonated.
In terms of recruiting and retaining diverse talent, how does that start for Booz Allen, and how do you ensure that you're continuing to maintain an environment that is welcoming and critical for these diverse talent to continue to succeed?
Well, we certainly feel that you got to walk the talk, and it starts at the top. In 2021, 36% of our new hires were BIPOC and 30% were female. At our board level, we've got 73% diverse representation. 45% of our board members are women, 18% African American, 9% Asian American, and 9% Hispanic. And that flows down to our executive leadership team, which is almost 90% comprised of women, 8 out of 9. And that's very visible to our workforce and, quite frankly, to the broader business community. So in addition to this, the statistics, we also have launched a diversity and inclusion program that really is inclusive and includes all of our workforce, and an active dialogue with them about what we could improve upon, initiating programs, and what part they play as we always seek to improve when it comes to diversity. When
you identify people that you might want to recruit in, there are obvious things to do. But are there new techniques to help recruit people to join an organization that you could share with us?
What we're trying to do is really make the experience more intimate and really address kind of the unspoken concerns or questions that a candidate may have. And it starts with the interview team. We work very hard to have a diverse interview team. We try to connect and build a relationship through the recruitment process and speak to all candidates about career aspirations and how Booz Allen is the best fit for them. Beyond that, once a new colleague is on board, we surround them with a host of support mechanisms that include diverse programs, diverse forums. We encourage them to not be shy about what they observe, what they would like in terms of their experience. And we're really focused on the inclusion side of DE&I. What we have learned is that it's one thing to onboard a diverse talent, but it's another thing to retain. And inclusion is very critical to the success in that endeavor. So again, holistic, it's very consistent with our core values around diversity. And we're always looking to walk the talk.
All right. We appreciate the helpful insight and want to remind everybody that Lloyd Howell is Booz Allen Hamilton's CFO. When we come back, we're going to prepare for the countdown to the closing bell.
Welcome back. The S&P 500 and Nasdaq have turned slightly positive with just a few minutes until the closing bell. And Yahoo Finance's Jared Blickery is back for another look at the markets. Jared, how are things looking heading into the holiday weekend?
It's like the little engine that could. The S&P 500, as you said, just turning green for the second time today. And I got this up on the Wi-Fi Interactive. And there you see it. After a little morning flirt with green, we see it again towards the end of the day. See if we can close positive here, although it looks like it's turning negative. So I don't think it, well, I'm going to be positive. I think it can too. NASDAQ looks like it's going to be safely green for the day. Russell 2000 also climbing into the green. So interesting end to the week. We'll go over some final statistics for the week after the bell, but I just want to focus on the sector action right now. As we've been discussing, energy by far and away the best performing sector of the day, followed by tech, communication services, those mega cap Latin sectors, as well as consumer staples. Really interesting to see this mix of a defensive and also value and also tech, kind of a jumble here. So not sure what to make of it. Here's a travel space. It looks like we're seeing more red than green. American Airlines down over 4%. Royal Caribbean maintaining gains, but Caribbean has fallen into the red. Norwegian Cruise Lines has as well. They've been green almost the entire day. Also want to take a look at the energy sector. That is the one bright green and dark green center tiles that you have on your screen here. And semiconductors, not looking too bad there either. So that's kind of leadership that we're looking at today. Just got a few minutes to the closing bell, so I'm going to send it back to you guys.
Jared Blickery, thank you so much. We've got the closing bell on the other side of this break. Stick with us. Welcome back. Let's welcome in our panel to discuss today's trading action. Jay Hatfield is InfraCap founder, CEO, and portfolio manager, and Colin Stewart is head of Americas at Quant Insight. But before we head to our panel, do want to get one final check of the markets before we get the closing bell on this Friday afternoon. As we can see here, the S&P 500 and NASDAQ looking like they are going to end in positive territory after a choppy session earlier. We do have the Dow Jones Industrial Average, however, still in negative territory, down nearly 200 points, or about half of a percentage point. And in taking a look at the S&P 500 sector action, energy, information technology, and communication services are outperforming. And here's the bell.
All right, we have a closing bell and we have a gavel. Let's see where the markets will settle today, because You know, we always say the last 20 to 15 minutes of the session is what you want to pay attention to. Why even trade during the day? Let's just have the last 15 minutes. The Dow's going to settle down about 200 points, but look at this. The S&P 500 in the last bit of the session actually went positive. It'll close up about 3 points. Nasdaq's going to be up 86 points, a little bit more than 0.5%. Let's go back to the panel. And let me start with you, Colin, especially since your firm calculates mathematical relationships between factors in the real economy, financial conditions, and measures of risk appetite. For those of us who might have had to repeat calculus and not pass it, I'm taking a look at the S&P 500 right now. What's the risk appetite? Because it feels like there's a lot of fear out of there, even though at the last minute this went positive.
Yes, as far as we're concerned, the mathematical relationship between the macro factors has a strong relationship to volatility. In fact, volatility such as VIX and German VIX are among the top negative factors that would drive the S&P down. And in fact, we have a separate volatility indicator that indicates that VIX could be rising from here. But the balance of what's driving the S&P from a macro perspective is that. But on the other side, Fed rate expectations and inflation expectations are driving it higher. So our sensitivity analysis suggests that the S&P right now is fair from a macro point of view at 4,772, but it likes Fed rate expectations and rising inflation, but would fall on balance because of falling volatility.
Jay, one of the things that you pointed out in your note to us is that tighter liquidity, not interest rate increases, is the key driver of the volatility we've been seeing in tech and other risky areas like crypto. Explain more of what you mean by this and what this means in terms of what headlines investors should be looking out for coming from the Fed that may stir up more volatility in these market areas.
Thanks for having me on. What we view as the key driver of the shift to momentum stocks was really this unprecedented liquidity that the Fed was injecting. And the minute it became obvious that they were going to withdraw that liquidity, which is at the end of November, that's when you saw this rotation out of tech and into value started. So the Dow has outperformed the Nasdaq by over 7.5%. And so that's the real driver, is liquidity. That tends to drive momentum, and that tends to drive the risk premiums down. There's a urban myth that tech stocks have much more interest rate sensitivity than other stocks. But if you really do the analysis, and we've done that and calculate the duration, which is the way to measure interest rate sensitivity, normal tech stocks that trade on the stock exchange have similar durations to value stocks. It's only private companies that have payoffs 30, 40, 50 years that might be a little bit sensitive to that, but that's not the key driver. It's really tight Fed.
Jay, there was something that jumped out in the notes that you sent us that I wanted you to help us explain and help us understand, which is when the 10-year yield is above 2%, and you use the word significantly, so I'm curious if you can put that into context. $52 trillion of global pension assets will rebalance and reallocate into treasuries. What does that do to liquidity when that moment happens?
Well, it doesn't have a big impact on liquidity. There would be some selling of stocks, but then if we're correct and there is a lid on interest rates, so 2% on the 10-year-ish, and that would imply a 30-year almost 3%. What happens is the pension funds, first they need to rebalance every quarter. So if stocks have outperformed, they sell and buy bonds. But if bonds have underperformed, they're going to buy those. But what we saw in the past is that the boards of these gigantic pension funds decide, well, why are we only in 28% bonds when the 30 years at 3 and our bogey's 6? So we expect them to raise those allocations. And then the final reason we don't think rates are going to infinity is that the rest of the world, particularly in Europe, is very slow, partly because of the blown energy transition. So we see US rates being very competitive globally as well.
Colin, earlier today, we had JPMorgan CEO Jamie Dimon saying that there's a pretty good chance that there will be more than 4 interest rate hikes this year from the Fed. There could be 6 or 7. What do you think about this? And what do you think the market has priced in for now? Because it seems like for now, perhaps not 6 or 7 are priced in, but could they be?
As far as JPMorgan is concerned, it's definitely very comfortable with rising interest rate environment. We see them positively sensitive to rising interest rates with about three interest rate rises over the course of this coming year. But as far as JPMorgan is concerned, the macro fair value of that company is $163 right now. So just little spot prices under that, given the balance of what the positive and negative drivers with Fed rate expectations and inflation on both sides.
Colin, one of the things you point out that can hurt the index the most would be higher volatility, but especially a widening credit spread, say in the EU or in emerging markets. Is that, how much those spreads have to widen to be a real potential threat?
So as far as credit spreads are concerned, I would say that particularly the European credit spreads widening, that is the highest negative factor. So if they rise by one standard deviation, you're going to see the S&P fall by 9 basis points. If you have US high yield expand by one standard deviation, another 8 basis points, and FinSub in Europe, a similar amount. So it's really overall across the interest rate perspective in the developed markets, it's going to be about a 24 basis point fall in the S&P with a one standard deviation move higher. What's more interesting perhaps is in China. If Chinese 5-year credit spreads rise by a standard deviation, then the S&P would fall by 15 basis points of all things remaining unchanged.
All right, we'll leave it there for now. Colin Stewart is head of Americas at Quant Insight, and Jay Hatfield is InfraCap founder, CEO, and portfolio manager. And we thank you both for your time. Let's bring back in Yahoo Finance's Jared Blickery for one more thought on the markets. And Jared, what do you make of this week's action?
Well, it was all about energy, as we've been saying. So let's take a look at the Wi-Fi Interactive and get the final stats for the week. Here we see the energy sector up 5.2%. The only thing else in the green was communication services, just barely positive, tech just barely negative. So actually not too bad a week for some of those mega caps. To the downside, real estate, that's down 2%, consumer discretionary, that's down 1.5%, and utilities, that rounds out the losers, who are down more than 1%. Now in the NASDAQ, let's sort this by performance. And before we do that, let's just say Microsoft down 1%, NVIDIA also down 1%. But you look at the big winners here, Applied Materials, that stock reaching a record high earlier in the week, that's up 10%, Illumina up 9%, Lam Research 9%, Pinduoduo up 8%, so is JD.com. So really it was the chip stocks and some of the Chinese stocks that fared best this week. To the downside, Peloton off another 12%, Lululemon down 7, Dollar Tree 7, Zoom 7, Starbucks 7. So it looks like a lot of these high-flying names still experiencing a lot of pressure. Check out the travel sector here. Really, the cruise lines, the main source of green. Well, also Wynn Resorts is up 8%. That's a China story, but Carnival's up almost 5%. Royal Caribbean almost 4. Norwegian Cruise Lines about 3. And then we got to take a look at the carnage in ARK. Now, these are some of the top components here, and you can see this week alone, DraftKings down 15%, Intellia Therapeutics down 13%, Roku down 7%, so is Zoom. It really kind of boggles the mind as to how much further some of these stocks could drop. But if you're looking for that dead cat bounce in these names, maybe hold out for next week, guys.
Jared Blickery, thank you so much and have a great weekend. This week has been a difficult one for the Biden administration as new data showed inflation soared by the most in decades, and the Supreme Court struck down much of the White House's vaccine mandate. Yahoo Finance's Rick Newman is here to discuss in this week's Bidenomics. Rick, break this down for us.
Well, as Joe Biden's first year basically comes to an end, he's about as low as he's been during his entire presidency so far. We got a new poll out this week showing his approval rating is 33%. That is absolutely dismal. Other polls have him higher than that, but he seems to be sinking below where Donald Trump was at his lowest point. And there are some puzzling things happening in the Biden administration. So yes, consumers are bummed out about inflation. They should be. They're bummed out that we can't seem to get past COVID. They should be. Those things are not really Joe Biden's fault. He's just going to have to wait those things out. But this week, Joe Biden gave a big speech about reforming the filibuster so that this voting rights bill can pass. But everybody in Washington knows that there aren't enough Democratic votes to reform the filibuster. And even after he gave that speech, a few Democratic senators came out and said, nah, that's a bad idea. So what is going on with Democrats here? And why is Biden spending time talking about something that's never going to happen when ordinary families are facing these very real problems? So there's a messaging problem, there's an execution problem in the Biden administration, and there's a communication problem. So he could pull this together in his second year, but he's not ending the first year on a very strong footing.
Picking up on that, Rick, how do you pull it together? I mean, one of those senators actually delivered that speech before the president addressed his own party. And it seems as if, a lot of self-inflicted wounds, not only by the administration, but by the Democrats who, have a circular firing squad.
They do. I mean, I'm glad you see it the same way I do, Adam. I think to get this back, get back on track, stop the self-inflicted wounds, stop the unforced errors. Does Biden get the problem here? So there's a reason that he's doing these things, that he's putting some political capital into things like a voting rights bill that's never going to pass. He's trying to appease the Democrats' liberal wing. The question is, why in the world is he trying to do that? Most people looking at their rent going up and their food bill going up and they can't afford a car, they're not saying Congress really needs to pass this voting rights bill. It's important. Those issues are important, but that is not the thing that is on the minds of most voters and most families right now. So if Biden is going to recover, he just needs to start focusing on mainstream voters and what they care about and forget about. He needs to forget about Bernie Sanders and Elizabeth Warren and Alexandria Ocasio-Cortez and the progressives he seems to be obsessively catering to. I don't really know why he's doing that.
All right, Yahoo Finance's Rick Newman, thank you for that report and have a great weekend. Coming up, the Andretti Acquisition Corporation SPAC, led in part by IndyCar legend Michael Andretti, is on the hunt for the next big disruptor in mobility. We'll tell you about it on the other side of this break.
All right, race car fans, it is a fact that the technology and the state-of-the-art technology in a lot of race cars eventually winds up in some form or another in the cars that we buy on the private market when you can finally get a car with the manufacturing and the supply chain issues these days. I bring that up because we're going to bring in Michael Andretti, Andretti Acquisition Corp. Co-CEO and Director, along with Bill Sambrook, Andretti Acquisition Corp. Chairman and Co-CEO. Because, Michael, the other thing race car fans know is that if you've ever been to the infield at the Indianapolis Motor Speedway back in the day, there is treasure and trouble to be found. And you're raising a great deal of money looking for treasure. So what are you going to do with this blank check company that is now trading? What are you going to acquire?
We don't know yet. We just starting the process of vetting the companies. We've actually been lucky enough to have 40 companies already come to us with interest for us to acquire them. So we're just, we haven't started the vetting process yet, but it will be probably in the next week.
Bill, you and Michael have known each other for a long time, both professionally and personally. Tell us how you decided to work together on Andretti acquisition.
Sure. I had retired from U.S. Concrete about a year and a half ago. And around Christmas of last year, Michael came to me with the idea of starting a SPAC. He knew that he had a really good brand, and he has a fantastic network that the Andrettis have built over the last 50 years. And he has the ability to test out technologies on the racetrack that make it into the commercial mobility space. But he also knew that he needed somebody that had public company experience. And I had done that for my entire career after I left the Army, and having successfully run U.S. Concrete and actually sponsored his son's race car where our business interests intersected. He came to me because we've known each other for 50 years, and he trusted me. And from there, here we are today.
Bill, following up on that, though, I mean, we're in a technological revolution as we go from internal combustion engines to electric vehicles. I imagine there's a great many companies. How do you weed out those which are not worthy of acquisition or merger from those which are truly gems?
Sure, they need to have a good management team. They need to hopefully have a need that is not being met in the current marketplace. Hopefully, that we can make them public company ready. Remember, this is all about taking a private company, probably entrepreneurial bent, a founder that's more of an inventor than a public company CEO. And 3 months into the process, they're a reporting company. And a lot of SPACs or a lot of de-SPAC companies have tripped up in that. So it's a combination of that they have some competitive advantage, a good management team, and the ability to go public and provide a market need that's not being met right now.
Michael, there were rumors last year that Andretti Autosport was looking to buy potentially a Formula One team. Would you consider acquiring a company in that space through Andretti acquisition?
No, this is actually separate from the racing side in terms of that. I'm still interested. We're still looking at Formula One, but I have backers for that are very interested in doing it. So this is completely different. Now, if the team can help in any way, then obviously, we'll be there to help. But it really has nothing to do with that.
Michael, I'm going to deviate a little bit from what you're doing business-wise because we're excited to see when you actually do this, deploy the funds and merge. But from the racing side, do young people have the excitement these days for Formula One and for IndyCar racing? Or because, there are teenagers today who don't want to get their driver's license, which blows me away. I can't believe it. But does it still hold? I'm old enough to remember Jim Nabors singing Back Home Again in Indiana at the 500. Mm-hmm. What's going on?
It is a little strange, I got to admit. That's one thing that's been pretty cool for us. We've been in the sustainability space with Formula E, which is an all-electric series. It's a world championship series. It's actually the only FIA-sanctioned world championship electric series in the world. So we've been in that space, as well as Extreme E, which is a new series, which is electric off-road racing. So we have I think, been able to keep the young fan interested, because a lot of the youngsters nowadays are very concerned about the environment and things like that. And so I think we've been able to get a lot of new fans in that way through that series, those two series.
Bill, I want to dive a little bit deeper. What specific criteria are you looking for in an acquisition target? Because as I believe Michael mentioned earlier, there were already companies interested in a tie-up with Andretti Acquisition. So how do you really parse through these potential tie-ups?
Well, there are obviously some pre-revenue companies because they're on the cutting edge and probably have the sharpest growth curve. So we'll look at them, but they also bring a lot of risk. And we also have a number of companies that have EBITDA, are more established, and are safer bets. But like I said before, they need to have a product or a competitive advantage or a niche that has not been met by any other public companies at this space at this time, and they do need to have a good management team in place.
We wish both of you the best. Michael Andretti, Andretti Acquisition Corp. Co-CEO and Director. Bill Sandbrook, Andretti Acquisition Corp. Chairman and Co-CEO. And if you're old enough to remember Jim Neighbor singing "Back Home Again in Indiana," am I on key? I say that because if you're old enough to remember that, then you're old enough to pay attention to our retirement segment right after the break.
The Biden administration's new policy requiring private insurers to cover the cost of at-home COVID tests starts tomorrow. But what does that mean for Americans with Medicare? Juliette Kabansky, KFF Deputy Director of the Program on Medicare Policy, joins us now to discuss as part of our retirement series brought to you by Fidelity Investments. And Juliette, I want to start with that question. Many Americans age 65 or older are on fixed incomes, and the cost of paying for multiple at-home COVID tests out of pocket can add up. What are the options for those on Medicare to get free or affordable testing?
Well, there are a few options. As you noted, people with Medicare are not able to get reimbursement directly from Medicare the way that the Biden administration is requiring people with private insurance to get reimbursement from their health insurance companies. But people with Medicare can take advantage of free testing that's available through health centers in their communities, rural health clinics, pharmacies. Many of them are offering free testing. So there are options. There is also a new federal government website that has just been announced, covidtests.gov. That will be an option for people to request up to 4 tests that will be mailed to them at no charge. So Medicare beneficiaries do have access to free testing through those options.
I want to shift gears and talk too about the news regarding the Alzheimer drug. I don't pronounce it correctly, so I'm avoiding pronouncing it. But it'll be allowed, but in limited use. I mean, a lot of us either have someone we love or someone we know where, we're looking for help, for treatment for them. So where do we stand on this?
Right. So the FDA approved this new drug called Aduhelm in June of 2021. But for months, we've been waiting to know more from Medicare whether it will cover the drug or not. And just this week, Medicare announced a preliminary decision that it will cover this new drug, but only for patients who participate in approved clinical trials. That is a relatively restrictive coverage criteria, but Medicare's decision was based on the fact that there's really not a lot of evidence yet supporting the value of this drug, suggesting that it really actually does improve clinical outcomes for people with Alzheimer's disease. So we are now entering a period of a 30-day public comment period. And in April, Medicare will announce its final decision as to whether it will cover this drug under this clinical trial pathway or whether it will change its mind and issue a different decision. So we're kind of in a wait and see mode until the final decision is announced.
Going back to the COVID testing and reimbursement policy, given the options for those on Medicare to receive COVID tests, as you were breaking down for us, you mentioned the White House's new website as one of several other methods outside of reimbursement. But does this provide enough access for those on Medicare, or what more do you think could potentially be done?
Well, access to at-home tests is an issue for all of us, right? It's very difficult, pretty much wherever you are at any age, to find these at-home tests. The Biden administration has announced that it's buying 1 billion at-home tests, and those will be distributed, as quickly as possible. But supply is certainly an issue for all of us right now. It I think is up to Congress perhaps to make decisions as to whether Medicare can actually cover the cost of at-home tests for people with Medicare. It may also be an option for Medicare beneficiaries who are enrolled in private Medicare Advantage plans to seek reimbursement for at-home tests, but that is not a requirement. So, I think right now we're in a bit of a struggle with the supply of at-home tests. And once that loosens up, then I think Medicare beneficiaries, as well as the rest of us, will have an easier time getting access to at-home tests, particularly for free through local community sites.
Is there a final issue, because we pay attention to these headlines as they affect people who are eligible for Medicare, but is there another issue that isn't getting attention that you might want to highlight right now in addition to what we've already discussed?
Well, I think one issue, back to this issue of the new Alzheimer's drug that we were talking about, the Medicare Part B premium for 2022 increased by 15%, which was a dramatic increase relative to what it typically is in a given year. The Medicare officials, when they announced that premium increase, said that a lot of it was due to this high-priced Alzheimer's drug, and the fact that Medicare needed revenues in order to pay for what they expected would be billions of dollars in additional spending. Then the manufacturer of that drug cut the price of it in half. And now we've had this coverage decision, which is likely to really limit access to this drug much more than Medicare officials maybe initially thought when they set the premium for this year. So there's now discussion and perhaps some pressure on Medicare officials to revisit the increase in the Part B premium for this year. It's not clear, the timeline for making any changes. But if there was, any relief in the Part B premium, I think that would be very welcome for Medicare beneficiaries who, as you noted, many of them live on limited incomes. And so any cost relief, I think, would be welcome.
All right, we'll leave it there for now. Juliette Kubanski, KFF Deputy Director of the Program on Medicare Policy, thank you so much for your time this afternoon. Bentley residences are coming to Miami Beach. We've got the details on a new luxury residential tower in Florida on the other side of this break.
So gone are the days when Esther, Sadie, and Lil were hanging out at Wolfie's on Miami Beach. They had a bagel with a schmear, and Wolfie's is gone. A lot of people think Miami Beach not the same since. I bring that up because Miami Beach is one of the hottest residential places you could go. And when Wolfie's was around, not so much, right? Our next guest, Gil Desert Development President, is joining us along with Pras Subramanian, who usually covers cars, but what Mr. Desert and his company are about to build involves Bentley Motors. It's fascinating, and you've done this before. So tell us about the luxury plan for the shoreline on Miami Beach that you're going to be building.
Well, we're getting ready to start selling our next tower. We built a successful Porsche design tower that sits on the ocean in Sunny Isles Beach, and now we're moving on to the second building, which is going to be the Bentley Tower, Bentley Residences, 216 oceanfront apartments with our patented car elevator system. that takes you and the car up to the apartment and places the car right in front of your living room. So it was a tremendous success on the Porsche project, and Bentley wants to do a follow-up. So we're changing it around to really mimic what it means to be the Bentley brand, and it's going to be one of the most spectacular towers here in Miami.
Hey, Gil, Pross here. How did this deal come about? Did Bentley approach you? Did they have a say in the design of these really cool apartments with, as you said, the in-unit garages?
But yeah, of course, we worked with Porsche Design that eventually became part of the Volkswagen Group, and Bentley is as well part of the Volkswagen Group. So they're kind of sister companies, and because of that, we were able to make a good deal with them to really kind of brand the buildings and as well as work on other branded Volkswagen brands.
Gil, this is Emily here. Shifting gears slightly, we've been talking a lot about the movement of people from leaving New York, San Francisco, and moving to Florida during the pandemic. What have you been seeing in terms of those trends in desert properties?
I mean, well, what we've seen as far as that goes is people are definitely looking for Florida. You know, they're coming down here during, I don't know if you can hear that noise in the background, I apologize, but they're coming for exactly this, for the noise in the background and beautiful sunshine that we're having, and instead of being locked up and locked down in cold places. And so Florida really, we're very lucky to be here during the pandemic. And the result of that is people starting to take note and come down here and make Florida their home. And so for us, it's been a tremendous boom in the real estate market. Houses are selling for record prices. All the condos that I've built up to date have been sold out. And so now we're ready to launch our next project.
So Gil, I got a two-parter here. First off, what sort of insights did you use from the Porsche Design Tower that was actually very successful? What did you guys use from there to kind of grow that experience at Bentley? And secondly, you mentioned that South Florida real estate scene. How has client reaction been to this, the Bentley residences so far?
Well, I mean, what we really did at Porsche Design Tower and what we're doing again at Bentley is really the home in the sky concept. You're driving into your apartment. We put swimming pools on the balconies, and we really created the home in the sky. And so, and that's what people are looking for. They're looking for the turnkey solution where they can walk in and have that place here in Miami. And then when they leave, they just lock the door. They don't have to worry about the gardener, the pool guy, et cetera, and go back to wherever their other residences are. So, I mean, we really look on our floor plans. We put a lot of attention to how the units work and how the apartments work. And so, that was a success at Porsche. And the few mistakes we made over there, we made a lot better at the next tower. And of course, the Bentley brand itself, it opens up a whole different world of design and look and feel and performance and aesthetic. So we're really mimicking those with the same designers who designed the cars. Those are the same people who were working on our tower. So we're very fortunate to be working with really, really talented people who are going to be doing the interiors and helping guide the exterior of the building as well.
Hey, Gil, one more. I just wanted to ask you about why these collaborations work. Like, what does Bentley get out of this? What do you got? Why do you think there's luxury automakers and high-end developers kind of want to meet in this middle and do something together?
I mean, we are working on putting together a case study to see if they actually sell more cars by having like a real landmark to their brand within the market. But it definitely creates the transition between car brand into lifestyle. And I think that's what a lot of these car brands are looking for, because they're not just car brand companies, they're actually creating that lifestyle. And the car is part of the lifestyle. But so it really helps them, show what Bentley home furniture looks like and what Bentley design can do and transition what it is to live inside of your Bentley, basically.
As a car nut, I can tell you this is a fabulous idea, because I would absolutely put the car in the living room, although I'd probably lose the battle over that one. But I'm curious. My taste exceeds my wallet. I would love to own a Bentley. What's the price range, entry point? I'm just going to guess here that we're looking several millions of dollars for an entry-level unit in one of your luxury buildings.
The entry-level unit starts at $3.9 million, and it goes up to $7 million with penthouses starting at 15. So it's relatively not tremendously expensive compared to what is being sold on the beach, what is being offered on the beach. We sold the majority of the units at the Porsche Design Tower between $5 and $7 million. So we're kind of hitting that perfect sweet spot of the second home buyer that loves to come down to Florida and have this kind of apartment. At Porsche Design Tower, just to note, we had only 2-car garage per unit, and here we're doing a 4-car garage with a larger swimming pool, larger balcony. So it's just a little bit bigger of an apartment and a way better floor plan. So we think since we had such great success with the Porsche building, this is going to be a no-brainer.
For the Bentley Tower, what's your favorite feature here? Because you have so many amenities, of course, the car elevator. What would you say really is the standout feature of this particular tower?
I mean, one thing that really surprised me, the Bentley guys designed a spa, which is nicer than most of the spas I've ever seen in hotels that I've been to. I mean, the spa here is going to be really cool. Of course, the best feature is the fact that we have a car elevator inside the unit. You can just simply come inside the building. It picks up your car, it lifts it up to whatever floor you are in the building and places it right outside. So there's a certain level of privacy, security that goes along with that. You can just pull your things right out of your trunk and bring them to the house. You don't have to request assistance to come and go. So people actually really, really appreciated that. And that's why what the net result of that was we had a tremendous amount of celebrities like Lionel Messi, the soccer player. We have some singers like Maluma and others people who are now living at the Porsche Design Tower because of that level of privacy that you could just kind of come and go from a building without asking anybody for help.
That 3.9 million entry point, I was thinking, well, you can get a studio in New York City for that. But Gil Desert, you've got us tempted. Desert Development President, congratulations, and break a leg when you break ground on the tower. Also, Pross, we'll see you at the post meeting. When we come back, we're going to be talking about a new real estate investment IPO. You may want to get in on this one.
Welcome back. If you want to own real estate, NICE is letting you invest in a piece of a property for as little as $100. NICE CEO Philip Michael joins us now for more. And Philip, this is a property at Temple University in Philadelphia. You first had a public offering for a building at this location back in 2020, and you're building on this now. Explain how this works.
All right. So the way that it works was that we took it through something called the Regulation CF, which allows people that are so-called non-accredited investors to come in and own a piece of a property that was typically reserved for so-called accredited investors who are worth $1 million or more. what our mission is to help people who aren't necessarily part of the 1%, but part of the 99% to come in and own a piece for as little as $100. We did that. People came in at $1 million valuation. 3 months later, it appraised at $2 million. And then we have more land around the property. It's a small tech neighborhood, if you will, inside campus. We call it Silicon Square, similar to Silicon Valley. And people can now we're closing it up, buy in the second part, phase 2 and phase 3. And then here in Q1, in terms of the IPO, we will consolidate the whole project into one stock. And then the plan is to list it on Lex Markets, which is NASDAQ powered real estate trading platform, where people will be able to get a piece of this development for $100, trade in and out freely. And yeah, that's what it is. They'll be able to do that, and they'll have it in their app like TD Ameritrade, Schwab, and so on and so forth. So that's what it is.
It's genius because you bring liquidity to a class of investors who, one, have been priced out because they're not accredited, but the liquidity is a big part of it. How much do I make if I go in at $100 though? I mean, this is fractional. So, I mean, $100 is only a couple pennies, right?
That's absolutely correct. Think about it how it is if you invest in Tesla or Amazon. The rate of return is the same, whether it's me, whether it's somebody that put in $100,000 or somebody that put $100. So year to date, ourselves and our co-investors are up 105.5%. So it's 2x. Now, granted, it's a high inflation environment, and equities have done well in that environment as they typically do. So that's not necessarily a normal case, but to answer your question, if you get a 2x return on $100, you have $200. However, if you have $100,000, then it becomes $200,000. The numerical value changes dramatically, but the rate of return is the same for everybody. But the idea is not necessarily for that $100 to turn into $1 million. It's to get people started, just like retail investors that get into the stock market that haven't done it before via Robinhood or a number of the other apps that are out there. So that's what we aim to do, give people access to alternative asset classes just like real estate and deliver the same type of results.
Right, and do you have a sense of who your investors are? Because we saw in the past year and a half, there has been this explosion in fractional share ownership in the Robinhood investor, the Reddit retail investor. So who are your investors?
Well, it's really interesting. There's a high number. It's north of 80% that are people of color, which is, it dramatically outdoes anybody else that's really on the market. And I think it's because we've been able to communicate with a particular market of particularly people of color and minorities. There's this statistic that says by 2053, Black wealth specifically will drop to zero, the median Black wealth. And there's this rising wealth gap, but the number one driver behind that is absence of real estate ownership. So we really wanted to make it accessible to people who haven't had it, get them familiar with the asset class, and hopefully go out, yes, of course, learn how to build a diversified portfolio within what you have, but also go out and buy property for yourself, because this is where the bulk of wealth is built. So it's almost like a gateway drug to investing by using our properties in that sense. I hope that answers your question.
You did, and I won't keep saying genius, but I got to ask you because on one hand, alternative wealth, you know, when you invest in alternative investments, you're locking it up, but with this you have the option of liquidity because you can trade your investment. But is there also the way like a real estate investment trust would work? Are these buildings, are they rental income kickoff, and does the holder of the equity within the investment get a fraction of the, I'll call it the dividend, the payments?
Yes. The short answer is yes. Now, we have different type of properties with different type of investment appetites. This one in particular was a development project, which means it doesn't cash flow until it's stabilized, which means once it's fully rented out and then it'll cash flow. The plan with the stock, once it's trading, is to have it be a dividend stock, similar to how a REIT would be. So it was actually a really great question. Yes, that's how we wanted to be. That's phase one that we had, that stabilized in the opposite corner is where people could get in, also at the development construction price point, if you will. And then once stabilized and once it's trading, they'll get in there to be able to trade in and out while collecting dividends according to their fractional ownership share of the property. And then they'll get the equivalent, their portion of the rent roll, right? So that's how it will work.
Do you have plans to expand these kinds of IPOs outside of the Philadelphia area? And if so, what places are you targeting?
That's a really good question. I really like Philadelphia. We have other properties in other parts of the country, and this is something that we really want to do with these particular type of projects. Now, with a development project, the risk happens on the front end, meaning if you buy a piece of land, that's when it's the riskiest because you have to get approvals, you have to get financing, you have to make sure it gets built and then leased out. Once it's closer to completion, a lot of the risk has been removed. So that's what we like to do, put up our own money first, bring it close to completion or even completion, and then we let people buy in. So there's not that long of a time period before they can get into liquidation or collecting dividends if that's what they want to do. To your question, we have properties down in South Florida that we're exploring that we're actually developing in South Florida right now as we speak. In Texas and other areas like that. I don't want to say too much, but yes, we absolutely have plans to do that. I just have to be careful what I say because it's not something we've filed for yet. But absolutely, that is a plan for the future projects, just so people have an exit option, can have a great experience with this, because a lot of them are first timers. So for instance, this project has over 5,000 people of color who are first time investors in this particular asset. So we want to make sure that there's a straight pathway to getting your returns, cashing in and out, and having that good experience. So you hopefully continue, not just with us, but to build your portfolio, because that's really the cornerstone of having of building wealth for yourself. So we just want to be the gateway drug for people to get the wealth management and wealth building tactics that the 1% has, but bringing it to the 99%. So that's how we want to do it.
All right, and we were looking forward to more updates out from NICE. Philip Michael is CEO of NICE, and we wish you a great weekend. Coming up, we'll get an update on the box office as the new Scream hits theaters. Stick with us.
When the first Scream movie came out, let's just say the stars of that film are now eligible for AARP cards. But why, you got something good, why not do it again and again and again? Ali Canal is here with fame and fortune because they're going to do it again. And Scream 6, or is it Scream 5?
Scream 5, yes, it is back for round 5. I'm a big fan of this franchise. I absolutely love these movies, so I'm certainly going to see this in theaters. It's making its debut today. According to ComScore, it's projected to make between 25 and 30 million within that opening weekend. And, it's going up against some pretty heavy hitters. We have Spider-Man No Way Home, which just continues to dominate the box office. That movie has earned over $1 billion domestically, with the potential to reach $750 million when all is said and done. So there's some question marks here of whether or not Scream can overtake Spider-Man at #1 this weekend. But if it does, it's certainly good news for the box office. This is a theatrical exclusive. Once it's done, its theatrical run, it will then go to Paramount Plus to stream. And that's, something that a lot of studios have been talking about, especially with the rise of the Omicron variant. A lot of studios have recommitted themselves to that model of theatrical first, followed by streaming. And we did get the chance to speak with IMAX CEO Richard Gelfond earlier this week. He said, despite all of these scary headlines that we've been getting about COVID, that's actually not the biggest risk factor at the box office. Instead, he cited the streaming component and studios' lack of faith in the theatrical experience. So here's a closer look at what he had to say.
Ironically, one of the biggest problems is studios who don't have faith in the theatrical release. As you know, during 20 and 21, they took a lot of movies and they put them on day and date streaming. And a result of that was they didn't have good box office performance. And even in streaming, as you've seen from the streaming numbers, people didn't sign up for streamers for movies.
Yeah, so Gelfond is not a fan of the day and date release strategy, that hybrid release strategy that we saw through 2021. Experts that I spoke with said it was very hard to really determine how successful a film was when they had that hybrid format. It's really difficult to measure a streaming view with a box office ticket, and some of the data surrounding that is still a little murky. But speaking of streaming, we got the news just an hour ago that Netflix will be raising monthly prices on their plans in the US and Canada starting today. Their standard plan will now cost $15.49. That's up from $13.99 in the US. And across the board, depending on the plan, Netflix says it could rise between $1 and $2. Now, the stock, it did pop on that news, rising nearly 4%. Investors love that pricing power. And it speaks to the larger story here that consumers are gravitating towards streaming platforms. No matter how much they cost, they're going to want to sign up and to watch the content that's available. So I agree with Mr. Gelfond that streaming is definitely a risk for the box office heading into the new year, but I don't think we're going to see as many hybrid releases as we did in 2021.
All right, Ali. And by the way, you can save some money if you don't want to go pay to see Scream. Just watch this movie on HBO, View from Above. Even Gwyneth Paltrow says worst film ever made, although I love the Cleveland connection. Everybody have a great weekend. We're going to do it again on Tuesday. Markets close Monday. See you later.